Running a race is like financing a business investment. The work is not done when the race starts. You need to plan the exact pace that you want to run at and stick to that. In the world of business, many investments will also not work out as the companies hoped for. There is always another race to run. Your next win may be just around the corner. Welcome to Corporate Finance 2, Financing Investments and Managing Risk. My name is Heitor Almeida. I'm a professor of corporate finance at the University of Illinois at Urbana-Champaign, and I've been teaching corporate finance to MBAs, PhD students, and undergraduates since 2001. I also do research, and in particular, I research corporate finance topics that we are going to discuss in this course, such as risk management, capital structure, payout policy. You're actually going to see several of my papers showing up as discussion topics for corporate finance too. So this is very exciting to me to be able to share my research with you as well. What we're going to do in this course is to learn how companies finance investments and then manage the risks associated with these investments. So the two big topics are financial management and risk management, financing and risk management. Some of the specific issues that we're going to study are how much debt a company should have. How can we determine the optimal leverage ratio? How would a company choose between bank debt and public debt, bonds? How to set a payout policy using dividends and share repurchases that creates value for shareholders. How to manage risks using derivatives, but also other tools such as liquidity, purchase obligations, and some other topics we're going to talk about in Module 3 when we get to risk management. And finally, what we're going to do in Module 4 is to use all the theory, all the examples that we developed in the first 3 modules to construct financial management plans for M&A deals and R&D programs using data from real-world companies. So Module 4 is really going to be the point at which you can apply what we learned to some real-world examples, some cases about real-world companies. So make sure you get to Module 4. This is the structure, by the way. We have four modules. We're going to start talking about capital structure. Then we're going to go deeper into debt financing and payout policy, move on to risk management, and finish with the case studies that I just mentioned about acquisitions and R&D. Okay? Let me relate this course to Corporate Finance 1. I'm sure this is something that you have on your mind. How does this course relate to the previous one? This is the follow-up, right? So in Corporate Finance 1, we studied how companies make investment decisions that create value for shareholders. So really, the focus on Corporate Finance 1 is more on spending cash. How can we determine whether a company should spend cash in a project, for example? Whereas in Corporate Finance 2, the focus is on raising cash and also paying out cash to shareholders. So for example, in Corporate Finance 1, we talked about how to measure the contribution of a new project or acquisition to shareholder value, or how to incorporate risk and uncertainty into investment decisions. In this course, we're going to talk about issues like capital structure, payout, risk management, which is more on the financial side. So Corporate Finance 1 is about investment, spending money. Corporate Finance 2 is about financing and risk management. Can you take Corporate Finance 2 without having taken Corporate Finance 1? The answer, of course, is yes. It's up to you. The course is open. I would like to say, though, that it's not ideal because I am going to use tools and concepts that we also discussed in Corporate Finance 1, such as net present value, financial planning models, and other concepts as well. So I would, it would be better if you could take both courses. However, I understand some of you may be more interested in corporate finance too, or you may have some background already. What I'm going to do to make it easy for you is every time I use a concept or idea developed in Corporate Finance 1, every time I draw on an example from that course or I draw on a concept that we studied in Corporate Finance 1, I will try to state it explicitly in the slides and then point out to a specific module in Corporate Finance 1 where you can go back and review that material. Okay, so that way I think you can easily go back and look at what you need, learn what you need, and then go on with Corporate Finance 2. I think it won't be too painful to go back to Corporate Finance 1. This is actually a very highly rated finance course on Coursera. These data come from about October 2016. We had we had 171 ratings, right, exactly, and we got a rating of 4.7 out of 5. Thank you for all of you who have rated the course, shared your stories. There is an example here for you. Thank you for helping out with this really the marketing aspect of the course. Of course, I'm very glad to see that you enjoyed Corporate Finance 1. And I hope you are going to enjoy taking this course, that course as well. If you are just thinking about whether to take Corporate Finance 2, maybe you want to take Corporate Finance 1 as well. So what are some of the issues that we're going to borrow from Corporate Finance 1? You are going to see that we're going to use lots of real-world examples. So it's not just theory, it's not just examples from textbooks. I'm really going to draw on examples from financial management at real-world companies and try to dig into data, try to understand what these companies are doing and see what we can learn from these examples. So these are just like 5 different companies that we're going to talk about in the course, but there are many more. And when we talk about real-world companies, for example, here you have AT&T, we are really going to get into the real data. I'm not going to massage the data or change things or make it easy for you. I'm really going to draw the data directly from financial statements and give it to you so you can look at the data, learn where to get data, how to read financial statements, and how to use them to do financial management for real-world firms. There is also going to be time for questions. If you took Corporate Finance 1, you might remember that there are many questions that are introduced in the videos, right? Where we stop the video and we allow you to think about the question, spend some time reflecting, going back to the early material, trying to answer questions. I think that's an important part of the learning. However, there are also some new things. There are some exciting new things. As I mentioned before, there's going to be a greater focus on research. As it turns out, even though both Corporate Finance 1 and Corporate Finance 2, both investments and financing are extremely important topics, most of the research in corporate finance actually focuses on financial management. So as you're going to see, we're going to draw on a lot of the most current, the most updated research on issues like capital structure, payout, risk management, and really bring them to this course and to see what we can learn from researchers. And I'm promising you there's going to be a lot that we can learn from recent research that's going to improve the way that you can do financial management in the real world. So very practical, applied research, but very solid and careful research as well. The other new thing we have is we have a couple of interviews with small business owners. We're going to interview the owners of two local companies here in the Champaign-Urbana area. One is Analog Outfitters, the other one is non-incorporated. And the reason we are doing that, there are really 2 reasons. The first reason is that these interviews are going to give you a perspective from small business. Most of the examples that we talk about in this course, like AT&T, some of those pictures you saw in the previous slide, are examples from large companies. And I think it's very useful for you as well to think about the same issues in the context of a small business like Analog Outfitters, for example. In addition to that, of course, these businessmen are going to bring the real world, right? I mean, I'm using real world data as much as I can, but hearing a business owner talking about financial management in his or her own company really adds another layer to this. So I hope you enjoy the interviews. I have made a couple introduction videos that point out to specific questions and issues that you can think about as you watch these interviews. On my end, the news is, see, I'm not very good on football. I would play better with my feet, but you know. On my end, the news is that I got another teaching prize from my executive MBA students, which almost broke my nose. So I got another teaching prize. It's a football that is signed by the students. If you saw Corporate Finance 1, I got a basketball that time. So you know, after I got the prize, I was joking with the students that maybe one day they'll give me a soccer ball. You know, then I can do some better. I'm gonna have more skills with that, given that I'm from Brazil. So you know, I haven't really played football when I was a kid. Back, yeah, I did that a bit better, right? So you know, what about you? Please, you know, we have the discussion board. Feel free to share with us what you expect from the new course, what's going on in your business lives. You know, the discussion board is open for you to contribute, to talk about yourselves as well. So I hope we have a good time exchanging information on the discussion board. There are several quizzes and assignments. This is similar to the previous course, but there is a slight difference here that I want to talk about. Each module is going to have 3 sets of problems. There are practice quizzes that have solutions with feedback, and then there's going to be an end of module quiz that you have to complete in order to pass the course. And then finally, there is an end of module assignment with solution. But here there are a couple changes. First of all, these assignments are required only for honors tracks, so you can pass you can get the Coursera certificate without taking this end of module assignment. Of course, I do recommend that everybody takes it, because I think it's going to add a new layer of learning if you go through these more in-depth assignments after you go through the modules. But if you don't have time, or if you just want to take the module quiz, you have that option as well. So we have this new a track which you call the honors track, which is what you get if you take both the quizzes and you take the assignments. The other change is that there are only 2 assignments, so we're trying to make it easier for students to work on the assignments. So rather than 4 assignments, we have 2 assignments on Corporate Finance 2. Okay? And please try to work on all these examples as carefully as you can, because as you know, practice makes perfect. So the more you practice financial concepts, the more you think about it, the more problems you solve, the better you will get on financial management.
Too often, smart, hardworking, busy people miss out on education because of traditional linear learning. So learn on your terms. With stackable online content from Geese College of Business, you can take self-paced classes, earn transcriptable credit, pause, earn a degree, switch and stack coursework, earn a certificate, or learn however you want. You'll get expert-led education in big or bite-sized increments. Wherever you are in your learning journey, the right time to start at Geese is your time.
So let's start talking about how companies finance investments. Corporate Finance 1 was about spending cash. We talked about topics such as the net present value, the internal rates of return, cost of capital. What we're going to do in this course is we're going to talk about how companies raise cash to finance this spending. Issues like debt financing, equity financing, risk management. So this is going to be the topics we're going to talk about. After all, cash doesn't grow on trees. So it's very important to think about how companies raise the cash that is going to fund their activities. Which investments are we thinking about? We're going to focus mostly on financing new investments such as research and development, R&D, and mergers and acquisitions, M&A. We actually have a couple examples in Module 4 where we're going to do some case studies focused on R&D and M&A. But it's important to notice up front that companies also need to raise capital for other activities. For example, refinancing existing debt. You may want to refinance your debt to lower interest rates, for example. That forces companies to go to capital markets. You might even have to raise capital to make payments to suppliers in some cases. right? Or you might simply want to reoptimize your capital structure. Maybe you think you don't have enough debt, you want to increase your leverage, or you want to reduce your leverage. That, again, is going to force companies to go to capital markets and raise some financing. In this module, Module 1, our initial step is going to be to think about the most basic decision that companies have to make, which is to think about whether companies are going to raise capital by issuing debt, right, to get a loan from a bank, or to issue a bond in markets, in public markets, or whether companies are going to issue equity. Companies are going to raise capital by giving ownership to investors and raise capital from investors. Debt or equity, that's going to be the key topic of Module 1. What we'll learn first is we're going to talk about how debt and equity financing affect the financial statements that we were talking about in Corporate Finance 1, right? So we're going to learn how debt and equity financing change income, cash flow statements, how they change companies' profits. We're going to compute the net present value of both debt and equity issuance. Remember that net present value is the key tool that we have to analyze corporate decisions. We can also use NPV to think about debt and equity. And then we're going to talk about two mistakes that practitioners make, that students make when they are thinking about capital structure. The first one is that dilution is an illusion. There is no such thing as dilution. The number of shares outstanding actually does not matter. We're going to talk about that. And then we're going to talk about why debt issuance is not mechanically going to reduce the cost of capital. Our math, in this case, the math is actually misleading. Usually math is right, but math can also get, mathematics, what I'm talking about, mathematics can also get you to the wrong place. And here you're going to see that doing a simple calculation can actually give you the wrong answer. Then we're going to talk about the key relationship between debt and systematic risk, right? The idea is that debt is going to increase a company's beta, which is behind the logic in a key result in corporate finance, which is the Modigliani and Miller proposition. The Modigliani and Miller proposition is going to show you why issuing debt will not necessarily reduce the cost of capital. Then we're going to move on and talk about research. As I mentioned in the introduction of this course is going to draw a lot on research that we researchers have done about capital structure and other topics in the last few years. The first issue you're going to learn is that equity issuance tends to cause a decrease in stock prices. I'm going to show you some data that shows this. Perhaps because of this effect of equity issuance on stock prices, companies are reluctant to issue equity to finance projects. Then we're going to talk about how debt affects profits, and the key effect, one of the key effects is going to be through taxes. We're going to calculate the effect of leverage on taxes and how leverage affects our ultimate measure of profitability, which is OPAT, operating profit after taxes. And then we're going to talk about other effects that might mitigate this advantage of debt, like personal taxes and costs of financial distress. Right? Costs of financial distress are going to increase with leverage because leverage increases distress risk. And ultimately, what we're going to end up with is a model that we call the trade-off theory of capital structure, which balances the costs and benefits of having higher leverage. And I'm going to show you this model, talk about some data, some recent research about the trade-off model, and then what we're going to do following up, in future modules of this course, is to try to use the trade-off theory to analyze firms' capital structure choices in the real world. So we are starting with this example from Corporate Finance 1. This example was in Module 2 when we talked about financial planning. I think it's simple enough that you can understand this even if you haven't looked at that example, but if you have any questions or if there's anything you want to check, the example is in Module 2 of Corporate Finance 1, okay? And what the example is about, it's a financial planning model for PepsiCo, under the assumption that PepsiCo wants to invest $3.5 billion in 2015, and $6.5 billion in 2016, assuming we are in December 2014. And the question that we asked was whether PepsiCo could finance this expansion without issuing new financing, right? Which is the key topic we're going to talk about in this lesson is how is PepsiCo going to get this new financing. But previously what we've done, so here you have our planning model, right? So you have the capital expenditures, $6.5 billion in 2016, that's the big one. And then what we did in this financial planning model was to think about whether PepsiCo could finance it using only internal capital, right? So can PepsiCo finance this out of its own cash flow and cash balances, right? So the way we did this is we forecasted cash flow from operations using a simple forecasting model, right? We included the capital expenditures under the assumption that there is no new financing in the next few years, so you can see that it's all zeros here in 2015 and 2016. The answer we got is that PepsiCo would have a negative change in cash of about $2.7 billion by 2016. So the answer, right, is that if PepsiCo does not want to reduce its cash holdings, right, assuming that the company has a target amount of cash holdings that it wants to keep, for example, right, then PepsiCo would need to raise new funds, right? Because of this expansion plan, the company would need to raise some money, right, some new funds. Let's say that the amount that PepsiCo will raise is $5 billion. We talked about this in Module 1 as well. It might make sense for a company to raise a little bit more than what it needs, right, so that it has a little bit of a financial cushion. Okay, again, we talked about this in the Module 2 of Corporate Finance 1, right? So this is the new question we're talking about now. We're going to think about this very important choice that companies have to make when deciding how to raise new financing, okay? Which is whether you're going to go to the debt markets or whether you're going to issue equity, right? So that's the major topic of this module, of this session, and we're going to start with this example. The first thing we're going to do is to talk about mechanics, okay? So we have the financial statements ready, we have our financial planning model ready. So what I want to do with you, and I think it's a very useful exercise, is to look at the financial statements and figure out what will happen after PepsiCo issues debt and equity, okay? Let's start with debt. Suppose that PepsiCo issues $5 billion in new debt, okay? And suppose that the interest rate is 4%, right? It doesn't have to be exactly that, but let's say that those are the numbers, right? That means that PepsiCo will pay new interest of $200 million per year, right? So how will that affect the financial statements? You can check. This is the old financial statement. It has the interest expense here, right? That's the item, okay? The new income statement is going to have an increased amount of interest expense, right? So you have $200 million additional interest expense. So I have it here in bold. PepsiCo will have to pay additional interest because you financed the new investment using debt, right? So the interest expense is here. The interest expense is, of course, going to reduce your earnings, right? So you pay interest, your earnings, your net income is going to go down. You can check that, right? In terms of the cash flow statement, right? So your earnings are lower. It's in bold. That's the top of the cash flow statement, right? And then we can just derive the whole capital, the other items of the cash flow statement, right? We're going to lower the cash flow from operations as well, right? We have the capital expenditures, but this is the key thing, right? Because PepsiCo borrowed $5 billion, in the year of 2015. Let's say that PepsiCo did this right at the beginning of 2015. When you get to the balance sheet, at the end of 2015, the balance sheet will, and in the cash flow statement, will also reflect that $5 billion, okay? So PepsiCo has net borrowing, a positive net borrowing of $5 billion, right? Which means that now you're going to have a positive cash flow from financing. And if you recalculate the numbers, what will happen is that now we have a positive change in cash there right at the bottom. There is a positive change in cash of $5.1 billion in 2015. So that will be more than enough to compensate for the negative, right? The number is there, the negative change in cash in 2016. So now PepsiCo definitely has enough funding, right? So that was that. Let's talk about equity, okay? Issuing equity, of course, means going to the market and selling new shares. At least for a public company, right? What the public company would do is to sell new shares of the company in the marketplace. The current stock price of PepsiCo at the time that we did the financial planning model, which not necessarily when you are watching this lecture, but at that time, PepsiCo stock was trading at $94 a share. So what that means is that if PepsiCo wants to get $5 billion in new equity, it will have to issue 53,191,000 shares. Okay, so you can do the math there. Quite straightforward, just dividing 5 billion by $94 a share. Okay, so what changes? Now, there is no new interest expense, right? So the income statement, if you think about it, the income statement is going to be exactly the same. Your operating income, by definition, doesn't depend on financial cash flows, right? Your interest is not changing. That means that your earnings is going to be the same. There is no change in your earnings, right? Cash flow statement. So instead of the borrowing, right, so we had $5 billion for net borrowing here. Now we're going to have $5 billion for the net issuance of stock. That means that PepsiCo is going to the market to raise new equity, right? And that's reflected in the cash flow statement, right? Again, when you get to the bottom of the cash flow statement, what we'll see is that now PepsiCo is going to have a positive change in cash. So definitely the company has enough funding, right, to finance the expansion plan, right? But now think about the following, right? There is a little trick here. We saw the income statement, the cash flow statement. It all seems good, right? Now PepsiCo has a higher change in cash now, so you have enough cash to finance the new investment, right? Your profits haven't changed, right? So you might be wondering at this point, what is the cost of issuing new equity? So I want to give you a little bit of time to think about that. What's the cost of issuing new equity? The cost of issuing new equity is that the number of shares outstanding is going to go up, right? So as we figured out when we're doing the calculation, PepsiCo is going to have to increase the number of shares outstanding by 53.19 million, right? So the company has more shares outstanding. What that means is that the profits that PepsiCo produced, they haven't changed, right? But they're going to have to be divided among a larger number of shares, right? Issuing equity is the same thing as bringing new owners, right, to own the same company, right? So if you bring new owners and the company hasn't changed, then the old owners, the people who already owned PepsiCo shares, are going to own a smaller, a smaller fraction of the pie, right? So the cost of issuing equity is that you're issuing new shares in this case, right? And you might be thinking about dividends. I'm sure that some of you thought, oh, the cost of issuing equity is that we're going to increase, somehow we're going to have to increase dividends, right? That would be the counterpart of debt. You issue debt, you pay interest. You issue equity, you change dividends, right? If you look at our financial planning model, we actually assumed that total dividends were constant. Dividends were not changing at all, right? And if you think about this, it actually makes sense. Paying dividends is a choice of the company. It's another choice, right? In principle, it's unrelated to the choice of issuing equity, right? And if you think about the fact that, PepsiCo wants to bring new money into the company, maybe it doesn't make sense for PepsiCo to increase dividends at the same time, right? So if PepsiCo had increased dividends, then this would consume part of the new funds that PepsiCo brought in from the equity market. So maybe it wouldn't make sense for PepsiCo to increase dividends at that point. you know, this is, in fact, it's a topic of its own, right? In Module 2 of Corporate Finance 2, right, we're going to spend a lot of time talking about payout policy, right? So it's exactly the decision of how much dividends to pay, and then we're going to have more to say about that. Okay, so we have gone through the financial statements, right? And you learned the mechanics of debt and equity, right? So how would the debt issuance change the financial statement? How would an equity issuance change the financial statements? What's the benefit? What's the cost of issuing debt and equity, right? But we still have to make that decision. Is the company, right, which choice is PepsiCo going to make? Is PepsiCo going to issue debt, or is PepsiCo going to issue equity, right? And in Corporate Finance 1, we actually learned a tool that is the right tool to guide managers when managers are making financial decisions like that, right? Which is the net present value, right? So essentially, what companies would do is to take investments that have positive net present value, right? If you apply the net present value idea to the financing decision we are talking about now, the answer would be that the company is going to issue debt when the NPV of issuing debt is greater than the NPV of issuing equity, right? Let's try to apply that idea and see how far we get. We're not going to get the answer from here, I'm just telling you up front, but I think it's going to be useful, very important for us to think about this calculation, okay? Let's start with that, right? We already figured out that there is a benefit and a cost, right? The cost, of course, is that you're going to pay interest. The interest is $200 million per year, right? The benefit is that you're going to get a $5 billion inflow of capital, right? So the 4% interest payment, right, is also the yield to maturity on this bond, right? That's another concept we talked about in Corporate Finance 1 that might be useful to recap here, right? It's also the yield to maturity, or the expected return on this bond, right? So what this means is that it would be very reasonable, it's actually theoretically correct, to discount, you know, if we're figuring out the NPV of the debt issuance, the correct discount rate to use would also be 4%, right? We would be discounting the interest payments exactly at the 4% rate, right? So the NPV would be a positive 5 there at the beginning, right? You have the money coming in the company, and then in the future years, the interest payments go out, right? Minus 0.2 every year. We discount it for 5 years. You know, if you do the math, the answer you'll get is that the NPV is going to be 0, right? Does that make sense to you or not? Let's talk about it, okay? Think about what we've done, right? The idea here is that if the debt is fairly priced, right? So meaning that if the interest rate is the same as the discount rate, right? So if PepsiCo is paying interest exactly at the required rate of return, right? Then what's going to happen, this is what the math is reflecting, what's going to happen is that the cost of issuing new debt, which is this $200 million annual interest, is going to exactly compensate for the benefits, right? So the benefits are exactly the same as the present value of the costs, right? That's why we have a 0 NPV, right? And of course, what's going on here is that we are relying on the assumption of efficient markets, which again is something we talked about a lot in Corporate Finance 1, right? So we are relying on the assumption that the debt is going to be fairly priced by the marketplace, right? That PepsiCo is issuing debt exactly at the required rate of return, right? If the debt for some reason is not fairly priced, then obviously the NPV would not be 0. So if PepsiCo can issue debt at a cheaper rate, for example, right, then it might be, you know, it might be positive NPV to issue debt. But if you think about it, you know, why would that be the case, right? You know, it's a debt issuance. It should be correctly priced by the market. The 0 NPV is actually a very reasonable answer to this problem, Okay? What about equity, right? We covered that. What about equity? Now we have $5 billion of cash coming in, and we have the new shares being issued, right? I put a couple more numbers there that we're going to need. The first is the current market value of equity, right? And the second one is the number of shares outstanding. We're going to need those numbers, right? And the question is, what is the NPV of equity issuance? This is a little bit trickier, right? Because as we already figured out, we don't really have the counterpart of interest payments. The cost of issuing equity is that the number of shares is going up, right? So here what we're going to use is we're going to think in terms of stock prices, right? Remember that maximizing the net present value is exactly the same thing as maximizing the stock price, right? This is another idea we covered in Corporate Finance 1, the equivalence between net present value and stock price, right? So NPV and stock price are the same thing, and we can actually think in terms of stock prices here. Let me show you, right? We have the old stock price, which I'm expressing as the market capitalization divided by the number of shares. $94 is 138 billion divided by 1.468 billion shares, right? And then what's going to happen? If PepsiCo issues new shares, right, PepsiCo is going to get $5 billion in cash, right? The cash is going to come in, right? Who owns the cash? The cash is going to be owned by the shareholders, right? So the cash that PepsiCo gets is going to increase the company's market capitalization, right? And then what I've done, so that's the numerator. What I've done in the denominator, you can see there, is to add the number of new shares, right? So PepsiCo receives cash, but the counterpart is that there are new shares being issued, right? If you do the math, what you'll get is that the stock price is $94 a share, okay? So the stock price hasn't changed. Again, the answer then is, since the stock price hasn't changed, what this means is that the NPV of the equity issuance, again, is 0. And it's exactly the same idea, right, that made the NPV of debt equal to 0. The idea is that the new cash that comes into the company exactly compensates for the issuance of new shares. So the stock price remains constant. And again, this notion relies on the assumption of efficient markets, right? Or at least on the assumption that the equity is fairly priced. Of course, if PepsiCo manages to sell shares at a higher price than what the shares should be worth, of course, that's going to be a good deal, right? If you're selling a product, you want to sell at a high price, right? If you sell the product at a low price, you can think of the equity as a product, then PepsiCo is going to make money. But if you sell just at the right price, the NPV is 0. You don't lose money, you don't make money. At this point, you may be wondering, right? So PepsiCo is raising cash to finance this new investment. That was our original assumption, and you might be now complaining in your mind, or your mind might be complaining at you that we're not talking about the NPV of the new investment at all, right? We're just talking about interest payments, shares, cash coming in. Where is the net present value of the new investment? That, of course, has to matter, right? So think about that question for a while. The answer is that the NPV of the new investment is not incremental, right? Again, that's another concept we talked about in Corporate Finance 1, is the idea that cash flows that matter for the NPV are the incremental cash flows. The only cash flow that matters is a cash flow that changes, right, what happens in the company. So when you think about debt and equity, right, the NPV of debt was 0, right, when you think about interest payment and cash coming in, and then there is the NPV of investment, right? There's, the company is going to invest this money and hopefully make a positive NPV. What is PepsiCo going to do with equity? The same thing, right? So if you issue equity, you're going to take the $5 billion and invest in the company. So the NPV of investment is the same, irrespective of whether you're issuing debt or equity, right? So it's not incremental. The NPV of the investment will not affect the decision of whether PepsiCo is going to issue debt or whether PepsiCo is going to issue equity. In fact, it's safe for us to completely ignore what companies are going to do with the money. We just have to think about the immediate consequences of issuing new securities. That's a very useful idea that we're going to follow up later. We have made some progress, right? Now we know how debt and equity issuance affect the financial statement. We covered this zero NPV idea, right? But we haven't answered our question yet, right? Should PepsiCo issue debt or should PepsiCo issue equity? So far, if both have zero NPV, then maybe it doesn't matter, right? We are going to have more to say about that, of course. But before we do that, I want to talk about two misconceptions. So there are two ways that people think about the debt and equity decision that actually turn out to be incorrect. And it's as important to learn what's wrong, right, than to learn what is right. So the goal of this lecture here is to tell you about these two misconceptions that I think are very important for you to understand. The first one is this notion of dilution. Okay, it's a very common argument. We see that all the time. Okay, and it always drives me mad because it's wrong. Okay, it's the idea that issuing new equity reduces the stock price because the number of shares outstanding go up, right? So the dilution story goes as follows, right? You know, that's why I put it in quotation marks. It's not what I'm saying. It's what I hear other people say. Is that issuing new equity reduces the stock price because of dilution. The number of shares outstanding goes up, and thus the stock price must come down. Right? Why is this wrong? You know, we've already done the math to show why this is wrong. Yes, it's true. Issuing equity increases the number of shares, but the company is receiving cash in exchange for that. Right? There is cash coming in. The cash is going to increase the market value of equity. Right? The stock price is a ratio of the market value of equity and the number of shares outstanding. The numerator goes up, the denominator goes up. You know. In fact, in our example, nothing happened. The stock price remained constant, right? There is, in fact, no dilution if the equity is sold at a fair price. That's what we showed in our numerical example. The market value of equity exactly compensates for the increase in the number of shares outstanding, so the stock price remains constant. The stock price does not go down, okay? So I like to really stress this point because it's something that I want all my students to remember from this capital structure class, right? Which is the notion that dilution is an illusion, okay? Dilution is an illusion, okay? With the proper English, okay? So dilution is an illusion. Repeat that with me, repeat for you until you know, remember that, okay? That's a very important thing to remember because this argument is so common and it's so wrong, okay? The second argument is a little bit more complicated. This is going to take us a little bit more effort to understand. You know, the reason why dilution is wrong, I think it's pretty straightforward, but this one is a bit more complex, okay? And it has to do with the cost of capital. Again, drawing from Corporate Finance 1, one thing we did in Corporate Finance 1 was to compute the weighted average cost of capital for PepsiCo. So the weighted average cost of capital is a weighted average of the cost of debt, the required return on debt, and the required return on equity. The numbers are here. The required return on debt was estimated at 4%, right, 4.2%. And then you multiply by 1 minus the tax rate. And you multiply all of that by the 19% is the existing leverage ratio. So it's the amount of debt that PepsiCo has divided by the value of the company. And then the other component of the weighted average cost of capital is the required return on equity. What is the required return that shareholders require when they invest in PepsiCo's equity? Okay? And that turned out to be 5.5%. We estimated that using real data. So I'm not making up these numbers, right? Again, as I said before, by the time you're watching this lecture, the numbers might have changed, but those were real numbers that we estimated using real-world data. And the problem is that these numbers lead people to make the following argument, okay? So the after-tax, right, when you look at this, right, the required return on that is 4.2%, but there is the tax benefit of that, so you can think about the after-tax required return on that, which is, the 4% minus 1 minus 25. That is 3%, 3.2%, right? So debt holders require approximately 3% to invest in PepsiCo, while equity holders require 5.5%, right? So this might seem to suggest that a clever CFO, a smart chief financial officer should never issue equity, right? That is cheaper. That seems cheaper, okay? In fact, I want you to do the math on your own for you to really understand what I'm talking about here. This math is not going to give you the right answer, okay? But I think it will help you think about this problem. Try to figure out what happens to PepsiCo's weighted average cost of capital if you increase the leverage ratio to 40%. So it was 19, we're going to double the leverage ratio to 40%, okay? The answer is here, right? So we have the cost of debt, the required return on debt. It's now multiplying a leverage ratio of 40%, right? And then we have the required return on equity, which is 5.5. It's multiplying a leverage, 1 minus the leverage ratio, it's 60%, right? So you move the company from 2080 to 4060, right? If you do the math, which I hope you are able to do, okay, or if not, it's here, right? It seems that the weighted average cost of capital for PepsiCo is going down by 0.5%, right? Seems right. The problem is this calculation is wrong, okay? And I'm not surprised that if you're confused at this point. As I said, this is a slightly more complicated argument, okay? Here's the reason. The reason is that debt is going to increase risk, okay? So notice that to do this calculation, right, you made the implicit assumption that the required return on debt and the required return on equity were going to stay the same, 4.2, 5.5%, okay? But think about the following. PepsiCo is doubling its leverage ratio, right? It's issuing a lot more debt. Is the company really going to be able to borrow at the same rate? Maybe not, right? Is the required return on equity still 5.5%, or are the shareholders going to require a higher return because the company has more leverage? Maybe they do, okay? So what we're going to learn next is why this calculation is wrong, okay? And we're going to see what is actually the right calculation, how the cost of capital for PepsiCo should change when leverage increases. This is the calculation that we've just done, trying to figure out what happens to the cost of capital of PepsiCo when leverage changes, right? So it appears that the cost of capital is going down to 4.5%, but what we already learned is that this calculation is wrong, okay? One way to think about it is that this is a mechanical effect, right? It's a simple algebraic equation, right, that couldn't possibly be right. It's too mechanical to be describing the real world, right? And in fact, it is, right? So you can think of this mechanical effect as also an illusion. Just like dilution, this mechanical effect of debt in the cost of capital is also an illusion that you should avoid, okay? In fact, this problem that we are talking about, this is really cool because that is the motivation for research that won a Nobel Prize, okay? Back in the 60s, there were two people called Modigliani and Miller who are the winners of the first Nobel Prize that was given to researchers in corporate finance. There have been others since then, but Modigliani and Miller won the first Nobel Prize that is attributed to corporate finance research. So, we really love these guys, okay? And the motivation for their research is that they got really mad with this mistake that people were making. They got tired of hearing the argument that because debt is cheaper than equity, right, then companies should issue debt to reduce the cost of capital. Okay? What they showed in their research is why this mechanical effect is an illusion. And the reason, right, the reason is that the increase in leverage, if PepsiCo issues more debt, what will happen is that the cost of debt and the cost of equity are going to go up. The company becomes riskier. So the right equation for the WACC actually does not have a clear answer. Okay? The right equation is not what we had before. The right equation is here. Okay? We know that leverage is going to 40% and equity is going, you know, and 1 minus the leverage ratio is going to 60%. You know, the company can try to control that. But what the company cannot control is what will happen to the required return on debt and what will happen to the required return on equity. Okay? In fact, both will go up in the end, right? Because the cost of debt and the cost of equity are going up, you don't know what happens to the cost of capital. Okay? The reason why risk is going up is an idea that we talked about in Corporate Finance 1, right? Is the idea of systematic risk. Okay? What happens is that this increase in debt is going to increase the company's exposure to systematic risk. So a high debt company is also going to be a high beta company. Okay? Debt increases beta. In order for us to see why, what I want to do is to move away from PepsiCo a bit. It would be a bit difficult to do it using PepsiCo. It would probably involve too many numbers that you don't want to look at. I'm gonna use a simple example here, okay? Where we have a boom and a downturn, right? So here the boom happens with probability 75%, 0.75. The downturn happens with probability 0.25. Okay, and what we have here is a cash flow to the company of 50 in the boom and 30 in the downturn, right? So the company makes a profit of 50 in the boom and a lower profit of 30 in the downturn, right? If you figure out the expected value of equity today would be 45, right? It's just a weighted average. We've done calculations like that in Corporate Finance 1 as well, right? To calculate the expected value, what you do is you take the average between the boom and the downturn, right? Another way to express this data is that the current value of the company is 45, right? If times are good, right? If you are in a boom, your value is going to go up by 11%. Okay, so 50 is 11% higher than 45. If you are in a downturn, your value is 30 instead of 45. It went down from 45 to 30, so that is a loss of minus 33%. Okay, so gains, losses, right? You have the percentages there. Now let's think about what happens if there is a debt payment. So suppose we have the same company, but the company now promised to pay the debt payment of $15 million, let's say. The unit here doesn't matter, right? What will happen to the cash flows? So now you have to make the debt payment, so your cash flow is not 50, it's 50 minus 15, goes down to 35. Again, in the bad state, right, in the downturn, your cash flow goes from 30 to 15, right? If you redo the math, what you'll see is that the debt payment is increasing the percentage gain, right? So if you are a levered company and you hit a boom, right, you're going to have a higher percentage gain in your value. But if you hit a downturn, the percentage loss is also going to increase. It's now minus 50% instead of minus 33%. Okay? So just putting all these numbers together, right? If you have no debt, zero debt, right? Those cash flows go to the equity holders, right? They make a gain of 11%, a loss of minus 33, right? If you have leverage, what happens is that the percentage gain increases, but the percentage loss will also increase, okay? So that is increasing the fluctuations in the value of the company, right? And if these are aggregate states, right? So if this is really a boom in the whole economy or a downturn in the whole economy, what this means is that debt is going to increase beta. Okay? Bottom line is that an increase in leverage is going to increase systematic risk, right? There are greater losses for shareholders in a downturn. A company that is highly levered is going to amplify losses for shareholders if times turn bad. So that increases systematic risk. Because systematic risk goes up, shareholders are going to demand a higher return to hold equity in that company, right? So now we can think again of a low debt, high debt situation. We're back to our PepsiCo example, right? So just to repeat the point we've made, but now I think with more confidence we understand better what's going on, right? Because debt increases systematic risk, the cost of equity will go up, and the cost of debt, the required return on debt, will also go up. The end effect on the cost of capital is not clear. Okay? In fact, what Modigliani and Miller showed, which it might seem like a surprising result, but it's true, it turns out to be theoretically correct at least, is that under some conditions, the cost of capital does not depend on leverage. Okay? So under some conditions, which we're gonna talk about, the right equation is actually here. You don't know exactly what will happen to the cost or to the required return on debt and to the required return on equity, but what we do know is that the cost of capital for PepsiCo is going to remain the same. Okay? The cost of capital stays at 5% no matter what PepsiCo does to its leverage. That is M&M's cost of capital equation. Okay? So what is the intuition? What's the condition under which this holds? It is exactly the same example we started with, right? Remember, we started this lecture trying to figure out what is the NPV, what's the net present value of debt and equity issuance, right? And it seems that a zero NPV would be reasonable, right? The benefits and the costs compensate for each other, right? This is actually the same condition here. The condition is that debt and equity have to be fairly priced. If debt and equity are fairly priced, then issuing debt or issuing equity generates a zero NPV. If the NPV is zero, the cost of capital shouldn't change either. Okay? And the M&M result also relies on the absence of other frictions, such as the ability to deduct interest payment from taxable income, which is something we're going to talk about soon. Okay? Of course, these conditions do not always hold, right? However, M&M is an essential benchmark in corporate finance, right? I mean, we wouldn't have given a Nobel Prize to a result that doesn't make sense. This is a very important benchmark. Okay, and let me tell you how I like to think about M&M. The way I like to think about M&M is that M&M help us avoid mechanical arguments, right? Such as the argument that because debt is cheaper, issuing debt is going to reduce the cost of capital. This is a mechanical effect. What M&M really says is that there is no mechanical effect of leverage on the cost of capital. So if you want to figure out why debt or equity matter for a company, we're going to have to do extra work. It's not as easy as grabbing some chocolate from that bag of M&Ms, right? So these are M&Ms. That's why I used it here, right? So we're going to have to do extra work to figure out why debt and equity might matter for the company. We have to understand better what is the difference between debt and equity. Why would companies prefer debt to equity or equity to debt, right? That's what we're talking about. We've seen the M&M proposition. The first thing I want to do in this session now is to talk about research. Okay, so that's the first time the mad researcher comes in our course. I told you he was going to show up a lot. Okay, that's the first time we're going to talk about research on capital structure. That's actually going to be our starting point to try to differentiate debt from equity. Okay, and if you think about this, right, the idea we have so far is that issuing debt or equity should give a zero NPV, right? So if debt and equity are fairly priced, you should have a 0 NPV, right? But we learned in Corporate Finance 1 that NPV and stock price are equivalent concepts, right? So what researchers have done is they have tried to follow up on this idea, right? Can we try to measure how stock prices react, right? So we can observe data, we can get data from the real world, right? And measure how stock prices change when companies announce large issuances of debt and equity, okay? And if M&M were right, if the M&M theorem of the M&M result is sufficient to describe the real world, what would happen is that we would observe a 0 reaction, right? Stock prices should not change when companies issue debt or when companies issue equity. What happens? So what people have done is conducted event studies. We call this an event study, which is a type of research where we examine the market's reaction to new information. In these event studies, the new information is about capital structure, right? So the company is issuing equity, the company is issuing debt. The research, there was a lot of research on this topic earlier on in the 1980s when we first could get data on announcements, and we had good data on stock prices. So many researchers have studied this topic, and this paper by Ekbo and Masoulis that I'm citing here, what it does, it summarizes the evidence on event studies of capital structure. Okay? And this is 95, it's not the current result, but the results continue to hold. If you redo this study today, I think you would find exactly the same result, right? What are the results? Companies that issue bonds, right? If you measure the stock price reaction to bond issuance, what happens is that in fact, you observe a small change. Okay, there is no reaction to issuance of bonds. So there is a 0 change, right? However, when companies issue equity, their stock prices tend to decline. And it's a significant decline. It's 1.5% to 3% on average. Okay, so issuing equity seems to be negative NPV, right? When companies issue equity, their stock price goes down. Okay? So now we can also think about the other side, right? So we know that stock prices decline when firms issue equity. We can also try to measure what kind of financing an average company uses in the real world, right? Instead of doing examples, we can look at the data and try to measure if companies use equity, outside equity, or bonds, or bank, some other type of debt financing to finance their investment, right? The event study I just showed you suggests that issuing equity is negative NPV, right? So what would you predict? Probably what I would predict is that companies try to companies try to avoid issuing equity, right? Because issuing equity reduces the stock price. That is exactly what we see in the data. Let me explain you what this is. So this is data I got from the Federal Reserve system for U.S. companies. Okay, and this is very recent, so I got this in 2016. Like I said, the evidence that Ekbo and Masoulis were describing really hasn't changed. Okay, so what these bars measure is the source of financing for companies' expenditures. Okay, the blue bar measures internal funds. So those are cases where that's the average for companies that finance their investments using their own cash flows. Okay, so you can see that the blue bar is by far the largest. Okay, and then the red bar measures the fraction of investments that is financed with debt issuance. And what you can see here is that this red bar is also significant. I'm not sure you can see the numbers there, but the average red bar is about 20%. So meaning that companies finance on average 20% of their investments using new debt financing. And finally, this green bar is equity. And the striking feature here is that the equity, these green bars are actually negative, right? What does that mean? it means that companies are on average not issuing new equity to finance investments, right? In fact, what the average company does is to repurchase shares. So instead of issuing new equity, companies are buying back shares and reducing the amount of external equity that they have. At least that's what the average company does. Okay? So this is consistent with the idea that issuing equity reduces stock prices. Right? We actually call this in corporate finance the pecking order of financing. What that graph seems to suggest is that companies first use internal funds to finance their investments, then they use debt, and then they use equity. Right? And the aggregate net equity issuance has in fact been negative. You know, in almost every year, if you look at that graph, or if you look at the Federal Reserve data yourself, it's publicly available if you want to check my work. Okay? So the message is that companies are in fact reluctant to issue equity in practice. Okay? There are some exceptions, and one of them is in mergers and acquisitions. That's in the final module of this class, Corporate Finance 2, we're going to talk about the financing of M&A, and one of the key points is going to be that when companies finance large M&A deals, they are in fact issuing significant amount of new equity. That's one case when companies are going to issue a lot of new equity. There are other cases as well. For example, venture capital industry, right, is based on equity. So when a venture capitalist provides financing to a new venture, it's typically not going to be debt financing. It's closer to equity, right? And of course, the other exception is when companies go to the equity market, to the public equity market for the first time. We call that an IPO, okay? So in that case, companies are definitely issuing new equity. But what that graph shows is that, you know, these three exceptions here, they are important, but they are not enough to overturn the general pattern that companies prefer to issue debt rather than equity. Okay? The bottom line is that debt seems to be the most important source of external funds for most companies. Okay? Which is a very important message to take away from the data. What we'll do in the next lectures is we're going to try to dig deeper and try to understand debt financing in detail. First, we're going to try to understand, you know, why is it that companies might prefer debt to equity, right? We're going to try to see how debt affects profits and value, okay? And then we're going to go in the next module, we're going to go very deeply into the details about debt financing. We're going to talk about different aspects of debt financing in the real world, such as the pricing, collateral, ratings, and etc. So we're going to try to really dig deep and understand how debt financing works in the real world. So the first thing we're going to do is to try to understand the relationship between debt, profits, and value. That's going to take quite a bit of work for us to go through all the arguments that we need to understand. Let's go back. Our starting point is going to be the PepsiCo example again. We're going to go back to that example we were talking about, right, where PepsiCo was trying to decide whether to issue debt or equity. What we just learned is that most likely PepsiCo will issue debt instead of equity. That's what average companies do in the real world, right? Let's try to understand how this debt issuance will impact the company's profitability. To do that, we're going to go back to financial statements. Remember that we have the before and after, right? That's before meaning before the debt issuance, after meaning after the debt issuance, right? The difference here is that your interest payment is going up by $200 million. Okay? And, right, if you look at the earnings, we talked about this already, but here I want to make it very clear, right? The interest payment is going to reduce the company's earnings, right? Very simple here, accounting, you know, mechanical, there is nothing very deep going on. Interest goes up, earnings go down. So here's a question for you, and I want you to think about this right now at the beginning of this session. Okay, is PepsiCo more or less profitable after the debt issuance? To answer that, we're going to go back to Corporate Finance 1 again. Okay, remember that our definition of profits, the definition of profits that I like to use is what I call OPAT, operating profit after taxes. Okay? Operating profit after taxes is defined as your EBIT, your operating income, minus the taxes that you pay to the government. And what is very easy to show is that OPAT is going to go up with leverage. Okay? So PepsiCo is actually going to become more profitable after the debt issuance. So if you got that answer right, if you remember the definition of OPAT, I'm really happy. Okay? Or if you haven't taken Corporate Finance 1, maybe it would be difficult for you to figure that out. But in any case, let me show you what's going on here. Okay? So here at the bottom, what I've done is I calculated the OPAT for PepsiCo. So for example, in December 2015, right, you had operating income of $9.7 billion, right? You're paying $2.1 billion in taxes, so your OPAT is 7.5. 1.5, right? It's going to be a small change, so we have to talk about all the numbers, right? Your interest payment went up after the debt issuance. The effect of that is that the taxes went down, right? But your operating income is still the same. Your business hasn't changed, right? So if you do the calculation at the bottom, what you'll see is that your OPAT is going to increase, okay? The operating profit after taxes is going up, right? What that means is that PepsiCo is in fact becoming more profitable after the debt issuance, right? And this picture kind of shows what's going on. What is happening here is that by issuing debt, companies take money away from the government, right? The main effect is that debt is lowering the company's taxable income. So you're taking money away from the government. Who gets the money? The shareholders, right? So that it's a positive effect of that, the fact that profits go up. And you might think, why are we going to stop at $5 billion then, right? If we issue $20 billion of new debt, now it's going to become, it's going to be easier to see the effect, right? Your interest payment is going to go up to almost $2 billion a year, right? Meaning that you're going to get a big tax deduction. Your OPAT is going to go up even higher, right? In fact, it's very easy to show that if a company is profitable, your operating profit after taxes is going to increase with leverage. Okay? So this picture, I'm going to start using these pictures in this lecture. So essentially what I have here is leverage on the x-axis, and on the y-axis we're going to have measures of profit and value. So far what we figured out is that OPAT is going to increase with leverage. So the higher the leverage, the more profitable companies are going to become. Okay? So let's bring back the researcher, right? Let's talk about the real world, right? And the evidence from the field, right? What would this model predict so far, right? So if leverage increases profit, what would be your prediction? Your prediction is that leverage ratios should be very high, right? If companies are profitable, then they should be almost entirely financed with debt. Leverage ratios should go up. But the problem is when you look at the data, this is not true. Okay? The average leverage ratio for companies in the US, it's similar in other countries as well, is approximately 30%. Okay? And an interesting fact is that this average leverage ratio is even lower for profitable firms. So what this means is that is that maybe we're missing something, right? There is something else going on. It's not just this increase in profitability, right? The other prediction is that companies should always finance investments with the debt, and we saw the evidence that's not true, right? They do prefer debt than outside equity, but the first thing that companies do is to use their own internal funds, right? That's the pecking order. First internal funds, then debt, and then outside equity, right? So there's something missing here from this model, right? The conclusion is that there must be a hidden cost of issuing debt. What we'll try to do next is to understand where this hidden cost is. In essence, we're going to try to understand other consequences of issuing debt for the company's financial statement and ultimately for profits and value. the first effect we're going to talk about is personal taxes. Okay, we talked about the positive effect of that on profits. That comes from corporate taxes, right? But issuing debt is also going to change the taxes that investors pay at the investor level, right? So to get a full picture of how that affects profits, we have to think both about corporate taxes but also personal taxes. Let me show you this. We have to do some calculations here, but they are quite straightforward, right? So what we're going to do is we're going to follow what happens to OPAT, right? Before issuing debt, PepsiCo had an OPAT of $7.5 billion in 2015. And by examining the financial statements, we can also figure out where this money went, right? So $1.156 billion were used to pay interest. PepsiCo paid $3.617 billion in dividends. And then the rest of the cash went to retained earnings, okay? Right? So now what we need to think about is personal taxes. You know, the payments that PepsiCo is making to investors are going to generate taxes at the investor level. The interest payment that goes to debt holders is going to be taxable. The dividend payment to equity holders is also going to be taxable. Okay? So debt investors receive, you know, that $1.156 billion in interest payment, and the specific tax that they pay is going to depend on many factors. One important factor is what is the marginal income tax rate, right? Interest payments are typically taxed at the personal income tax rate. It's just treated as regular income. In the US, the marginal income tax rate can be as high as 39.6%. Using the current tax code, you know, the tax code might change. So, you know, by the time you're watching this, maybe we have a different tax rate. There is an election coming on in the US, actually, you know, when I'm recording this, so who knows. But right now it's 39.6%, okay? What this means is that investors are going, if they pay 39.6, we're going to talk about that. If they pay that, you know, high tax rate, what they would receive is $698 million. The rest of the money goes to the government, right? So remember, you know, the reason why that increased profits is because we're taking money away from the government, but, you know, when the company pays interest to investors, then the government gets some money back. We have to take that into account. What about equity investors? They received $3.617 billion in dividends. Again, talking about the US, the highest dividend tax rate in the US is 20% for people at high income levels. If we assume that dividends are taxed at that rate, then equity investors would receive a lower amount, right? Instead of 3.167, equity investors would receive $2.894 billion. What about retained earnings? With retained earnings, there is no immediate tax, right? PepsiCo retains the earnings. The earnings are going to be taxed when they are distributed to equity investors, either through dividends, future dividends, or maybe through future share repurchases. So for now, let's just say that PepsiCo gets a 0% tax, right? So you retain the earnings, you don't pay any tax for now. So what happens? These payoffs after personal tax are then different, right? So if we take personal taxes into account, debt investors are getting 698. Equity investors are getting 2.894. We have the retained earnings, so we can sum everything, right? So out of the OPAT of $7.5 billion, we generated an after-tax income to investors of $6.334 billion. Okay? So that is the situation before PepsiCo issues any new debt. That was the before situation. Now, what I want us to do is to consider what happens to the after-tax payoff after the debt issuance. And let me use a bigger amount here, just for the sake of the example. Let's use a $20 billion the debt issuance instead of a $5 billion debt issuance that we started with, just for us to see the numbers more easily. What's going to happen to the after-tax payoff? So try to do the calculation yourself. I started it here for you with the interest payments, the new interest payment and then the new retained earnings that PepsiCo will make after the new debt issuance. So try to figure out what happens to the after-tax payoff. Here's the answer. Using the same tax rates, right? The government will get a chunk of it, right? If you did the math correctly, you would get that your OPAT out of the OPAT, right, which now is higher, right, because of corporate taxes, investors would end up getting $6.218 billion, right? So let's put the numbers together on one slide for us to see. Before the $20 billion debt issuance, PepsiCo's OPAT was 7.5, investors were getting 6.3, the government was getting 1.2, right? Just rounding the numbers here to make it easier for me to talk. After the $20 billion debt issuance, the OPAT went up to 7.7, but the after-tax income that goes to investors actually went down to 6.2, right? Oh, your OPAT increased, but the after-tax payoff decreased with the debt issuance in this case, right? The government, right? The other player here is the government. The government ended up getting more taxes, right? So you took away, you thought you were taking away money from the government, but in the end of the day, the government bites back, right? Because that increases personal taxes. I exaggerated this example a little bit. This is, of course, not a general example, right? There were many problems with the assumptions. One of them is that investors are probably not taxed at the highest marginal rate. Many investors hold bonds in tax-deferred funds, right? So, for example, if you have retirement money that you're saving for your retirement, this money is invested in a fund that will not actually pay tax until you withdraw the money after your retirement, right? The effective tax rate on retained earnings, on the other hand, is not really zero, as we assumed, right? Shareholders will eventually have to sell. For shareholders to get cash back, either the company has to do a share repurchase, right? Or shareholders have to eventually sell the equity, or the company has to pay dividends. So at some point, shareholders are going to pay tax. So the tax, the zero tax rate is also an exaggeration. Figuring this out in the data is actually very complex, okay? Fortunately, we don't have to do it. There is research. Here comes the mad researcher again. There is research we can draw upon. In fact, in this area of corporate taxation, there is one particular researcher who is considered the world's expert on. I wish it was me, but it isn't. Okay, his name is John Graham. He's at Duke University, and he's done a lot of research trying to estimate what happens to companies' profits, what happens to companies' value, taking into account both the corporate tax benefit and the personal tax disadvantage of that. I'm just going to give you the bottom line. Remember our picture, right? We have leverage on the x-axis, profits on the y-axis. We have our OPAT, right? The OPAT is going up. That's the corporate tax effect. What's going to happen is, after you incorporate personal taxes, this benefit becomes lower. So profits do not increase as much with leverage as we would have thought. But if you look at this picture, what it shows is that there still is a positive slope. Okay? What John Graham shows is that even after taking personal taxes, in a reasonable way, trying to estimate what actual tax rates investors are paying, what we find is that profits still increase with leverage. So by increasing leverage, companies are on net taking money away from the government and giving more money to debt holders and shareholders. This picture is the summary of what we have so far. We have profits, leverage. What we've shown is that profits increase with leverage for profitable firms, right? So as long as a firm is profitable, as long as a firm can take the tax benefit from the government, right, then what happens is that profits will go up even after taking personal taxes into account. So your OPAT goes up, your after-tax payoff goes up less, right? But it tends to also go up with leverage. So tax benefits is a big reason why companies might prefer leverage. So let's think about the following. If that's the case, why not, increase profits, increasing debt even further? For example, we might think of a slightly crazy situation where PepsiCo issues so much debt that you have, a $9.6 billion interest expense, right? In that case, you're going to pay zero taxes, right? Your taxable income goes to zero. You pay zero taxes. Your OPAT is going to be, the same as operating income, right? Clearly not, your intuition is telling you that there's something is wrong, right? Of course it is. We're going to talk about it. What happens is that there is a cash shortage, right? If a company is in a situation like that, yes, you're not paying taxes, but you're not going to have any profits to pay dividends, for example. There is no cash to pay dividends. There's no cash to make investments, R&D, any other expenses, right? A company in this situation where your interest payment is as high as your operating income is a company that we call financially distressed. What we say in corporate finance is that if a company is in that situation, the company is financially distressed. Okay? In practice, financial distress is not going to arise from voluntary increases in debt. In our example, the example was a little bit crazy because of that, right? PepsiCo would probably never be able to issue that much debt anyway. What tends to happen in practice is that companies become financially distressed because of poor performance, right? Maybe they expected to be able to pay interest at the time that they issued debt, but then there was a big crisis, either with their products in the marketplace or maybe an economic crisis. Profits turned out to be lower than expected. Companies become financially distressed. This is an example of this situation. So suppose that PepsiCo is distressed because the operating income went down to about $2 billion, right? So now PepsiCo has EBIT of $1.9 billion and interest expense that is higher than your EBIT, right? So yes, you're going to pay zero taxes, but that might create problems. Let's think about, I want to give you some time to think about this. How should PepsiCo respond to this situation? What is the company likely to do if it encounters a situation like that? The answer is that something is going to have to happen, right? If PepsiCo has cash, maybe the company has saved enough cash in the balance sheet that they can use that cash now to keep financing investments, for example, right? If they have it, maybe they don't, right? Or PepsiCo could try to refinance its debt, right? The problem is that interest payments are very high. PepsiCo can try to go to the bank or to go to bond markets and try to refinance debt. As we talked about in Corporate Finance 1, refinancing a liability means that you have to issue a new liability to buy back the old one, right? Or PepsiCo could try to issue new equity, right? If you can't raise new funds, then what PepsiCo is going to have to do is to cut dividends or cut investments, right? So either way, you're going to have to manage this shortage of cash. The important notion is that most of these options, with perhaps the exception of standing cash, most of these options are likely to generate significant value losses for the company, right? If PepsiCo goes to the debt markets to refinance debt, what will probably happen is that you're going to have to refinance at very high interest rates. If you're financially distressed, a bank is not going to give you new financing unless you pay a very high interest rate, right? We learned already that if PepsiCo issues equity, right, the stock price is likely to go down, right? In fact, what people have shown is that this stock price effect is even larger for firms that are financially distressed, right? If a firm is close to bankruptcy, is financially distressed, you issue new equity, you're going to have to pay to do that. What happens is that the stock price goes down a lot, right? Cutting dividends is also going to reduce the stock price. That's something we're going to learn in Module 2, that dividend cuts have a similar effect as equity issuance in the other way. Okay? And finally, we learned in Corporate Finance 1 that cutting investments, if they are positive NPV, cutting positive NPV investments are also going to reduce the stock price. Right? The bottom line is that any of these options, right, any of these reactions that PepsiCo might have are going to cause value losses, or most of them. Like I said, if the company has enough cash, it might be able to use the cash to mitigate the cost of financial distress. But in the other cases, it's very likely that there are going to be value losses, right? These value losses that are caused by high debt is what we call a cost of financial distress. Okay? In corporate finance, we refer to this value loss as a cost of financial distress if they are caused by debt. So it's very important that this has to be driven by a situation of high leverage. Okay? Bankruptcy is an extreme version, right? A company that is bankrupt is a company that cannot find a way of repaying its liabilities. Then the company has to go to court and either liquidate or reorganize, right? That's like an extreme outcome. But financial distress is even more likely to happen than bankruptcy, right? Because bankruptcy is the extreme version. Financial distress happens much more often than outright bankruptcy. Okay? So one question you might be wondering is, how large are these costs in the real world, right? How large are these costs of financial distress when we actually go out and try to measure them? There is, in fact, a very nice paper that was written in 1995 that estimates cost of financial distress for companies that became distressed due to high leverage. Okay? And this is the paper by Andrade and Kaplan that was published in 95. What they've shown is that financial distress can cause a loss in value of 10 to 25% using the benchmark of value 1 year prior to financial distress. So when a company enters financial distress, its value tends to go down by 10 to 25%. Okay, so it's a significant value loss. And now we can think about it, right? The question for our module here is capital structure. We have the cost of financial distress. How will this cost of financial distress affect the capital structure decision that we're thinking about, right? And the intuition is pretty clear. Right? What will happen is that higher leverage is going to increase the probability of financial distress. So when a company starts increasing leverage, on one hand you might have tax benefits of that, but on the other hand, the higher is your interest payment, the greater is the chance that your profits are going to become lower than your interest payment at some point. Right? So if, like I said, this is usually driven by poor performance, but poor performance is a reality, right? It might happen. Okay, and what will happen is that if your company has high leverage, the poor performance is more likely to cause cost of financial distress. Let's go back to our picture. We have profits, value, and leverage, right? Again, leverage in the x-axis, value and profits in the y-axis. If you think about tax benefits, what we've shown with the PepsiCo example is that your after-tax profits are going to increase with leverage. So PepsiCo becomes, or any company that is profitable, will likely become more profitable as leverage increases, right? This increase in profitability will also increase the company's value. So I plotted the value here as well, instead of just profits as we were doing before. However, we also learned about cost of financial distress. As your leverage increases, what will happen is that the risk of bankruptcy, the risk of financial distress is going to go up, right? If financial distress happens, then all of those bad things happen. The bad things we talked about, the company has to refinance, they have to issue equity, cut investments, right? These actions will tend to reduce the company's value. What this means is that as you increase leverage, value goes down through this financial distress channel, right? If you put the two pictures together, what we get is what we call the trade-off model of capital structure. It's the trade-off between the tax benefits of debt and the cost of financial distress. So the way that companies should choose their optimal leverage, the optimal amount of leverage to have, is by trading off the positive effect of taxes on profits with the negative effect of leverage on financial distress costs. Okay, what you get is a picture that is going to give you, presumably, we're going to give you an optimal leverage ratio that we call L star here. That would be, in this case, that would be the optimal amount of leverage that a company would have. Okay, so this is all very nice theoretically, right? And here we bring back our researcher again. How does this figure look like in the real world, right? That's what we are interested in. A very nice theory, but let's see if we can figure out how this picture looks like for real world companies. This is done in a very nice paper by a researcher called Arthur Korteweg. What he does is he estimates exactly that picture, the effect of leverage on value for firms of different characteristics. Okay? And this is what Korteweg finds. Korteweg finds that there is a picture like that in the real world. There is an optimal capital structure, which, as we talked about already, the average firm has a leverage of about 30%. Korteweg finds that the average firm tends to have an optimal capital structure. And here's the important number. The average firm in the US, the average company in the US, tends to gain 5% in value by moving from a leverage of 0, by having no debt, to a situation where you have 30% of debt. Okay? So you would gain 5% in value by moving from 0 debt to 30% leverage. That's how this picture would look like in the real world, according to Korteweg. Okay? And then, of course, this is just an average picture. Not all firms are going to have the same optimal leverage. If you think about the model we just described, there are many variables that are going to be important, right? So, for example, the volatility of cash flows. Financial distress is going to happen if the company's performance becomes poor, right? So riskier companies that have higher cash flow volatility, are going to have a higher chance of becoming financially distressed. The tangibility of assets matters as well. If a company becomes financially distressed and you have very tangible assets like land, right? It's going to be easier for a company to raise financing by selling the land or by borrowing against the land. So tangibility should also reduce the cost of financial distress. Profitability, right? Profitability also matters because, as we discussed it, only profitable firms should really have tax benefits of leverage, right? If you don't have any profits to shield, there's no tax benefit to take advantage of. Size also matters, right? Think about financial distress. If a large company becomes financially distressed, it's probably going to be much easier for a large company to access financial markets and refinance debt, issue new equity, than for a small company, right? So size should also affect this trade-off. And finally, the company's valuation. This is something we talked about in Corporate Finance 1 as well. It's the market-to-book ratio, right? The market-to-book ratio, essentially what it measures is, it measures whether the company's value lies in the future, right? Where the future profits matter a lot for this firm, right? So if you think about the market-to-book ratio, what should be the case is that companies with high market-to-book ratio have a lot more to lose if they become financially distressed, okay? So one way to think about these characteristics, for example, thinking about volatility, right? We have that picture that we showed you for the median firm from Korteweg's paper. The median firm will have an optimal leverage ratio of 30% and will be getting 5% of value by moving to the optimal leverage ratio. If a firm has high volatility, then this picture will be shifted lower, right? The high volatility, the high risk firm will not have as much benefits of having high leverage because of the increased risk of financial distress. Okay, so the picture shifts down meaning that optimal leverage is going to be lower for a firm with high cash flow volatility. Okay? The problem is that now we reach the limitation of what we know from the research. We have this very nice model that describes capital structure, and it seems to be consistent with real-world capital structures, but what we don't know is how much, going back to that picture, what we don't know is how much lower should the leverage be, right? You can, if you look at that picture again, you'll see that we had a question mark. We really don't know how much lower should the leverage be for the firm with high cash flow volatility. One way to think about this is that the trade-off model is not good enough to give us a precise quantitative model of capital structure, but you can still use the trade-off model as a qualitative model, right? So as we discussed it, right, we have the median firm has an optimal leverage ratio of 30%, but firms with high cash flow volatility, low tangibility, small size, etc., should have less debt, right? So you can use this model as qualitative guidance for how much leverage a company should have in the real world, and what the research has shown is that by and large these characteristics do seem to predict variation in leverage ratios in the right direction. I want to talk a bit about the Analog Outfitters interview that you're about to watch. This is a very small business, and as the owner himself says, the financial management aspect of the business is underdeveloped. They are learning by doing, really. And what you'll see also is that many of the key questions that we ask in this course and also in Corporate Finance 1 are going to appear in our conversation because of the questions I ask him and the topics that they want. Actually, there is more than one interview. The topics that they chose to talk about. So here's the big question I have for you. You know, you're taking an MBA level finance course, and that might allow you to actually think about, you know, how would you have done it differently? Which financial management decisions would you have changed? What would you have changed about the financial management of this business? Let me highlight a few topics that you can pay attention to. First of all, the financing strategy, which is one of the big topics we're going to talk about in Corporate Finance 2. What are some of the methods that Analog Outfitters has used to finance its business traditionally? The owner definitely talks about that, and he also talks about the problems with these traditional methods, so I wanted to identify those and think about it. And in addition, it's going to be clear, I think, in our conversation that the company is trying to change the way it does things. And the question I have for you is, you know, is the company moving in the right direction, right? In terms of risk management, which is one topic we're going to talk about in Module 3 of Corporate Finance 2, I wanted to think about why is it that this company faces currency risk. It's a very small company, so you might think that they don't have currency risk, but in fact they have. And more specifically, think about how changes in the value of the dollar relative to the other currencies can affect the profits of this company. This is one of the topics we're going to talk about in Module 3, and you can start thinking about it as you watch this interview. The owner also talks about R&D. This is a technology company, right? So they do invest in R&D, right? And I wanted to watch that and think about whether this is a significant investment for the company or not. I think there are some numbers in the video that allow you to compare the investment in R&D with some of the other investments that this company makes, right? So going back to Corporate Finance 1, I wanted to think about this question and also consider whether the company is using the type of R&D financial model that we discussed in Module 3 of Corporate Finance 1. Payout, we talked about payout as well. One point that is coming up in the interview is that the role of payout has changed over time for this company. I want you to think about why this is the case, why has payout become more important, and what is the company doing to design a payout policy going forward. Payout is going to be a topic that we're going to discuss in Module 2 of Corporate Finance 2. Thanks for talking to us. Can you tell us a little bit about the company, the products, a little bit of history maybe?
The history.
Yeah.
Well, probably a lot like a lot of small businesses started in a basement. And Benji Day was the original owner. And basically we went from doing everything from repairing pro sound equipment and a little bit of everything all the way to wanting to build our own amplifiers. Yeah. So we went from kind of a live sound rental company, repair company, to manufacturing. Yeah. And which is a great direction. I'm a musician and a builder, and so now we fully just manufacture our own amplifiers out of recycled materials and some of the old vintage materials that we found.
How long have you been manufacturing?
We've been manufacturing around 5-6 years, I think. Okay. Probably. But we've been in business for longer than that.
Yeah, they look great.
Yeah, and so it's a pleasure to kind of give some of these materials a rebirth and make an original tone, original sound. Yeah. And that gets back down to the basics of just old vintage tube amps.
Yeah. No, you know, the sound was beautiful here as well.
Yes, you were the first person to play an amplifier in here.
Yeah, I heard
so
that.
You christened this place.
I have to get one for me. You know, they sounded great.
It was absolutely beautiful.
So, Ben,
yes.
Thanks for talking to us.
My pleasure.
Yeah. Can you tell us about what were the big investments your company has made in the last few years?
So, as our business has grown, you know, we for the last 7 or 8 years we've been in a building in downtown Champaign. Yeah. And we started off. We own the building, but we started off with one little 2,000 square foot section, and rented out the rest of the building. And it was sort of comical. Our section didn't have a bathroom, and we couldn't afford to pay the rent, so I had to find other renters. And so we had to walk down the street and use the sneak in the back of a restaurant to use their bathroom for about a year and a half. Anyways, we finally had enough money where we took over more of the building and more of the building until you know, the last few years we had the whole building except for the apartment. Yeah. But we realized very quickly during our growth that we were in the absolute wrong place for a manufacturing business. You know, we've really transitioned from a service business doing repairs primarily to a manufacturing company, and went from a company that was open to the public to a company that's essentially a factory, so we don't need to be open to the public. Yet here we were in downtown Champaign with no parking, you know, and we couldn't have semi-trucks do deliveries. It was just very difficult. Yeah. And so we had to rent properties around town. And so getting back to your question, what was the investment? Well, this place was certainly one of them. Mm-hmm. You know, we have 4 acres here of land, a 9,000 square foot building, and then 2 like 1,500 square foot outbuildings, and plenty of room to build a new building if it ever comes to that. So this was one that we've been working on for about a year. Another big investment we did was at our last building. We made a professional production wood shop for all of our cabinet work. You know, when we first started making speaker cabinets, we were literally doing it in the parking lot with portable hand tools, like literally in the gravel parking lot, set up sawhorses and stuff.
Even in the winter?
We had, yeah, we didn't have a choice because we couldn't get sawdust in the rest of the facility because because of all the electronics. So it was, we really paid our dues. Yeah. So that wood shop cost us probably about, with the tools, probably about, let's say $50,000. We had a contractor build it out properly, and so that was a big investment. And
so
that
what
allowed
happened to
us,
that when you moved here?
That part, we're still renting that part of the building for another month as we finish this building. And we have a lot of our stuff is stored in another storage place in town. Yeah. So that really made it possible for us to get our quality and our efficiency much higher. Yeah. To where we could do really precise work. Yeah. Recently, I'd say one of our bigger investments was to hire a full-time marketing person, which is difficult when it's like the cart or the horse. It's like, well, you have to have the sales to afford the marketing person, but if you don't have the marketing person, how are you going to get the sales? And we've been very fortunate that word of mouth we've never done any advertising ever of our manufactured products since we started in 2011 with this part of the business. And luckily our dealers and our word of mouth, took us to a certain level, but we realized there's only so much you can do with goodwill and, referrals from other people. So we made the leap to hire a person to do that, and it's worked out excellent. Yeah. It was worth all of the hard work it took to make that happen. Yeah.
So let's talk about these two initial investments you talked about. The manufacturing facility that you had to build. Mm-hmm. How did you finance that?
Well, that's a great question. There was a couple ways we did it. One of the mistakes we made in our business over the years was that we took on an investor named Visa. Ever heard of them? Visa?
No.
American Express?
Oh, Visa. No, the credit. Oh, I see. So you borrowed on your credit card.
Yeah, and that was a mistake. Yeah. And the problem with that is that if you don't really plan out, financially, a project or a plan, you think, yes, I can get it done right now. We've never been very good financial modelers. Yes. I should be going to get an MBA, and I need to sign up for your course.
You're welcome.
So we did a lot of short-term fixes without enough long-term planning. Yeah. Now we have paid off all of our credit card debt, but we wasted a lot of money at 10% interest.
Interest rates are very high, right?
Yeah, this is ridiculous. So we did borrow about $25,000 from my father, who I come from a family business background. We have a 100-year-old family business that my great-grandfather started in 1916 called Ideal Industries. We make electricians' tools and wire connectors and stuff. So I grew up around business, and I grew up understanding a lot about how you build and grow a business. I have not been as successful as my great-grandfather was, but I do my best anyways. So getting to the investment part, my dad worked as an executive there for many years, so he had some extra money, and so he has lent me money at various times when, we could go get a bank loan, but his terms are better.
So when you moved to this space here, did you take a bank loan to buy the space, or is this rented?
This is a very interesting situation. Where we are here, this is a beautiful building, but it is one that has been neglected. Oh. And the story here is that we're on an old Air Force base that was closed in 1994. Yeah. And as you might imagine, a small town, when it would be like the U of I leaving Champaign. Yeah. They lost half of their population over like 16 months. And this Air Force base was given to the village, and they've been trying to, ever since, get businesses out here, and sadly some of the buildings fell into some disrepair, as can happen. And so basically we approached the village of Rantoul and said, this is a perfect place for us. and we worked out a pretty good deal with them. We are closing on it. They let us move in before closing because I had to sell my other building in downtown Champaign. So we should be closing in another month. But and I will take out a loan. But I can tell you that moving to an old Air Force base, 15 miles from Champaign, financially is the best thing I've done because we're getting a great facility for 10% of the cost it would be 15 miles that way. And we're not open to the public. We can be anywhere. We could be in the middle of a cornfield, So this is perfect for us. And there's all these industrial buildings around here that we're renting a few of them, and there's just wonderful opportunities here. There's a 200,000 square foot airplane hangar over there for sale if you need some space.
So you said you're going to take a loan to help finance this.
Yeah,
Is it going to be a mortgage?
Yeah, I'll
loan?
take a mortgage. I'm going to put probably about $20,000 down and take a mortgage for the rest. So it'll be, our mortgage payment will be probably half of the rent that I was paying to myself for our other building. We had a commercial, we had a real estate company and then Analog Outfitters, two separate business entities. And the real estate company just owned that one building.
I see.
And so I paid rent to that. So.
Yeah. So, but you had, you owned the other space, right?
I did. I bought it in 2005 when downtown Champaign was starting to, really was starting to come up a little bit, but still kind of on the downturn. Still recovering from the 70s and 80s. And now it's really an entertainment district, and it's really doing great.
So you probably made a good profit on that.
We did very well. That's part of what helped us get rid of all of our debt. Was doing well on that building.
Yeah. So that's what I was going to ask you actually. So you had this windfall, right, from selling the building. How did you use that in the company?
Well,
or did you use that?
We used
some
a little
other
bit
way?
of it. It's funny. My wife. It was actually in my wife's name.
Yes.
And so we teased that it was her company, and it was her building. Even though she never went over there, she every 2 months she'd pop in and say hi. But basically what we decided, we're going to split the profits. She gets half to do what she wants, and I get half to do what I want. And of course, she used her half to fix up our house and do some stuff.
Yeah.
And then I used part of my half to pay off some debt. And then basically, buy this, and then just saving some for the future.
Saving for the company, right?
I don't know. It's in our real estate company. I left it there, so I don't know what I'm going to do with it for sure.
Yeah.
I mean, it's not a ton of money, but I want to leave some. Maybe do something fun, buy some new fishing poles. I'm really into fishing, so.
So are you the owner of the company here?
Yeah.
Is it a partnership with
I am
Ben
currently the sole owner.
Oh, you're the sole owner.
Yeah, and started it in 2002, as Benny said, in a basement, and then I upgraded to a garage after that. So big upgrade. But I am going to be taking on a partner, Brian, who you might be interviewing today.
That's
as
what
well.
I was going to ask you actually.
Yes.
If you ever considered, bringing capital by having more partners, and
yes.
Apparently the answer is
yes. And the reason, really for him, it's really not. I chose him not so much for a capital infusion, but a management. And
it's more on the management side.
Yeah, because he has a long history as an entrepreneur. He had his own heating and cooling company and built it up, to have over 30 employees, built it up from scratch and has a lot of history, and he decided to make a change and want to get into something he was more passionate about. So he, sold that. And, he's worked for me for about 4 years as a fabricator. And because of his skills and bending sheet metal, making ductwork, he's the one that has figured out how to make these, take the old road signs and bend them up because he has that skill. And as a fabricator, he does all the woodwork too. And over the years, he would give me a little advice and say, hey, we should really consider this, or why don't we do that? And then one day I'm like, wait a minute, you've got all this business knowledge, you've got all this fabrication knowledge, and you want to, your hobby is to work more. He's one of those guys. And I'm like, you need to be part of the ownership structure. This is ridiculous. And so that was, we started that about a year ago, and we're just getting all the details worked out about, how he's going to buy in. And part of the way he's buying in is with basically sweat equity. He's taking a diminished salary in exchange for
having some ownership.
Rather
than contributing capital.
Right. Yeah. And so he, and which is great. It works out great. And he's brought some new energy to the company. Even though he's been here for 4 years, now that he's on an ownership track, his efforts are even greater. I mean, he's here at 7 in the morning, and a lot of times I get a call from him at 8 o'clock, and he's still here. He's just an extremely hard, passionate worker. So he's a perfect guy for a partner. And there were other times I considered having a partner, but I never really had quite the right fit. My dad always told me, he said, a good business partner is one of the best things you can ever have. Yeah. And a bad partner, he's like, you might as well not even be in business, because it's going to take every bit of joy and probably success out. Yeah. So I was always very careful in how I thought about that. And I think I found the right person.
Yeah, that's great.
Yeah.
Let's talk a little bit about risks that you see going forward. What are the major risks that you see for your company in the near future? And
that's such a great question. When I read that, I had so many different ideas. One is that the music business, as all businesses change, that's a guarantee. Musical tastes change, and that's one thing we've seen, is that a lot of young people are, instead of listening to bands like Led Zeppelin and Pink Floyd, really guitar-centric bands, they're gravitating more towards this electronic dance music, which is, sometimes we'll have a drum set and some other instruments, but a lot of it is electronic. Yeah. And so the sales of electric guitars over the last couple of years have been going down. Really? Yeah. Acoustic guitars are still growing. And so as electric guitars go down, well, of course, amp sales go down. Now, so it's probably a temporary blip. That's what I think. I mean, I can't imagine the electric guitar is really going to go anywhere. But, there's trends, just like disco in the 70s, that it's just, there's some volatility in that. So that's one of them. And I think that one of the other risks I see is that we have a tremendous international presence. That's where we sell over half of our product. All this stuff is going to Paris.
Oh, really?
Yeah.
Wow.
And we have dealers in Costa Rica, Hong Kong, Sweden, Germany, Spain, Netherlands. I mean, Japan. And I'm a little concerned about our new president. He's scaring off a lot of, with all of his sort of potential trade wars, and that can really have an impact on us, I think, if suddenly it's much harder to import, or there's new tariffs imposed, or, so that concerns me.
Do you spend any money on research?
Yes.
Or any R&D kind of thing?
I don't even want to know how much, hundreds of thousands of dollars over the years to develop new products. And that is, we had one product, which we don't have here right now, one of our better sellers. It took a year to develop it, and that's, that's expensive. I did it myself, and I used some interns from the University of Illinois, and another friend of mine. We did it, but it was expensive. Yeah, so, but to make something great, you have to put in the time. So it's just part of it. And then try to figure out how to price the product. To recover that investment. And, how many do I have to sell to get this money back? So, and we've been successful at that on most products, but not all of them. So.
Do you think about that ahead of time when you start doing research? Do you think about the end product?
Not
what
enough.
You could sell us? Not enough, right?
Not enough. That's something that would be a weakness of mine. Is I'm not a great financial modeler or long distance planner for things like that.
Yeah.
Like, how are we going to? What is our cost structure going to be? How much is it going to really take to develop this product?
Yeah.
And and part of that comes from just being sort of a artistic guy, and when I get something in my head, I just want to make it and worry about the rest later. And that's really been a mistake. And so part of having the team I'm trying to create here is to have a little more discipline with things like that, and do better financial modeling to really decide, is this a good thing? Artistically, it might be great, but this is a business, and we got to pay our bills and pay our employees, so we can't just be a bunch of artists. We need some right-brained people around here too. Yeah. So.
Great.
Yeah.
Let me ask you a final question.
Sure.
Especially now that you have another partner, have you given some thought about how are you going to pay cash to the owners, or how are you going to distribute, right, the profits?
Right.
This is like a dividend, right? How do you get the money in your pocket
right.
and your partners versus keeping it in the company, right?
We're working on that right now with I've paid myself in the past as an employee and occasionally taken some dividends, but as an owner of a small company, you're always the last one to get paid. I mean, if you want to stay in business, you have to do it that way through the rough times, And so that's just how it is. So, but yeah, we're working on an operating agreement with our lawyer to figure all that out, and to he's going to be purchasing a chunk of the company too. So
the lawyer.
No, not the lawyer.
No. Yeah, I thought you said the lawyer.
No.
The lawyer's going to be...
Shoot, then he can pay cash.
Yeah.
My partner, Brian.
Your partner, Brian.
Yeah, he'll be buying a large chunk of the company, and so, we have that payment to work out. So there's, a lot of details to work out with the lawyer, but, and certainly how we're going to deal with that cash is part of it. And we want to have a good, solid operating agreement, everything laid out in advance, so everybody knows, if he wants to sell out to me in the future, or I want to sell out to him, and all that's spelled out, the formulation, the valuation, everything. So, fight about it. There's nothing to fight about, because it's all laid out. So the dividend policy will be part of that discussion.
Interesting.
Yeah.
Well, thank you. Thanks for talking
Yes.
to us. That was very interesting. Hi, Brian. Thanks for talking to us.
Oh, no, thank you.
So we were talking a little bit beforehand, so you have a business background?
I sure do. I used to own a heating and cooling business in St. Louis that I grew. Basically started out with me and one other technician and grew it to 35 techs and had 35 trucks on the road. And did that for 5 or 6 years and sold my half of the business, and about it really, did really well. It's exciting.
Why did you get out of that business?
I don't like heating and cooling. I'm a musician and more of an artist kind of a person. I'm a craftsman basically, and that wasn't much fun. It was really hard work. So and awful hard work.
Was that? Did you start that company?
No, I kind of did the same thing I'm doing here. I went to work for a guy and basically just kind of turned the business around, and just with hard work, basically, and just got busy, had some pretty good ideas as far as how to market the business, and just did things differently, and kind of got it rolling. So, and it worked. And then I burnt myself out. I worked too much, so it was time to get out. But
have some famous musicians playing.
We do have some. Pearl Jam has one of our amps. John Schofield. Yeah. We have a piece of gear that's going to Dave Gilmour, I think, today, maybe, pretty sure, which is pretty cool. We got all kinds of people, and it's great. It's fun.
Fantastic. You just joined as a partner, right?
Yes, I've been with the company for, I think, about 5 years now, 4 or 5 years. And I used to do my art at night. I'd work from 10 o'clock at night till 6 o'clock in the morning and didn't see anybody. And then basically I saw potential in the business side of things. and said, you know, we should really go for this, you know, and it was the time for Ben. He was like, he's been doing it for 13 or 14 years, and he's like, I need the next push, you know. Yeah. And so that's just one of my strengths. That's, you know, as a partner, I know how to like drive the team, get things done, get it going. Put the work in. I'm not afraid to sweat it out. You know, I do a lot of sweat equity stuff for sure.
That's what we heard from Ben.
Yes, I just work, and we get the job done, and then, you know, it pays off at the end. And which so far we've done pretty well with it. You know, with the new changes. You know,
but as part of the partnership, you're also going to buy into the company. Now, right? It's not just sweat equity.
Yes. I'm buying into the company with all my labor.
Any concerns, financial concerns, or what worries you about?
Well, I mean, it's an investment for sure, but. I don't really have any worries. I don't. I tend to keep things positive, you know, no matter what. I don't do very good at losing. So if I'm going to join the battle, I'm not going to quit. I will win one way or the other, and it just takes hard work, basically, you know, and being innovative and thinking of new ideas and just approaching things differently from everyone else. Is, I think, at least in the world of musical instruments, is see what everybody else is doing and do the complete opposite because you want to stand out, and that's how we approach things, you know.
So do you, you know, there are business students from all over the world watching. Do you have any advice that you give to people starting business?
Well, you know, I do have a little advice, and I hate to, I'm not downing the younger folks in the world, but I think younger people these days are afraid to get dirty and get down to business and get to work. And I think if you really want to make something succeed and you really bleed it and sweat it and love it, the work is not really work. It's a labor of love. And you need to, if you're going to become a business owner, you need to love what you're doing, or it's not a true passion, I guess. You got to have passion for what you're doing, or it's never going to work. You know, you're either going to make a lot of money and be miserable, or you can make a lot of money and do what you love. You know, so I choose the latter.
In this module, we talked about debt and equity financing, right? So we started with simple examples of how debt and equity financing affect income and cash flow statements, the mechanical effects. Then we talked about the net present value of both debt and equity issuance, the costs and benefits, and we talked about this idea that if debt and equity are fairly priced, then the NPV should be close to zero, or maybe exactly zero. Then we talked about two misconceptions that you should avoid when thinking about real-world capital structure. The first one is this notion of dilution. Dilution is an illusion. Dilution does not really matter, and it's not the right way to think about leverage or equity issuance or any capital structure decision. The second one is that debt issuance does not mechanically reduce the cost of capital. The fact that the required return on debt is lower than the required return on equity does not mean that a company is going to reduce the cost of capital by issuing debt. That, in fact, was the motivation for the Modigliani and Miller result, which is one of the key results in corporate finance. Okay? The logic there is that debt is going to increase systematic risk. Higher leverage is going to increase the required return on equity and the required return on debt, meaning that after a company issues debt, right, because the company becomes riskier, the cost of capital in the end doesn't change at all. Right? That's what Modigliani and Miller showed us, and we discussed it, the logic behind M&M and how to use it in practice to avoid making these mistakes that we talked about. Then we moved on to the real world, and we talked about the evidence that equity issuance causes a decrease in stock prices, right? And that is consistent with the other finding that companies are usually reluctant to issue equity to finance projects. So the most important source of marginal financing to companies is debt, right? So given this, we moved on to really go deep into what happens to a company when a company issues debt, right? If a company issues new debt, what's going to happen to profits, risk, and etc., right? We figured out the effect of leverage on taxes and NOPAT, right? Because of the tax advantage of debt, a company that increases leverage is going to reduce taxes and increase profitability. Personal taxes mitigate this effect, but don't completely eliminate it, right? So the real trade-off is between this tax advantage and the cost of financial distress, right? We discussed how what costs of financial distress are and how leverage increases the risk of financial distress. And then we learned how to put these two things together, tax and distress costs, in a trade-off model that allows us to analyze how firms make capital structure choices in the real world. Debt is the most important source of external finance for most companies. This is a key idea that we learned in Module 1, right? And what we're going to do in Module 2 is, just like this dog, we're going to dig deep to better understand debt financing in practice. We're going to talk about many kinds of debt that companies use in the real world, pricing of debt, and some other very interesting issues. Then we're going to talk about payout policy. What we're going to learn is that payout policy is the mirror image of the decision to raise external funds. If you think about it, the decision to pay out cash to investors has to be very related to the decision to bring cash from investors into the company. What we're going to talk about is the fact that some of the same ideas that we discussed when we talked about capital structure are also going to be useful to think about how companies decide payout policy decisions like dividends and share repurchases. In terms of specific topics, we're going to learn how to price debt securities, how to relate changes in yield to maturities to default probabilities, and then we're going to talk about the importance of credit ratings for capital structure in the real world. We're going to learn what determines credit ratings and why credit ratings are an important concern for financial managers. Then we're going to talk about credit default swaps, which is a very important market instrument that allows market participants to transfer default risk. We're going to talk about why credit default swaps are important for companies when they think about their capital structure. And then we're going to talk about the many different types of debt that exist in the real world, like commercial paper, capital leases, and bank financing. We're going to talk about how companies choose between these different types of debt, thinking about important aspects such as seniority, collateral, and covenants, which help us distinguish between these different types of debt financing. And so we're going to talk about issues like how companies choose between bank and market financing and some other issues as well. Then we're going to start talking about payout policy. We're going to learn how to avoid common mistakes that people make when evaluating the impact of dividends and repurchases on firm value. And then we're going to talk about how to identify the real effects, the key effects for why dividends and repurchases may affect firm value. Okay? And finally, we're going to try to learn how companies decide between dividends and repurchases and how companies set their optimal payout policy. Let's talk about the pricing of debt. That's the first thing we're going to talk about in this module. And what we're going to learn is the relationship between default probabilities and yields. Here's some data on US government bond yields that I collected from the Wall Street Journal in September of 2016. For example, if you look at a 10-year 10-year U.S. Treasury bond had a yield to maturity of 1.674. What I also did is I collected some data on bond yields for corporate bonds at the same time period. Actually have the date there, the exact date when I collected this data was September 20th, 2016. If you look at corporate bonds, for example, long-term corporate bonds on average, were yielding 4.22%. Right? So the question that we're going to talk about now is, where does this difference come from, right? So why is the yield on U.S. government bonds lower than the yield on corporate bonds? So here are the numbers. You can compare the long-term corporate bond yield. We don't know exactly what's the maturity. It's an average across different maturities, but even if you compare it with a 30-year U.S. Treasury bond, you can see that the corporations are paying higher interest rates, right, to borrow than the U.S. government. Okay, recall that in Corporate Finance 1, Module 4, we discussed the concept of yield to maturity and how the yield to maturity can be used to measure the expected return on debt, right, the expected return on a bond security, right? The answer is that investors are going to demand their compensation for the likelihood of default, right? The reason why corporations have a higher yield to maturity than the government is because of the risk of bankruptcy. When you think about the U.S. government, we hope that the chance that the U.S. government is going to default on its bonds is fairly low, right? It actually has never happened. That's the point of this cartoon here. The U.S. government has never really defaulted on its bonds, okay, and on any type of debt security issued by the government. However, what we're going to see later, there's going to be some interesting data for you. We're going to learn that in the current marketplace, the default risk on U.S. government bonds is actually not exactly zero. Okay, but we're going to talk about that later. For now, you can think of a very low risk of default. On the other hand, when we think about corporations, the default risk is going to be higher. And here I'm going to bring our researcher to show us the data, right? People have done research on default risk for corporate bonds in the real world. We actually have some pretty good data. And here it is. If you look on a 10-year horizon, so let me explain to you what these numbers mean. So here we are taking all bonds of a given rating, for example, BBB. Let's take BBB bonds as an example. We're taking all bonds that currently have a credit rating of BBB, and then we are looking in the next 10 years, what is the cumulative probability that this bond will default? What's the cumulative probability that the company will default on this BBB rated bond? The number is 5%. Not a huge number, right? It's a 5% probability on a 10-year period, would be 0.5% annually, but it's definitely higher than the probability that the U.S. government is going to default on its bonds, right? So this uses historical data, of course. The only data we have to estimate these probabilities is to look at the history of defaults, right? And try to measure what is the chance that different companies default, okay? Let me give you an example that uses this default data. So suppose that in the current marketplace, you hold a 10-year BBB bond that pays a yield to maturity of 3%. So I pulled out a specific bond from Capital IQ. It's a bond that was issued by Monsanto. And this pricing data is fairly recent. You can see the date there, September 19, 2016. So it's contemporary to the data that I showed you. Of course, I don't know when you're going to be watching this lecture, but this data was collected in September 2016, right? And if you look at the yield on this Monsanto bond, it's approximately 3%. So if you hold a bond issued by Monsanto, you expect a yield to maturity of 3%. Okay, the maturity is 2025, so this is approximately a 10-year bond, right? If we are in 2016, the bond matures in 25. This is approximately 10-year maturity. The rating is BBB, as I said up there. Okay, so what happens? How do we think about the possibility of default when we invest in this bond? Right? This is the purpose of this tree. Remember that we used these trees when we were talking about R&D investments, for example, when we're trying to model real options. Every time there is uncertainty in finance and you want to depict the uncertainty in a way that is visually appealing, that is easy to see, these binomial trees are very useful. Okay? In terms of the bond, this is what's happening. If you invest in the Monsanto bond today, there are two outcomes that are possible next year. By far, the most likely outcome, it has a probability of 99.47%. The most likely outcome is that you will get a return on the bond, right? And the expected return, if the bond does not default, is exactly the yield to maturity. This is what we learned in Corporate Finance 1 when we're talking about the yield to maturity. So you approximately get 3% if the bond does not default. But now this is the new thing. We are explicitly incorporating the probability that the bond defaults. If you look back at the table, the 10-year probability of default for a BBB bond on average is 5%, 5.3. So that's why I have 0.53. I'm basically dividing the number by 10 to estimate the annual probability that the bond will default. Right? So now we have to think about these two scenarios. And let's ask an important question. What will happen if Monsanto defaults? You might think that bondholders are going to get zero, right? You might be thinking that they might get a minus 100% return, but in fact, they probably will not. There is something called the recovery rate. If a company defaults on its debt, what happens is the debt holders are going to take over the company and attempt to recover some value from the assets, right? So that's what we call debt recovery. Again, we have historical data that tell us on average what have recovery rates been, and what we know from the data is that these rates have been around 40% of the face value for corporate bonds. So for example, if you hold a bond that had a face value of $100 million, the company defaults, what happens is the bondholder would recover $40 million. Okay? Putting it back in our graph, so now what we have is a minus 60% return in the case of default. You get 40 back, you lose 60, right? So your return is minus 60%. The question that I wanted to think about is, what is the investor's expected return when investing in the bond? How are we going to figure that out now? This is the calculation. It's a simple expected return formula that is very similar to the ones we used in Corporate Finance 1, right? All you have to do is to compute a weighted average. There is a 99.47% chance that the bond doesn't default. You get the yield to maturity, right? But there is a 0.5% chance that the bond will default, and you're going to get paid 40 out of 100, so you're going to get a minus 60% return, right? So what you see is that if you put those numbers together, those two numbers together, the expected return is going to be 2.62%. So if you invest in a BBB-rated bond like Monsanto, your expected return is in fact not 3%, it's 2.6% after you take the risk of default into account. Okay, and this is a general idea. The bond's expected return is always lower than the yield to maturity. That's the way to think about it. The yield to maturity is a promised return. It's what the corporation promises to pay you. If the bond defaults, the investor will not earn the yield to maturity, right? Another related thought then is that if there is a higher risk of default, if a company has a very high risk of default, what's going to happen is the company has to promise a higher yield to maturity as well. The higher the risk of default, the greater is going to be the yield to maturity. Okay? And it's very easy to see this in the data. I showed you the data for some corporate bonds already. Here what I added is a bond that is an average yield for bonds that are rated CCC. So these are bonds that are very close to default. The probability of default is very high. You can see that the yield to maturity is 13.5%, so considerably higher than the yields on the highly rated bonds. Okay? The other issue I want to talk about is that this notion of bond risk premium that is also worthwhile learning. notice that the expected return on the Monsanto bond is still significantly higher than the US Treasury rate. If you look at the 10-year Treasury rate, it was 1.674 in September. The expected return on Monsanto, even after deducting the default premium, if you hold a Monsanto bond, you still expect to make 2.6% on average, even taking the default risk into account, right? So what this means is that investors earn a risk premium of close to 1% for investing in a Monsanto bond. And the notion here is exactly the notion of a risk premium that we talked about in Corporate Finance 1. Monsanto bond is risky, right? There is default risk. Some of this default risk is likely to be systematic, is going to be correlated with what's happening in the overall economy. The way that investors are going to price this is to demand a higher expected return to invest in the Monsanto bond. So putting all the data together, this is what we learned. We could decompose the yield to maturity on a corporate bond in three different numbers. The first one is the risk-free rate, which is what the US government pays. Then there is the bond risk premium. This is the additional expected return that investors demand to invest in the bond, which is close to 1%. And then finally, there is the direct compensation for default, which is what we calculated in our numerical example. For any defaultable bond, you can think about this decomposition of the bond yield into these three different components, which is a useful way to think about a yield to maturity in the real world. This is a map of the world that you haven't seen before, I think. It shows the importance of credit ratings. It's a fundamental variable for credit markets, and what we see in this picture is that every country in the world actually has a credit rating. Countries borrow in debt markets, and what happens is that rating agencies have to determine what is the likelihood that a country will default on its debt. So you can see that most countries, actually not everywhere, there are some places in Africa that don't have a credit rating, and Asia, but by and large, you can see that every country has a credit rating. So this is just an interesting way to think about the world, right? These are the credit ratings that we're talking about. It goes from AAA, which is the highest rating. If you're looking at S&P, there are other companies that do credit ratings as well. So ratings go from AAA all the way down to default. So if a company is rated D down here, it means that you defaulted. If you have a high rating, it means that you have a low probability of default. Okay? And rating agencies like to separate these ratings into two categories. If you have a rating higher than BBB minus, that means you are investment grade, okay? And if your rating falls below BBB minus, that means the company becomes junk, okay? What do these ratings measure? We can look at what the rating agencies actually say when they talk about ratings. So I took this directly from Standard & Poor's. As we've been discussing, the credit ratings should be a measure of the corporation or the state or the city government. Whoever is issuing the bond is going to have a chance of not paying, right? So what the rating is going to do is to express the ability and willingness of an issuer to meet its financial obligations. However, they also say that credit ratings are not an absolute measure of default probability. You probably would not be a great business model to have a mathematical model that gives a very precise answer, right? And then what people could do is just replicate that model, and it would send the rating agencies out of business. So the bottom line is that it's a measure of the chance that the issuer default, but it's not a purely objective measure. Ratings are also going to incorporate judgment calls by the rating agencies, like S&P, as we've been talking about, is a major agency in the market. Some of the big competitors are Moody's and Fitch. So rating agencies are a combination of objective data and subjective calls. What we can do is we can try to look at the objective side. Which variables matter most for ratings? Let's bring our researcher here. People have done research on this, right? It's fairly straightforward. We have the ratings from Standard & Poor's, right? And then we have the data on the companies. We can try to relate them and see which variables are related to ratings. So I'm going to show you two tables. This table actually comes from a paper that I wrote recently about credit ratings. It's a regression. If you learned about regressions maybe in your statistics course, it's a regression of credit ratings on different firm characteristics. The variables that I have here in this regression we actually talked about already in this course. So ROA is a measure of profitability, is the company's profits divided by assets. Size is obvious, and then leverage, right, which is what we were talking about in Module 1. What you see in this regression table is that profits are positively correlated with ratings, so profitable companies have higher ratings. Larger companies have higher ratings, and companies that have higher leverage, if you have a lot of debt, you're going to end up with a lower credit rating. The regression also has squared terms, but it really doesn't change the interpretation that much. And here's an interesting observation. The R-square of a regression, again, if you cover this in your statistics course, which is a very important tool for finance, the R-square shows that it's a 0.6 R-square, 587, right, approximating to 0.6. This shows that these variables, profit, size, and leverage, explain a lot of the variation in credit ratings, but they don't explain 100%. So there's 40% of the variation in credit ratings that perhaps are capturing the subjective judgment that the rating agencies exercise when they give out credit ratings. Another way to look at credit ratings is to look at leverage ratios per rating. So here we have the highest rating AAA. When we look at the leverage ratio that I wrote down explicitly here as total debt divided by the market value of assets, you see that it would be only 3.7% for AAA rated companies, and then the leverage ratio keeps increasing as the rating goes down, right? So there is a one-to-one relationship between ratings and leverage ratios. We can also look at EBIT interest coverage, which is another financial ratio we talk about in Corporate Finance 1. It's the ratio of EBIT, operating income, to interest payments. It's essentially telling us if how large are the company's profits relative to the interest payment. And again, you see that there is this one-to-one relationship between how much the company borrowed and the credit rating that is given by the rating agency. To summarize, essentially what we've seen is that highly levered companies are going to have lower credit ratings, right? Particularly so if they are small and less profitable. There is this one-to-one relationship between ratings and leverage, which makes sense, but this raises an interesting question. Why should we care about ratings then? Maybe it's enough to just think about leverage, right? In Module 1 of Corporate Finance 2, we already talked about how to determine an optimal leverage ratio, which considerations go into that. Why do we care about ratings? Let's bring back our researcher. There's been a lot of research about credit ratings in corporate finance recently, including a paper that I wrote I'm going to show you. But here is the answer. Here is why companies should care about a credit rating. The idea is that a rating downgrade can have a very significant impact on the cost of capital for a company. This is what Kiesgen showed in his research. There are several papers that Darren Kiesgen wrote about this issue. And some of the reasons why rating downgrades matter is because rating downgrades affect variables like access to commercial paper market. We're going to talk about commercial paper later on in this module. Companies with low ratings cannot access credit ratings. Ratings are also going to affect regulations. For example, some insurance companies cannot invest in debt securities that have a low rating. They can only invest in highly rated securities. These regulations are going to change the supply of capital that is available for different companies. Bank capital requirements are also tied to ratings. If banks make a loan that has a low rating, the bank has to hold more capital against that loan, increasing the cost of the loan for the bank. And finally, ratings can trigger violations of financial covenant, which is it's another issue that we're going to talk about in this module. If you don't know what a financial covenant is, you're going to learn soon. Okay? So here's the summary that I was talking about, right? So access to commercial paper, insurance companies can be restricted from investing in junk bonds, so on and so forth. The bottom line is that there are lots of frictions in financial markets that are related to credit ratings. A rating downgrade can really matter for a company. Recently, I've followed up on this idea with my co-authors to think about sovereign downgrades. What happens in a sovereign downgrade is that some companies tend to be downgraded together with the country. For example, we have this example of EDP Energias, which is a Portuguese company. It got downgraded from A to BBB minus together with Portugal in March 2011. So Portugal got downgraded from A to BBB minus. EDP Energias got downgraded together with Portugal. That happens because the rating agencies use something that is called a ceiling rule. They don't like rating a Portuguese company higher than the country. So what tends to happen in the data, as we've shown, is that companies like EDP Energias, they tend to get downgraded together with the sovereign. Okay? And what we show in our paper is that the sovereign downgrades cause a significant increase in the cost of capital for companies like EDP Energias. This is a study that looked at many countries, many years, and it's summarized here in this picture. Essentially, this blue line shows what happens to companies that get downgraded. You can see that the y-axis is measuring the spread. So these companies usually have a lower spread than the other companies in the economy because they are the companies with high ratings, right? Like EDP Energias had the same rating as Portugal. Those tend to be the highly rated companies in the country. But following the downgrade, the sovereign downgrade is marked here by this line. The cost of capital increased a lot for companies like EDP Energias. Bond spreads increased significantly. We show in our paper that this has severe consequences for what happened to these companies. Okay? What this means is that there is a very important idea in corporate finance. Managers should care about credit ratings. Capital structure is not just about determining an optimal amount of leverage you have. A company should also be thinking about how is the rating agency going to react to my financial decisions. Okay? This is a very nice quote that I took from GE's annual report in 2006. It shows exactly this idea. It's one of the strategic objectives of GE when they think about financial policy to maintain their credit rating. At that time was AAA, right? The reason is that it lowers cost of funds, facilitate access to a variety of lenders, and etc., which is exactly what we've been talking about. So credit ratings do matter, and companies should target credit ratings. Kisgan actually has this very nice idea that I'm showing you here. It actually changes the way you think about the trade-off model. Remember that we had that picture that related value to leverage, right? So when leverage goes up, value goes up, and then it goes down, right? That allows you to think about the optimal capital structure. Credit ratings make this picture jagged, like what I have here, right? So for example, there are these points when if you increase leverage beyond that point, you might get a downgrade. If a company gets downgraded, there's going to be a significant change in firm value because of the increase in the cost of capital. So your value, you can see in that picture, the value is dropping by a discrete amount, when you change your leverage by a little bit. So this picture becomes jagged is one way to think about how ratings should matter when a financial manager determines optimal capital structure. Let's talk now about credit default swaps. It's a very important instrument in modern financial markets that allows default risk to be transferred across participants. For example, a bondholder can buy protection against the risk of default by buying this credit default swap from a counterparty. What happens then is the counterparty is going to assume the risk of default, meaning that if the bond defaults, the bondholder is going to be paid full. The CDS, we actually tend to call these CDSs. Credit default swap is a long name, so CDS is the short. It's an example of a derivative, right? It's a security whose payoff depends on another security. In the case of the CDS, the payoff of the CDS depends on the payoff of the bond. So let's talk about CDS on Monsanto's bond. Let's think about how a CDS would work for the same bond that we were talking about before. Okay? Remember that this bond has a 3% return approximately, yield to maturity, if the bond does not default. If the bond defaults, our estimate is that the bond will lose minus 60% based on historical data, right? So again, 0.53 is the annual probability of default using historical data for BBB bonds, right? And minus 60% is the annual return that we would expect if the bond defaults. Okay? Now let's think about a CDS. What would happen if an investor invests in the bond and buys the CDS? Essentially, the way to think about it is that the investor will get the 3% return no matter what, right? So if the bond defaults, if the bond does not default, you get 3%. But if the bond defaults, the default risk is transferred to your counterparty. Let's think about the following, right? Given this, essentially you have a risk-free bond. It's, this insurance is not going to be free. Insurance is not free. We can actually figure out in our example how much should the investor pay to hold the CDS, which is what we call the CDS premium in financial markets. Let's try to work this out. This is what happens, right? If you hold a Monsanto bond and you hold the CDS, essentially you have a risk-free bond. What should be the yield on the risk-free bond? Well, it shouldn't be different from the yield on the Treasury, right? We know from our data that the yield on the US Treasury at that date was 1.674%. The yield on the Monsanto bond was 2.94%, 2.954%, right? So the investor is getting 1.28% return higher by having the CDS. So that's what the investor is going to be willing to pay for the CDS, right? If the market is efficient, and assuming, of course, that this is the exact data, we should see a CDS premium of 1.28%. So, for example, if you hold a $1 million Monsanto bond, the investor would pay $12.8 thousand a year to hold the CDS. You pay that to your counterparty. The counterparty assumes the risk of default. If we look at the evaluation, I actually pulled out the data on the actual price for a CDS. Was pretty close to what we got, 1.123. Not exactly the same. And we don't have, this is not a crucial point for our class, but I just want to mention that this is a common finding in the literature. CDS premium tend to be lower than bond spreads. That happens because of liquidity. Bonds are very illiquid assets. It's not easy to buy and sell bonds in financial markets if you already hold a bond. The CDS market turns out to be much more liquid than the bond market. So usually what we find is that the CDS premium are a little bit lower than bond spreads, just like in our example. But I think now you have a good idea of what should determine CDS premium. So let's think about the question that we talked about before, right? So in this module, I mentioned that I'm going to show you data that the default risk of the US government is actually not zero. This actually comes from a recent research paper that I saw being presented here in Illinois. What we can get is we can get CDS premium on US government debt. This security actually exists, right? If you think about if the US has no risk of defaulting, then people would pay nothing, right, to hold the CDS premium on US debt. And if you look at this data, right, it was actually close to nothing, back, in 2007. this market started, and people were not really paying anything to hold the CDS on US government debt. But then everything changed during the financial crisis. The financial crisis happened in 2008. This premium on US government debt actually shot up significantly. And even, to these days, this is the most recent time, what these numbers are showing is that investors are currently paying 0.2% to insure against US default. Okay? So the US government is no longer risk-free. It's just a fun fact we can see from the CDS market. The other pattern in the data that, and this is important for corporate finance, as I'm going to show you later, what we see in the data is that CDS is actually more common for safer firms. You might think that the CDS is going to be more useful in the market when there is a lot of default risk, right? So there is a lot of risk to be transferred. But what you actually see in this picture is that the CDS is much more common if a company has a high credit rating. The dark blue bar here is the number of firms that have CDSs. The light blue bar is the total number of firms at that credit rating. You can see that the dark blue bars are a much larger fraction of the light blue for companies that have high credit ratings. Okay, why is this? One reason is because of the counterparty, right? So we have to think about the counterparty as well. CDSs are typically sold by banks and insurance companies like AIG. It was actually a reason why AIG got in trouble during the financial crisis because AIG was holding credit default swaps on mortgage-backed securities. So AIG, this big insurance company in the US, had some financial problems during the recent financial crisis, right? It had a loss, it had the number there, $440 billion loss, right? So this counterparty may not be willing, right? So, but banks and insurance companies, if they're going to write CDS for companies with high credit risk, they're going to hold, they are going to have to hold more capital, more liquidity against these positions to make sure that they're going to be able to pay out, right? What happens then in practice is that the counterparties may be less willing to make markets on the CDS of riskier firms. That is one reason why CDS is less common for risky firms. Okay, and let's talk about corporate finance, right? So this is essentially a security in the market. Why should a financial manager care about the CDS market? Or to ask this question in another way, right? How would the presence of a CDS change the cost of funding for a company? And what we're going to learn is that it might change what happens if the company goes bankrupt. And this is the key idea here, right? If a company goes bankrupt, as we're talking about in Module 1, there are essentially two options. Creditors can take over the company and hopefully restructure it. That's what we call Chapter 11 in the US. It's a process of restructuring of the company, trying to get the most value out of the highest value that you can get out of the restructuring, or creditors can simply liquidate the assets. Right? So if I don't want to go through this restructuring, I'm just going to liquidate the asset. So let's think about CDS. How would the CDS change this process? That's what we call the empty creditor problem. Okay? If you have a CDS, your creditors may essentially disappear, right? So what happens is that the original creditors that lent you the money, so think about a bank, for example. You borrowed money from a bank, but the bank no longer holds the debt. This bank sold off the default risk to another counterparty. So the bank is not going to care about restructuring anymore. If the company defaults, the bank might as well liquidate the security and go charge the counterparty for the compensation. So AIG has to pay, right? And the bank no longer cares, right? So what people have found in corporate finance is that the presence of a CDS can increase value lost during a bankruptcy. So the CDS matters for corporate finance because it might increase financial distress risk. That's another reason, by the way, why there might be a thin market for CDS for risky companies. These companies are risky, they are closer to financial distress, so this empty creditor problem matters more for these risky companies. So here is the debt structure for Monsanto, and this is what I mean by debt structure. Instead of just looking at the total amount of debt that a company has, right? In the case of Monsanto, it's $10.5 billion. What we're going to look at is what type of debt does a company have. In this case, right, I listed here all the different types of debt securities that Monsanto had issued at that time. This is essentially September 2016, is the same time period we're looking at in the previous example, right? So you can see that there is commercial paper, revolving credit, term loans. So the purpose of this lecture is for us to learn what's the difference between all these different types of debt and how companies choose between these different types of debt securities. The idea is that debt has many faces, so debt is not going to come only on one mask. There's going to be many different types of debt. Let's talk about these 5 types: commercial paper, revolving credit, term loans, bonds, and capital leases. Starting with commercial paper, if you look at that table I showed you, for Monsanto, commercial paper represents 18.3% of the total debt that the company has. So what's the characteristic of commercial paper? Commercial paper is a short-term debt that the maturity is less than 270 days, so even less than a year. It's sold directly to the market. So if a company has commercial paper, you're not really borrowing from a bank. You're borrowing money directly from investors in the market. There is no intermediary. Okay? And because of this characteristic, this is a type of debt that is relevant only for firms that have very high credit ratings. To be able to access this market where you can freely borrow from investors on a short-term basis without an intermediary, what happens is that this market is really only available for companies that have high credit ratings. Like Monsanto, for example, had a BBB credit rating. It can have some commercial paper. But companies that have lower ratings or companies that don't have credit ratings are not going to be able to access this market. If we look at the data, what I did is I pulled out from the financial statistics of the United States how much commercial paper was outstanding for the non-financial corporate sector at the end of 2015, and the figure was $176.5 billion. That might seem like a lot, but you'll see that it's a small market compared to bonds and bank loans. Okay? Let me also say that if you had obtained this data for financial companies, you would see larger numbers. Financial companies like banks and insurance companies, they rely more on commercial paper, but non-financial companies do not rely so much on this specific market. Then in that example, in the Monsanto data, we have revolving credit. And we talked about this in Corporate Finance 1 already. Revolving credit, it comes from a credit line. It's a bank loan that originates from a credit line drawdown. Okay? That data shows us that Monsanto has an undrawn credit line of $1 billion, $1.074 billion, but the revolving credit is actually 0. And here's the question I want you to think about. We talked about it in Corporate Finance 1. I want you to refresh your memory. Why would Monsanto have a credit line if it does not use it? The credit line is going to cost money, and Monsanto is not using it. What's going on? The answer is that the credit line is used mostly for insurance in this case. Okay? The idea is that Monsanto is going to draw on the credit line if it has trouble refinancing its other liabilities. For example, in Corporate Finance 1, we gave an example of accounts payable. If a company has trouble refinancing accounts payable, it may be useful to have a credit line that you can use to manage your liquidity. Or Monsanto may have trouble refinancing commercial paper, right? We showed that Monsanto does use commercial paper market. If you have trouble refinancing your commercial paper, it might be useful to have a credit line that you can use as a backup. So it makes sense actually that you have a credit line but you don't use it if you're using it for insurance, right? If you had drawn the whole thing, then it can no longer be used for insurance. What you see in the data is that companies like Monsanto that have a high credit rating are going to have are going to have undrawn credit lines that they use for insurance purposes. Moving down that table, we have the term loans. So a term loan is a bank loan that does not originate from a credit line drawdown. So it's a loan that it's money you borrow from the bank with a fixed maturity. That's why it's called term. And it does not originate from a credit line drawdown. Otherwise, it would be called revolving credit. Okay? It can be short or long term. And for Monsanto, it wasn't a very important form of financing. Monsanto uses only 3%. Only 3% of the total debt was coming from term loans. Essentially, what Monsanto is doing is using bonds for its financing. So 79% of the debt that Monsanto has comes from bonds that Monsanto issues in the financial markets. Like the bond we were talking about. Remember that I gave an example of a specific Monsanto bond. That is how the company is financing itself long term. Rather than bank loans, they are using bonds. Okay? Finally, we have capital leases. What is a capital lease? You can think of this essentially as renting, right? Instead of buying equipment, buying a machine, and borrowing money to buy the machine, what a company can do is to rent the machine. This rental is going to generate a liability, right? So if you have a lease, you're going to have to make the rental payment to the other party in this transaction, right? So this capital lease that you see in Monsanto's balance sheet is a lease that cannot be canceled, right? The lessee is the company who rents the equipment, right? So we call the lease a capital lease if the lease cannot be canceled before the end of the contract. So it has this liability component, right? So if you have this lease, you have to make the rental payment. However, for Monsanto, if you look at the data, Monsanto actually didn't have any leases, right? Capital leases are only going to be important in certain industries like airlines. Here you have JetBlue. Let's look at JetBlue debt structure as another example. And it's very similar to Monsanto's in many ways. So for example, it's most of the debt that JetBlue has comes from bonds. It doesn't really rely on bank loans that much. It has zero revolving credit, right? But it has a credit line here, undrawn credit line of $600 million, so similar, right? The main difference here is that JetBlue does use leases. So 8% of the total debt that JetBlue has corresponds to leasing, right? So essentially, airlines are going to lease. They use the leasing market to rent airplanes instead of borrowing money and buying airplanes. Airlines are also renting airplanes, and you can see that in the balance sheet of JetBlue. The most important sources of debt financing for companies are banks and bond markets. Going back to that data from the U.S. government, I looked at the end of 2015, how much outstanding bonds did companies have and how much outstanding loans, and you can see that the figures are very large. Companies had $4.8 trillion outstanding bonds at the end of 2015, and they had $2.6 trillion outstanding loans. That includes revolving credit, by the way. Okay? So this raises an interesting question. How do companies choose between these two forms of debt financing? What's the difference between borrowing from the bond market or borrowing from a bank? Very important financial decision to think about for a corporate financial manager. I want to give an example from the real world, thinking about two companies in the same industry. And this is a picture. We're going to have Home Depot and Tile Shop. Those are both retailers that retail similar stuff. Okay? Let's look at their debt structure. Home Depot is here. If you look at the debt structure of Home Depot, we're going to find, to encounter a common pattern. We already saw the debt structure of JetBlue and the debt structure of Monsanto in our previous slides. Home Depot is actually going to look very similar. There is a lot of bonds. So Home Depot is relying mostly on the bond market. 96.5% of its debt comes from the bond market. A little bit of capital leases for Home Depot. There is an undrawn credit line of $2 billion that the company is not really using. So companies with high ratings, large public companies tend to use credit lines for insurance, as we've been talking about. So 0 revolving credit and 0 term loans. So Home Depot is not relying on banks for its financing. Okay? Tile shop looks very different. Look at this. 47.5 million term loans. That is almost the entire amount of debt outstanding that they have, 57.1, right? So out of $57.1 million of debt, they have 47.5 in bank loans. So it's 83%. The other large item here is revolving credit, right? So remember, revolving credit originates from a drawdown of a credit line. It's also bank debt, right? You're drawing down a credit line from a bank, so both are bank debt. Essentially what this picture is showing is that other than a very small bond issuance and a small amount of capital leases, Tile Shop is relying mostly on banks for its long-term financing. That's the summary here. We have this very nice contrast. Two companies in the same industry. One of them relies mostly on bonds. The other one relies mostly on banks. What's the difference? Again, let's look at data. The data helps a lot. This is Home Depot. Okay? Here what I have in the bottom is this notion of secured debt. We also have data on whether the debt is secured or not, which we're going to talk about soon what it is. It's essentially a notion of collateral. Is the debt collateralized by assets or not? And here you see that for Home Depot, most of the debt is unsecured. It's not collateralized. Whereas if you look at Tile Shop, there is no unsecured debt. All the debt that Tile Shop has is secured, is collateralized. So that's a very important difference, collateral. That's one of the key differences between bank debt and bonds. Bank debt is typically going to be secured by buildings, machinery, other types of collateral. The bank is not going to give you a loan if you don't, we call it post-collateral, right? If you don't have an asset that you can post as collateral, essentially meaning that if you default on your debt, the bank can take over that asset. Okay? So if Tile Shop defaults, the bank is going to take over the collateral. Whereas bonds are typically unsecured. If Home Depot defaults, essentially what's going to happen is what we were talking about in the Monsanto example. Remember the Monsanto example, we had this tree. If Home Depot defaults on its debt, bondholders are going to take over the business and try to recover some value. Bonds are only secured by the cash flows of the business. So they are unsecured, really. This is, of course, going to affect recovery rates. We were talking about recovery rates in the beginning of this module, but now what we have is recovery rates specified by different types of bonds. This actually comes from Moody's. And what you see here is that secured bank debt has a much larger recovery rate than senior bonds. Okay, so senior unsecured bonds have a recovery rate of 40%. If you remember, that's exactly the number we used in our numerical example. But secured bank debt is going to have a higher than 80% recovery. So banks will get their money back. All right? Here's a question for you to motivate the next thing we're going to talk about. If you look at that data, the recovery rate for secured debt is 82% for banks. But we also have secured bonds, which they're not very common, but there are a few of them out there. That table pulled out the recovery rate for secured bonds, and it was 65%. So it's lower, right? If the only thing that mattered was collateral, the recovery rate should be the same, but it's not. What's going on? That's a question for you to think about. What happens is that bank debt is going to come with an additional source of control for the bank. Most commonly in the data, this is represented by financial covenants. Okay, so what's a covenant? A covenant is essentially a condition, a contractual condition that a company has to satisfy in order to be able to maintain the loan. For example, a very common covenant in the real world is that the company has to have a profitability higher than a certain number. So if your EBITDA, for example, falls below X, this X is the threshold, what happens is the bank has the right to call the loan. Covenants can be written on profits. They can be written on other variables as well, like leverage and related variables. Essentially, what happens is technical default, meaning that if the bank has the right to call the loan, essentially, either the company pays, right, or the bank is going to take over some of the assets. So this is technical default. What happens in practice is that is a trigger for renegotiation. So the bank can use the covenant to take control over the company and try to change the situation, to change what's going on at the company. This is a graphical way to think about covenants, okay? So here we have EBITDA on the y-axis and we have time. So this is a company that is doing poorly. So its EBITDA is decreasing, right? I also plotted the interest payment here. So if your EBITDA falls below your interest payment, that might trigger default, so you don't have enough profits to pay your interest, right? But typically, if you have a bank loan, what will happen is that there is going to be this threshold. There's going to be a covenant that says that your EBITDA is not going to be allowed to fall all the way down to your interest payment. Your EBITDA has to be greater than X, okay? So if you cross that threshold, if your EBITDA becomes lower than X, the bank will take control. The bank takes control, renegotiates the loan, does whatever it needs to do in order to make sure it's going to get paid, right? And the company has to comply with that. If the company did not have a covenant, then in principle you would be allowed to go all the way down to the interest payment before the bondholders can take control. So the bottom line is that these covenants are going to transfer control to the bank earlier than if you only had bonds, if you only had market financing. Okay? So to summarize, these are the differences we talked about, right? So bonds are going to give less control for investors, lower recovery rates. Bank debt has more control for the bank and higher recovery rates, right? And we haven't really talked much about interest rates, but it's pretty obvious the way it should go, right? Banks have much higher recovery, right? And they have more control. So typically what will happen is for the same company, it will end up paying a lower interest rate if it borrows from a bank and gives more control to the bank than if it goes to the bond market, right? The bond market, you're going to pay more interest rate, but investors, are going to have less control over the company. They're also going to recover less if the company defaults, right? So let's think about this. What source of debt financing should a corporate financial manager choose? So reflect on what we learned for a while and try to think about how companies make this decision in the real world. Right? And you can see that it's not going to be an obvious decision. Right? There's going to be a trade-off between paying lower interest rates but losing control. Right? If you go to a bank to borrow money, this bank financing will typically come with many more conditions, and there's going to be an expectation that the bank is going to interfere with corporate policies, right? So you're going to have to give control to the bank, so the bank has a higher recovery rate, it can charge you a lower interest rate. That's not an obvious trade-off, right? In fact, we have this nice way to describe bond financing, which is arm's length, right? It's the type of financing that keeps your creditor away, okay? And again, we can draw on our research, right? People have done research on this choice between banks and bonds and how has it evolved over time. So here is an interesting picture looking at the U.S. data in the last 30 years or so. What we've been seeing is that companies are relying more and more on bond financing. So the ratio, what we have in the y-axis, is the ratio of bonds to total debt, okay? This ratio has been increasing. It used to be 50%, but it has been increasing to close to 70% recently. So what companies are doing is they are shifting from banks to bond financing. In terms of firm characteristics, people have also done research on this, and what the research has found is very consistent with our example. Remember the tile shop Home Depot example? Bank financing is going to be more important for small companies, young companies, and riskier companies, right? If you're riskier, you're likely to pay a very high interest rate anyway, right? So it might be better for you to go to a bank, give more control to the bank so you can reduce the cost of financing. Once companies grow, mature, become less risky, they tend to switch to bonds. This is like Home Depot. So Tile Shop and Home Depot are, two companies in different stages of their life cycle in the same industry. Home Depot is a large public company, uses bonds. Tile Shop is also a public company, but is much smaller and riskier. It uses banks for its debt financing. Right? So the bottom line is that this greater control that is associated with bank funding is useful for small, risky companies, but at some point it seems to become costly, right? So companies move away from banks and into bonds in order to have this arm's length financing in order to reduce the control that is associated with bank funding. Let's talk now about returning cash to investors. As we discussed in the introduction, returning cash to investors is the mirror image of raising cash from investors. Some of the same considerations we already talked about in Module 1 are going to apply here as well. Okay? We're talking about payout policy, of course, right? So what we study in payout policy in corporate finance is how to return cash to investors, specifically to equity investors. If you have debt investors, right, debt investors are receiving interest. Interest is not really a decision of the company, right? If you borrow money, you have to pay interest, but payout is a decision. If you issue equity, you're not necessarily forced to pay dividends, and you're definitely not forced to do stock repurchase. That is a conscious, voluntary decision of the company. Right? So let's think about what determines this decision. Why should this matter? Why do we need to talk about payout? And the first thing you're going to see is we're actually going to directly use this mirror image idea. Remember the dilution argument, right, that we talked about in Module 1. What we discussed is the idea that dilution is an illusion, right? Let's think about this. Suppose somebody tells you the following argument, that stock repurchases reduce the number of shares. If you buy back shares, the number of shares outstanding go down. Therefore, stock prices go up, right? Because the stock price is the equity value divided by the number of shares outstanding. Is this right or wrong? Remember, dilution is an illusion. The idea of dilution is that issuing shares increases the number of shares outstanding, so stock prices must come down, right? I showed you that dilution is an illusion, right? Of course, if dilution is an illusion, reducing dilution is also an illusion. Your tongue gets mixed up saying this, but, right? Reducing dilution has to be wrong as well, right? So let's try to work this out. I think you're capable of doing this on your own. It's very simple. What should happen to a company that, in this case, suppose you have a stock price of $80, shares outstanding is 1,000, so your equity value is 80,000. What should happen to the stock price if the company decides to repurchase 100 shares? Think about this. Right, so your shares outstanding are going to go down, of course. You have 100 less shares. But right? And if the stock price, if this was the right calculation, right? 80 divided by 900, of course, your stock price would go up. The problem is that the repurchase costs money. You're not going to be able to repurchase shares for free. If you buy the shares at the market price, right, that means you're going to spend $8,000. So if you do the math, 80 minus 8 divided by 900, exactly the same stock price, right? So the stock repurchase at the market price cannot change the stock price, right? Remember the NPV idea. NPV and stock prices are the same thing as we learned in Corporate Finance 1, right? So what we learned is that if a company buys back shares at the market price, the NPV should be 0, right? The company can only increase the stock price if they manage to buy the shares for a deal, right? If you buy the shares on the cheap, obviously, you know, that's going to be a good deal. But think about the other side. Who would sell, right? Who is going to be willing to sell shares at a cheap price? Most likely they're going to pay a market price, right? So the NPV of the stock repurchase should, to a first approximation, should be 0. Remember, same idea we talked about in Module 1 when we were thinking about issuing debt and issuing equity. Let's think now about dividends. Suppose a company decides to double the amount of dividends that it pays to investors. What's going to be the NPV? Let me give you a specific example, an example from the real world. Let's say that PepsiCo, right? This is PepsiCo, the company we talked about in Corporate Finance 1. It is paying $4 billion here of dividends currently, okay? Let's say that PepsiCo decides to double its annual dividends from $4 billion to $8 billion. Shareholders might love this, right? You know, you're going to receive $4 billion additional dollars annually, right? But, you know, but the money is not free, right? The dividend has to come from somewhere. If PepsiCo pays $4 billion additional dollars in dividends, you're going to have $4 billion less in cash. The net effect is 0, okay? So that's how I like to think about dividends. Dividends is just moving cash from one pocket to the other. You take cash from one pocket and move to the other. Investors own that cash no matter if it is in the company or, you know, the left pocket, or if it's in your pocket, the right pocket, okay? Equity investors will still own that cash, right? Meaning that moving cash from one pocket to the other, paying a dividend, really shouldn't have any effect, okay? So what we've seen so far is, you know, very similar to Module 1. You know, there should be no mechanical effect, right? Paying a dividend or doing a stock repurchase is a transaction that, in principle, shouldn't create any value. And again, we can look at evidence. What happens to stock prices, right? We have, you know, instances in the real world when companies decide to change payout policy. We can look at what happens to their stock prices when they increase dividends or when they do a stock repurchase. We're bringing back our researcher to show us the data, right? Let's look at dividends first. This paper by Bernardi, Michaeli, and Taylor was written in '97. What they find is that stock prices tend to increase by 1.3% following the announcement of a large increase in dividends. So this is an announcement return around the day that a company announces an increase in dividend. By the same token, stock prices tend to decrease by 2.5% when companies announce that dividends will decrease. Okay? So it doesn't look like this is 0 NPV, you know, the value is actually changing following a change in dividends. Same thing for dividend initiations and omissions. If the first time a company announces it's going to pay a dividend, on average, stock prices go up by 3.4%. If a company omits a dividend, if you use it to pay a dividend and you tell investors you're cutting it to 0, your stock price is going to tank. It goes down by 7%. That's another paper by Michaeli, Taylor, and another co-author. Okay? Repurchase. This data is data that I compiled myself. The evidence on repurchase announcements was kind of old, and I just wanted to see what was happening more recently. So a few years ago, I did this table myself. This is not really published. It's just something I use for my class. But you can look at all the events of stock repurchase announcements in the marketplace between '99 and 2010. And then at the bottom here, I computed the average market reaction to these repurchase announcements. what we see is very similar to dividends. When companies announce a new stock repurchase, their stock prices go up on average by 1.54%. Bottom line, both dividends and repurchase increase the company's stock price in the real world, which is not consistent with the zero NPV argument we learned. So what we're going to learn next is why do dividends and repurchase actually matter in practice, in the real world. What we learned so far is that dividends and repurchase should be zero NPV, but they are not. Paying dividends, doing stock repurchase do change companies' stock prices. So now what we're going to talk about is why is this the case, right? So why do dividends and repurchase matter in the real world? There are 4 arguments that we're going to discuss related to taxes, signaling of information, cash management, and earnings management. Let's start with taxes. As we learned already when we're talking about capital structure, investors will typically pay taxes, personal taxes, when they receive dividends or when they sell shares that they own, either back to the company. Really what happens is that if a company repurchases shares, the company will be buying back shares in the market. You're not buying shares directly from any specific investor. So a stock repurchase means that somebody is selling shares, right? So this will generate taxes. For dividends, it's fairly straightforward, as I have here in this table, right? So for example, if PepsiCo pays a $4 billion dividend to investors, it's going to be taxed. The current tax rate in the US is 20%. So your $4 billion is going to turn into $3.2 billion. The government is going to take some of it. It's not clear what the tax rate on repurchases is. It's a bit complicated because the actual tax rate depends on the taxable gain, okay, which is the amount you sell it for minus the cost basis. The cost basis is a number that depends on the price. You can think of it as the price you paid for a share. If it was only one share, the cost basis is the price you paid for that share, and the taxable gain is the price you sell for minus the cost basis. In the real world, there are lots of complications about how this tax is computed. The maximum tax rate in US is also 20%. It's the capital gains tax for wealthy investors. If PepsiCo, instead of paying dividends and repurchasing shares, right, so as we learned, both generate taxes. What if PepsiCo had done nothing, paid 0 dividends and repurchased 0 shares? What would have happened to personal taxes? Here's the answer, right? PepsiCo would have saved a lot in taxes for investors if it had retained the cash, right? So this table summarizes everything. Dividends generate a tax rate of 20%, right? PepsiCo was doing doing $5 billion in stock repurchase during 2015, and investors were paying a tax rate. We're not sure exactly how much because it depends on the cost basis, but it's positive. I mean, it wouldn't be 0, so investors are paying tax when they sell shares, so they would get less than $5 billion, right? If PepsiCo had retained the cash, then investors wouldn't have paid any of these taxes to a first approximation, so PepsiCo would have saved a lot in taxes. Bottom line is, taxes are not going to help us explain why companies pay out cash. It actually goes the other way. From a tax management point of view, it's typically better to have companies retain cash. And then you let investors choose. If investors want to get some cash back, they can do it by selling shares in the market. So investors choose when they want to pay taxes or not. So taxes is not going to help explain the data, by the way, right? Because the data show us that the dividends and repurchase increase stock price. So taxes is not the reason for it. But it's important to know what are the tax implications. one argument that does help is signaling. So let's think about a real-world example, right? We have this fictitious example that we talked about, that PepsiCo doubling its dividend. Here is the cash flow statement of PepsiCo that we also used in Corporate Finance 1, right? So PepsiCo is currently generating $2.9 billion in cash, right? And it's paying a dividend of $4 billion, right? It's here in the data. So what happens if PepsiCo increases its annual dividend to $8 billion, right? What happens is that now PepsiCo is going to start losing cash, right? If you pay $4 billion additional dollars in dividend, you are generating $2 billion. Now you're going to lose $2 billion in cash a year, right? So what information would this convey to investors? For PepsiCo to do that, right? For PepsiCo to be able to commit to a $4 billion dividend, it must be the case that the company is very confident about its ability to generate cash in the future. The only situation in which a PepsiCo CFO, would do something like that is if you're sure that the PepsiCo is going to generate a lot more cash in the future than what it's generating today, right? So that's one possible reason why the market responds positively to dividends or repurchase, right? Spending cash, returning cash to investors is a positive signal about the company's ability to generate cash internally, right? So that's one possible explanation. And then there is cash management, right? So we talked about the possibility that PepsiCo might retain cash. So suppose you're thinking only about taxes, right? So PepsiCo decides to retain cash because it doesn't want investors to pay taxes. What will happen, of course, is retained earnings, right? If you don't pay any dividends and repurchase, everything is going to go to retained earnings. This cash is going to start accumulating in the balance sheet. What happens then? What happens when companies start accumulating too much cash? Again, we're going to bring our researcher to help guide us. People have done research on this. In fact, there is a classic paper by Jared Harford written in 1999 that shows that essentially the idea that cash burns a hole in the pocket. Okay? When companies have too much cash, they end up doing wrong things. For example, acquisitions. Harford shows us that cash-rich companies are more likely to attempt acquisitions, but also that these acquisitions end up destroying shareholder value. So these are bad acquisitions. Okay? Cash-rich acquirers destroy 7 cents in value for each dollar of excess cash that they carry in the balance sheet. So cash burns a hole in the pocket. It causes managers to engage in bad deals. We are going to go back to this argument in Module 4 when we talk about the financing of M&A. We are again going to talk about this relation between cash and M&A, which is a very important topic. But for now, the key idea is that paying out cash may be a way to control this overspending, right? If companies end up having too much cash, they may overspend it in bad acquisitions, for example. So one way to control this behavior is by giving the cash back to investors. That argument, by the way, works both for repurchase and for dividends. Both are ways to return cash to investors, get the cash out of the company, stop managers from over-investing in bad projects. We have pretty solid arguments for why companies should pay out cash. We just talked about a few of them, like signaling, cash management, but we haven't talked about how they should do it. We haven't talked about the choice between dividends or stock repurchase. That's the topic of this lesson. Okay? Let's start with data. What you show here, or what you see here, is what has happened to payout policy from the beginning of the 1970s up to recent dates using US data. So this is for the US. The blue line shows you the total payout as a fraction of net income. you can see that this line is around 20 to 25%, fairly stable. Companies were paying back 20 to 25% of their cash to investors. What has happened in the data, though, is that the red line has decreased. The red line is the dividends, right? In the 70s, almost everything was dividends, so companies used it mostly or almost exclusively dividends to return cash to investors. But more recently, share repurchase have picked up. In the current days, repurchase and dividends are equally important. Okay? So that's the summary. It seems that now both repurchase and dividends are equally important, so companies are doing more and more stock repurchase and cutting dividends, paying fewer dividends, and keeping this 20 to 25% payout ratio fairly stable over time. Let's think about the arguments we learned to try to think about, does this make sense? In terms of taxes, right? What we discussed is that repurchases are almost surely going to generate fewer taxes for investors. Investors, for one thing, they don't need to sell the stock if they're going to face a very high taxable gain, if they face a very high marginal tax rate, right? With dividends, there's no choice. If you pay a dividend, all the investors are going to have to pay taxes. So even though both have the same statutory tax rate of 20%, what academic researchers believe is that the stock repurchase is going to minimize taxes. So that might be one reason why repurchases have picked up. Let's think about signaling. As we discussed, one reason to pay out, one reason to return cash to investors is to signal that you're confident about the future, you're confident about your ability to generate cash. Right? Repurchase is going to have an additional role, though. Consider a situation when a company believes the stock price is too low, right? So there is some violation of market efficiency. The stock price is $80, but the company believes it should be $85. What the company can do is it can signal that to the market by telling the market that it's willing to buy stock at $80, right? The company goes in the market and says, I'm willing to pay $80. That is going to signal to the market that the stock price may be too low. The company wants to buy back, so maybe we should increase the stock price. And notice that the difference here is that there is no such effect with dividends, right? Both spend cash, but the dividend goes to everybody, and there is no stock price associated with the dividend payment, right? So the dividend cannot signal that the stock price is too low. Here there is an advantage for stock repurchase. Let me talk about another argument that it's a reason why companies do repurchases in the real world. This one is not a reason that I think makes sense from a welfare, from a society point of view, but there is evidence that it does happen, which is earnings management. Okay? Repurchases are going to allow a company to manage earnings. Specifically, repurchases allow companies to increase earnings per share. Earnings per share are calculated as earnings divided by shares outstanding. And what will happen for most companies in the data, what will happen is that a stock repurchase is going to mechanically increase your earnings per share, whereas dividends is not going to have any effect. Okay? Let me give you an example. Suppose that the consensus analyst EPS forecast for next quarter is $3 a share. So analysts are forecasting EPS, right? They believe that the company is going to produce an EPS of $3 a share. But the company CFO realizes that your EPS is actually going to be 2.98 instead. Maybe your profits are going to come a little bit short, right? So you're not going to be able to meet the analyst forecast. What should the CFO do? One possible answer is that the CFO might repurchase shares. This is exactly what I showed in a recent paper co-authored with Foss and Kronlund. What we've shown is that companies that expect to fall just short of the analyst forecast are much more likely to repurchase shares than companies that meet the analyst forecast without doing a repurchase. This is what this graph shows. 0 here, you can think of 0 as the point at which companies were going to miss the analyst forecast. So companies that are just to the left of missing the forecast are much more likely to repurchase shares than companies that are just to the right. So that is unequivocal evidence, we believe, that EPS management drives stock repurchase. What we also find is that 37% of all stock repurchase are conducted by companies that are just about to miss EPS targets. We also find that companies are more likely to do this when compensation depends on EPS targets, right? EPS is a common way to set bonuses plans in companies, for example. And the same companies that do stock repurchase, they end up reducing investments and employment following this repurchase. So our interpretation of this evidence is that it's actually a little bit troubling, right? As we learned already in corporate finance in this course, we really shouldn't be focusing so much on earnings per share. But what happens in practice is that analysts forecast earnings per share, meeting your EPS target that seems to matter, right? And one way that companies do this is by using stock repurchase, okay? Even if it causes them to reduce employment, for example. Let's go back to our question, dividends or repurchase, right? So this is like a race. We've been running a race here, right? We talked about 4 different arguments: taxes, signaling, earnings management, cash management. Here is the result of the race. You know, repurchases win on almost everything: taxes, signaling, earnings management, cash management, right? The only one that is possibly a tie is cash management, actually. Like both repurchase and dividends are ways of returning cash to investors. All you need to do is to get the cash out of the company, okay? This is why academics like to think of the dividend puzzle. We saw the data. Companies have been decreasing dividends over time and doing more repurchase. You know, that makes sense when you think about these arguments, but dividends haven't decreased to 0. Companies still pay dividends. The recent data shows that dividend and repurchase are equally important, right? We don't really know. We don't really have a great story for why companies pay dividends. That's an interesting, right? You might think that dividend is an obvious thing. Once you dig deep and think about why should a company pay dividend, we actually end up with the opposite conclusion. The dividend doesn't make any sense, right? So finance is very interesting this way, right? Maybe one explanation is due to behavioral reasons. Maybe it's simply the fact that investors like dividends. They think dividends matter, so companies have to pay dividend for that reason. It's an inefficient market kind of explanation. A related explanation that also sort of relies on inefficient markets, but is a little bit more sophisticated, and this is actually a story I heard directly from company CFOs telling me that that's the reason why they might not do stock repurchase. So let me give you the argument here. Let's take PepsiCo. Suppose that PepsiCo spends $5 billion to repurchase stock at, let's say, $94 a share. That's the current PepsiCo stock price. But in the following year, the market tanks. There is a minus 20% negative return in the market. As we saw in Module 1 of, in Corporate Finance 1, PepsiCo's beta was approximately 0.5, right? So we would expect PepsiCo stock to go down by 10%. Market goes down 20, Pepsi goes down by 10%, right? So now the stock price is 84.5. The CFO repurchased shares at $94. The stock price is now 84.5. So here's a question for you. Should the CFO be blamed for having repurchased the stock at a high price? No, right? Nobody should be able to predict the stock market. The reason why PepsiCo stock price went down is because the market went down. It has nothing to do with the company. However, this is the argument that CFOs told me when I was in a conference once and we were discussing why do companies pay dividends, do stock repurchase. One argument they gave me is that they are very concerned about doing stock repurchase and then seeing the market go down, the CFOs get blamed anyway, right? Even if the decrease in the stock price has nothing to do with the company, if it's all driven by the market, they still get blamed for having repurchased stock at a high price. So that's kind of a market risk story, right? Repurchase expose companies to the risk of buying stock at a high price, and it may well be a reason why, you know, companies have moved completely away from dividends and into stock repurchase. They've done some of that, as we've shown in the data, but they haven't gone the whole way. That might be because of this market risk story. In this model, we talked about different aspects of debt financing that matter for real-world companies for corporate financing practice. For example, we talked about how to price debt securities and specifically how to relate changes in yield to maturities to default probabilities, pricing. We also talked about credit ratings, what determines credit ratings, and specifically why are credit ratings so important for financial managers. Then we talked about credit default swaps, which is a very important market instrument that allows participants to trade the risk of default, and we discussed why credit default swaps affect companies' bankruptcy risk, why companies should care about credit default swaps. Then we went into the details of that structure for a few companies to be able to distinguish between different types of debt, such as commercial paper, capital leases, bonds, bank financing. And we talked about why are these different types of debt different, thinking, for example, about seniority, collateral, and covenants, right? And the idea is that seniority, collateral, and covenants are as important as pricing for debt financing. In fact, we talked about how companies choose between bank and market financing, and the argument was that bank financing would probably allow the company to borrow at a cheaper rate, but it's not going to come free, right? It's going to give additional control to the bank. Then we moved to payout. Payout policy is the mirror image of borrowing money, of bringing cash from investors, right? And what we used is some of the same ideas we had talked about in Module 1 to avoid making mistakes when evaluating the impact of dividends and repurchase on firm value. There should be no mechanical effect of paying a dividend or doing a stock repurchase. We also learned how to identify the key effects of why dividends and repurchase matter for firm value. We talked about taxes, signaling, cash management, and why companies should actually care and should try to optimize their payout policy. And then we ended by discussing the differences between dividends and repurchase and how companies should choose between dividends and stock repurchases. This is a quick introduction to assignment 1, which has some open questions and a couple of numerical problems. The goal of the open questions is to allow you to discuss some of the ideas of the module in your own words, try to explain some of these ideas using your words and see how you do. And let me talk a little bit about the goals for the 2 numerical problems. The question 6 is about bank versus bond financing. In Module 2, we discussed how bank financing allows firms to reduce interest rates by giving additional guarantees. What question 6 will allow you to do is to see how recovery rates and interest rates are mechanically related. Bank financing is going to increase recovery rates and reduce interest rates. So you can show that mathematically that this relationship holds. And then on question 9, we're going to study the debt structure of 2 companies in the same industry. In this case, it's the food industry, Starbucks and Panera Bread. So we're going to analyze these 2 debt structures and apply what you learned in Module 2 to compare these 2 companies. All the data that you need is going to be available in Coursera. The data is not going to be processed. The data is going to be in raw format, just as you would find it in any source. So you have to look through it and sort it and try to find the information that you need. That's part of the goal of the assignment. I will give you a solution as before, but of course, you should make sure you work on the assignment, prepare your solution before you see mine. Let's go through the solution of assignment 1. The first question is about this notion of cheap debt. Right? So you might think that low interest rate means that debt is cheap, but one issue that we learned in Module 1 is that that's not necessarily the case. Right? If you pay low interest rates on your debt, those interest rates might also reduce discount rates, especially if the reduction in interest rates comes from the government. Right? So if government rates are low, that's going to reduce interest payments, but those interest payments are also going to be discounted at lower rates. So the NPV of the debt issuance may actually not necessarily change, as we discussed in Module 1. In many cases, the net present value of debt issuance is actually going to be close to 0. Okay? On the other hand, two other issues that you might have talked about in your answer are that, first of all, the fact that interest rates are low allow firms to increase their interest coverage ratios. And as we discussed in this module, companies care about credit ratings, right? Having a high interest coverage ratio might allow companies to achieve a higher credit rating, and that might matter, right? The second consideration is that while debt is 0 NPV for large companies that don't have problems raising financing, that may not be true for smaller companies that may find it more difficult to raise funds. So when interest rates are low, that might help small companies, young firms raise more debt financing, and that might matter as well. So that might be a situation in which interest rates might actually affect debt financing in the economy. Question 2 is about financial distress, right? So the idea is that financial distress might happen when your operating income, when your profits become lower than your interest rate, right? So that is, though, a trigger to financial distress, not necessarily bankruptcy, right? Companies have options. Even if they cannot pay interest, they can sell assets, for example, right? To raise cash and pay interest. They can cut investments to try to increase EBIT. They can try to refinance debt, right? Maybe reducing interest rates by refinancing that, or they can try to issue equity. What we discussed in Module 1 is that all of these options are going to be costly, right? They're going to generate a cost for companies. For example, issuing equity is going to cause the stock price to go down using the data that we have available, right? So these options are costly, but the company is not necessarily bankrupt. You should try to avoid financial distress. But you know, you're not necessarily going to go bankrupt when your EBIT becomes a little slower than your interest rate. Question 3 is actually interesting because the numbers that I pulled out are not random. They actually come from the new president's tax plan. Okay, this comes from Trump's tax plan. So that is the idea. Of course, you know, by the time I'm recording this, the plan hasn't been implemented yet, so we don't know if it's going to happen or not. But we can start thinking about what would happen to corporate policies if tax rates change like that. So we talked about capital structure and payout, and we also discussed how taxes may affect capital structure and payout. In terms of capital structure, one of the proposals is, of course, to reduce the corporate tax rate. And if corporate tax rates are low, a side effect of this is that companies should have less incentive to borrow money, right? Because the tax benefits of debt are going to be reduced. The tax benefit of debt depends on tax rates. The higher is the tax rate, the greater is the tax benefit. So we should expect to see lower leverage ratios. That would be a prediction a researcher would make. If corporate tax rates go down, we should see companies decreasing leverage. Okay? On the other hand, there is also a proposal to reduce personal taxes, and one issue we talked about in Module 1 is that a reduction in personal taxes might reduce personal tax rates on debt investors. So when investors receive payments, they're going to pay lower taxes. That may counteract the reduction in corporate taxes a little bit. But I think, as we discussed it, corporate taxes tend to dominate personal tax effects, so we should see lower leverage. So that might be a positive aspect of having these changes in tax rates. In terms of payout, it's a little bit less obvious because corporate tax rates don't directly change payout policy. Payout policy depends on personal taxes, right? But if you think about it, personal taxes, they used to matter in the past because dividends were taxed at the personal tax rate, but now there are special tax rates for dividends and capital gains. So we really don't know what's going to happen to these specific tax rates on dividends and capital gains, and those are the ones that should matter most. So I think that should be one consideration you should have added to your answer, is that the personal tax really is not the most relevant tax when we're thinking about dividends and capital gains. However, there could be an indirect effect. So this is interesting, right? If corporate profits increase as a result of the lower taxes, as I think is the hope of the government, that companies will become more profitable and invest more, there may be an indirect effect, right? So if profitability increases, perhaps companies are going to increase payout as well. But we have to wait and see what happens. And this is kind of an open question. There were many possibilities here, and as long as you are more or less on target, it should be okay. Question 4 is about credit ratings, right? So one key idea we learned is that credit ratings matter over and above leverage ratios. So credit rating affects companies' ability to access financial markets because there are lots of regulations that restrict how insurance companies invest, how banks lend money. So a rating downgrade is a key factor. When companies consider whether to increase leverage or not, rating downgrades is going to really be in our minds. You are going to see this idea applied again in Module 4, right, which is when we're really going to use real-world examples of acquisitions and both strategic and private equity to think about whether companies should change leverage or not, and we'll talk about this rating downgrade idea further later in the course. Question 5 is about bank debt, right? So the idea is that bank debt is likely to be cheaper than market financing, but the reduction is because the bank has additional control. So the central trade-off about bank debt is that companies might be able to reduce interest payments, but that is going to come at a cost of giving additional control to investors. So companies are going to have to comply with a larger number of covenants. Companies are going to have to post collateral. So companies that are very financially healthy may choose not to do that and move away from bank debt to bonds. And here's another question on banks versus bond financing, a more mathematical question. And we talked about the notion that recovery rates and interest rates are related, and I think this example really allows you to calculate that on your own. So here is the same chart we used in class in the videos, and so we have the situation where the bank is lending money today, and then there are two outcomes. There is a 5% interest rate, but the idea is that the bank is only going to get the interest paid if the company does not default. If the company defaults, then there is recovery. Given that the bank has 80% recovery, the return here is going to be minus 20%, right? So using the formula that we derive it in the module, we can figure out the expected return. The expected return is 1 minus the probability of default times 5% plus the probability of default times minus 20%. Okay, and in the question I told you that the expected return is 4.25. Right? We don't know the P, so the math here would be to back out what the P should be, and it's a linear, it should be quite straightforward. You can even do this by trial and error in Excel. You would find out that the probability of default is 3%. Moving on to the bond, the key thing to realize is that bonds have lower recovery rates when compared to bank debt. That's one of the key things we discussed in this module. What this means is if the company defaults on the bondholder will realize a lower return, right, with 3% probability, which is the probability of default. The bondholders will have a minus 60% return, basically reflecting the fact that they only recover 40% of their investment. Okay? So what the question is asking you to do is to figure out, given this, right, what should be the interest rate that bondholders demand? Given that they have to have an expected return of 4.25%, what is the X, right? How much is, what's going to be the yield to maturity on the bond? What's going to be the interest rate? And if you do the algebra is here for you to see, you will realize that the x is going to be 6.24%. Okay, so just doing algebra solving for the x, you get that answer. To summarize then, what this question shows you is how recovery rates are directly related to interest rates, right? For in the case of bank debt, because the bank achieves a higher recovery rate, the bank can charge you a lower interest rate, right? The bank is going to lose less if the company defaults, so the interest rate is 5%. Because bondholders have lower recovery, the interest rate is going to increase to 6.24%. All right, so here's a summary. Essentially, banks have a lower interest rate because they have greater recovery. Question 7 is about dilution, right? So it's one of the key ideas in this course. Dilution is an illusion. The number of shares outstanding is irrelevant, okay? So we talked about this in the videos. To reduce shares to a repurchase, the company has to spend cash. Right? So it's not a free transaction. And if the shares are priced at a fair value, in fact, what should happen is the reduction in cash should exactly compensate the reduction in shares outstanding, and the NPV should be 0. So really, dilution or avoiding dilution or reducing dilution is not the reason why stock repurchase increase the stock price. This is something that I really would like you to remember after you go through this course. Question 8 asks you to discuss the dividend puzzle, right? Which is one of the key issues that academics are thinking about. Actually, currently, this is one of the key research topics recently. We're trying to better understand why dividends have survived, right? There is no, as we discussed it in the lecture, the reason why there is a dividend puzzle is because there is no clear reason why firms need to pay dividends. Most of the advantages of dividends can be perfectly replicated using stock repurchase, and stock repurchase are likely to be more tax efficient. So this is something that I think we'll learn more in the future. Why is it that dividends are so important for companies? It's, right now it's a puzzle. Question 9 and 10 are about the real-world data of Starbucks and Panera Bread. So what I ask you to do is just to go over the Excel spreadsheets that I posted in Coursera and figure this out. It shouldn't have been too hard to see that Starbucks has mostly borrows from the bond market, right? So as many large public companies, what Starbucks does is avoid having term loans, so it's actually 0 here, raises most of its debt from the bond market, right? It has an undrawn credit line, right? So the only role of bank financing for Starbucks is to provide this credit line, but the company is not really using it, right? The credit line is really used for companies for insurance purposes, as we discussed in Module 2, right? And we discussed this before in Corporate Finance 1 as well. It's one of the key ideas of financing is that, the credit line has this insurance role for companies. If all the other sources dry out, presumably Starbucks can still rely on the credit line, right? So here is the data on the yields, right? Just for us to compare later with the bank loans or to think about what should Panera be paying. Some recent data on bonds issued by Starbucks, you'll see that for the bond that matures in 2018, the yield is 1.5%. For bonds that mature, a couple years ahead, the yields are between 2.2, 2.5%. Starbucks has a rating of A-. And here comes Panera Bread, right? The key contrast is similar to what we did in the lecture. Panera raises most of its debt from term loans, right? It's a smaller company, that perhaps riskier, right? And what it does to mitigate the financing issues is that it raises bank debt instead of bonds, right? You can see, for example, that most of the debt is actually secured, right? Panera has both term loans and it's drawing down on a credit line. It has an undrawn credit of $210 and it has drawn $40 million from its credit line, right? So if you think about interest rates, right? It's interesting because Panera is smaller and it also has higher leverage, right? If you're thinking about leverage ratios, right? you know, the leverage ratio of Starbucks is actually pretty close to zero. It has only $3.6 billion in debt and $83 billion in equity, right? Whereas Panera has, you know, a leverage ratio of about 10%. It's not super high, but it's higher than Starbucks, right? However, you know, because Starbucks borrows from the bond market and Panera borrows from bonds, from banks, right? Starbucks bonds, Panera bank. What I would actually predict is that interest rates should not be higher for Panera. In fact, you know, perhaps Panera is paying even lower interest rates than Starbucks. And what I didn't give you this data. This was supposed to be the surprise of the solution. I actually got some data on loans issued by Panera. This is recent data on the coupon payment of the recent loans that were issued by the company, and you can see that they were around 1.5%. The maturity is close to the maturity of the Starbucks bonds that we looked at, maybe a little bit shorter. Okay. One issue you can see that this is a floating rate bond, okay? So this coupon is not fixed over time. It's going to change. It might change with the changing benchmark. So right now we are in times when interest rates are going up. It might be the case that Panera may actually have to pay a higher interest rate going forward. But it is, right now it's paying 1.5%. So it's consistent with the ideas that we discussed in the course. This module is about managing risk. Companies can use financial instruments such as futures, forwards, options to reduce or reallocate risks to other parties. What we're going to talk about in this module is how they can use these traded contracts to reallocate risk in a way that increases shareholder value. We're going to talk about that, but we're also going to talk about other mechanisms that companies can use to reallocate risk when they cannot use traded contracts. A key idea that we're going to learn is that companies can in some cases, use alternative mechanisms such as liquidity, supply contracts, and operational hedging to achieve the same goals that they would achieve with a traded contract like a futures. The idea of reducing or reallocating risk is what we call hedging. It's a major component of modern financial management. That's a lot. CFOs spend a lot of their time thinking about risk management, hedging, how to reduce risks, how to reallocate risks. So this is a key component of a modern corporate finance course. In terms of specific topics, we're going to talk about how to identify right and wrong reasons to hedge. What are the reasons that truly increase shareholder value, and what are the ways that companies can in fact destroy shareholder value by using futures, for example, in the wrong way. So we're going to talk about that, and then, like I said, we're going to discuss how to use these specific contracts to hedge risks. In particular, we're going to talk about this idea of speculation. Right? When you think about derivatives such as forwards, futures contract, this might bring to mind this idea of speculation. Companies can also use these securities to speculate, and we're going to learn how to distinguish hedging from speculation, right? And how to think about hedging in a way that increases shareholder value. We will also learn what to do when target risk cannot be eliminated using derivatives. For example, using liquidity management as a substitute, or bilateral contracts, or operational hedging. All of these possibilities are available for companies to mitigate risks such as currency risk, for example, when futures and forwards cannot be used. Finally, we're going to talk about currency risk more deeply. We're going to think about how hedged and unhedged currency risk may affect the company's cost of capital. This is an important topic because it will help determine how companies should adjust their cost of capital when investing in international projects. In a globalized world, it is increasingly important to be able to think about how globalization, how international projects how multinationals should adjust their cost of capital to address foreign risks such as currency risks and other risks. The first question we need to talk about is why hedge? Why do this at all? We're going to talk about good reasons and bad reasons to hedge. Let's start with the bad reasons. Okay? And the way I'm going to do this is just propose a few arguments. Some of them might actually make sense when you think of them, but if you take more time to really think about it and use your financial knowledge, you're going to see that the arguments don't make sense. Let me start with this one. Suppose your company is in a cyclical business, so your profits are very volatile. The company is then thinking about using derivatives to smooth out fluctuations in profits. Low risk is good, right? What's wrong with this argument? It's wrong because reducing volatility, is not going to increase shareholder value. Why? Because shareholders can do this on their own, right? If they hold stock of your company, shareholders can diversify risks by buying stock in another company, right? So if shareholders can do it on their own, the company has no business to be, reducing volatility. In fact, taking risk is the reason why companies exist. Companies are not going to create value if they don't take risk, right? No risk, no return. Reducing risks cannot be the goal of a company. So reducing volatility is not the right reason to hedge. We're going to need a little bit more sophisticated arguments to understand why companies hedge. Before we get there, let's talk about a few other motivations that are wrong. For example, suppose your company uses steel as an input. So you might think, you know a lot about the steel market. So you think that you're confident that steel prices are going to continue to go down, right? So what you're proposing is that your company should go to a futures exchange and short steel. Short means sell, basically, right? So you sell steel now, the price goes down, you make money. You're making money, seems good. What's wrong? It's wrong because this is speculation. It's not hedging, okay? Companies should try to produce value from the products that they make. So if you're using steel as an input, what you want to do is you want to sell your product at a high price. You want to make a good product, right? You should not be betting on the steel market. If the company CFO wants to do that, my proposal is that the CFO should move to Wall Street. That's where, that's the picture here. If you want to take risk, move to an investment bank. That's where you can take, you can trade, try to make profits out of things like steel futures. A company is not the right place to do that, okay? What are the good reasons to hedge? There are 3 reasons we're going to talk about here. The first one is to be able to choose which risks the company wants to take. The second one is eliminating risks outside of the company's control, which is related but a little bit different. The third one is to reduce the risk of financial distress. So these are all valid reasons that corporate finance theory has proposed and that make sense both in theory and in practice. First one, suppose, for example, that you work for a US company that wants to open a new branch in India. Doesn't matter what the product is. Let's say that there is a lot of demand for the product in India, so you want to sell there. However, selling in India means that you're going to be exposed to exchange rate risk. You're going to sell in Indian currency. Your shareholders are in the US, so now you're going to have currency risk. If the value of the Indian currency changes, that might change your profits, right? So the CFO of this company might want to reduce exposure to the Indian currency by hedging currency risk. Think about what the company is doing. The company is choosing the exposure. It's not that you want to reduce risk. Probably going to India is a very risky business, right? You're taking a lot of risk, but you're choosing which risk to take. You want exposure to the Indian market. You want to sell in India. You don't necessarily want exposure to Indian currency. So you can go to the futures market and eliminate that particular risk while at the same time maintaining your exposure to the Indian market. That's what we mean by choosing risks. That is a very powerful, valid, practical reason to hedge. Remember that, choosing risks. A company may also want to eliminate risks that are outside of the company's control. Let me give you an example. Suppose we have an airline. The airline, of course, is going to be sensitive. Airline profits are going to be sensitive to oil prices, right? So what the airline CFO is proposing is that they should engage in a hedging strategy because they would like their profits to better reflect the number of tickets that the airline sells. You know, how much the customers like the airline. They don't want the profits to reflect variation in oil prices. It's a risk outside of the company's control. That can be very valuable, for example, for executive compensation. We know that the CEOs, CFOs even, right, are paid depending on bonuses and stock. So CEO compensation is going to go up if the company is doing well. But if an airline is doing well because the oil price went down, maybe we shouldn't pay more to the CFO, right? The CFO should just make money if the airline sells more tickets, but the CFO compensation should not really be tied to oil prices. Again, using the futures market or another hedging tool may be a way to eliminate this particular risk. You still have risk, right, because you are exposed to the tickets, right? So your profits are going to depend on how many tickets you sell, but they're no longer going to depend on oil prices. Good reason to hedge. Finally, let's go back to the notion of financial distress that we talked about in Module 1 of Corporate Finance 2. Suppose now your airline is highly levered. That actually happens fairly commonly. Airlines have gone bankrupt a few times already, even the big ones like American Airlines, right? So profits are decreasing, your airline is highly levered. So now the idea is the airline is going to hedge oil prices to avoid becoming financially distressed. If oil prices increase further, your profits are going to go down, you're going to get closer to financial distress, right? We learned that financial distress reduces value. That's what we learned in Module 1, right? So let's think about that. Let's think about these two scenarios here, right? So low profits, high profits. Essentially, this depends on oil prices, right? If oil prices go up, if the oil prices are high, then you're going to have low profits. If oil prices are low, you're going to have high profits, right? Suppose the airline has no debt. Should it hedge oil prices? That's the question I have for you. You have no debt, okay? So you're not highly levered, you have no debt. Should you hedge oil prices or not? The answer is that, in this case, not necessarily, right? As we mentioned before, the volatility of profits are going to decrease, right? But maybe shareholders don't care. They could do it on their own, right? By buying stocks that are not sensitive to oil price. Or maybe shareholders can buy a stock that goes up if the oil price goes up. They can buy stock on an oil company, right? Maybe the company could do it so that profits don't reflect oil prices, as we mentioned. It might be because of executive compensation, right? But suppose now that the airline is highly levered, that's going to completely change the picture, right? Because now, if oil prices are high, right, in this situation where oil prices are high, your profits are low, what may happen is that the airline may not be able to repay the debt, right? That's what we're talking about here. This situation, high oil prices, low profits, what might happen is you might become financially distressed, right? If the oil price increases and that increase causes financial distress, this is again going to be a good reason to hedge oil price risk. Even if you're not concerned about executive compensation, you may want to eliminate volatility when you're getting closer to financial distress. Let's talk about how companies can use traded securities to hedge. in some cases, there are going to be securities that trade in financial markets or that are traded over the counter that are going to allow companies to hedge. We're thinking of futures and forwards mostly, right? Those are the main securities, the main derivatives that companies use for hedging in the real world. They are available, for example, for risks such as currency risk, commodity risk, and interest rates. Okay? Let's talk about a forward. That's the first contract we're going to talk about. A forward contract is an obligation to exchange an asset at a future date, but at a pre-specified price. So the idea is you fix the price today, and then you agree to exchange the asset in the future. So for example, it can be written on currency. You might agree with your counterparty to exchange dollars for pounds in 6 months, right? What you do today is you write a contract. You don't have to exchange any cash today. There's no cash exchange today. When the maturity comes, the two counterparties have to settle the contract. You call your counterparty and say, look, we have to close the deal. I'll give you X, you give me Y, we're done. Very simple, right? Let me give you some data and then talk about a specific example. Suppose we are in December 30th, 2014. You'll see later why I chose this particular date. We have data here from the Financial Times. The Financial Times used it to post these forward dates, this forward data. I think it's actually not there anymore, but you have a snapshot here. So here you have in the first columns you have the current exchange rates that were current at that time, December 30, 2014, and then you start seeing the forwards. This table shows that there are 1 month forward, 3 month forward contracts, and 12-month, 1-year forward contracts that companies can buy from a counterparty in the market. And it also gives you the specific values that people can trade these forwards. It's not just companies, right? Financial institutions, anybody in principle could access this market. Okay? So let me give you a specific example that I'm pulling out from this table, and you can check the data to make sure that this is right. Okay? Suppose that it is December 14 and we need to make a payment of 200 million rubles to a Russian supplier in December 2015. Right? So we have to make this pre-specified payment. We know it's 200 million rubles, but the payment is in rubles, right? That means the U.S. company is going to face some currency risk, right? The specific risk is that the ruble may appreciate against the dollar. If the ruble appreciates, right, that means that the value of the payment in dollars is going to go up. The U.S. company is going to have to spend more dollars to buy rubles. You could choose not to bear this risk, right? That's one possibility. But, if you want to do that, you can eliminate this risk using currency forwards. It's pretty straightforward to do this. Looking at the data that I just gave you, we know that a 1-year forward contract for rubles was worth 64.885 rubles at that time. Okay? So what the company would do is it would buy a forward contract today, right? So you would write a contract, it's a piece of paper, okay, for delivery of 200 million rubles in 1 year. You would agree with the bank, in 1 year the bank would give you 200 million rubles, and you would fix the price at 64.885. The price is fixed. In 1 year, right, essentially, what the U.S. company will do is pay a certain amount of dollars, which we can actually calculate here, is $3.082 million. In exchange for that, the bank would give you 200 million rubles, right? So, and that transaction will happen irrespective of the future exchange rate. No matter what happens to the ruble, you're going to transact at that specific exchange rate. So essentially what you're doing is you're locking in the payment, right? Now the U.S. company knows that you're going to pay $3.08 million. Doesn't matter what happens to the ruble anymore. That's the beauty of hedging, right? You have eliminated currency risk, right? Forwards are beautiful, but what's the problem, right? The problem is that the forward is going to have some settlement risk. think about this, right? So it's essentially a piece of paper. There's no cash exchange today. There's no guarantee, right? It's just a piece, it's a promise. This is really a promise. It's just a promise that the two counterparties make. So the forward contract is only going to work if both parties are reliable, okay? If there is a lot of settlement risk, if one of the parties might default on the contract, then the forward contract is going to become less reliable. If the forward contract is going to become less attractive for the company, because the bank, for example, may not be relied upon to give you the 200 million rubles. We'll talk about next what companies can do in that case. Now we're going to talk about futures. The main difference between futures and forwards is that futures are traded in an exchange. We're moving the derivative contract to an exchange. If you look at this picture, you'll see that George Bush, our former president, is actually there. Of course, he's not a trader. He was just visiting the Chicago Board of Trade that day, so it's kind of a fun picture to start this lesson. So what's the futures contract? The main motivation of a futures contract is to solve the settlement risk problem that we just talked about. It's going to achieve the same thing as a forward in a way that it mitigates or almost completely eliminates the settlement risk. How will it do that? First of all, it's going to be a standardized contract. It's no longer a contract, a piece of paper that you write with a counterparty. It's going to be a standardized contract that trades in an exchange, right? This is going to trade on a futures exchange. So the futures exchange is going to be responsible to honor the contract. If one of the parties default, the futures exchange is now responsible for it, okay? In order to protect itself, what the exchange does is to open a margin account. So in order for you to buy or sell a futures contract in an exchange, what you're basically going to have to do is to deposit some cash. We're going to give an example later exactly how the margin account works, but the idea is that if you want to hedge using futures, you have to give some cash to the exchange and put it in a margin account. The money belongs to you, but it's going to be with the exchange until the contract expires. And then the exchange is going to assume the settlement risk. Here's some data on futures. These are futures on British pound, okay? This data now comes from September 2016, so it's a little bit more recent than the other data that I gave you. And you see that there are futures contracts that allow you to buy and sell British pounds for all of these dates. You know, there are probably even more futures contracts, but let's talk about at least these ones. So you could buy a futures for December 16, March 17, June 17, September 17, again at a specific price. The settlement, the settle row column there gives you what are the current prices at which you can buy and sell pounds in the futures exchange. So how would a company use this market to hedge? Okay, suppose it's now October 2016. And now we have a US company that expects to receive a payment of 1 million pounds in approximately 1 year, September 17. Okay, so our previous example, the US company was making a payment in rubles. Now you're going to receive a payment of 1 million pounds. How can the US company eliminate this currency risk? Now we have the opposite position, right? So you're long on pounds because you're going to receive pounds. So if you're going to trade a future to eliminate that risk, what you need to do is you need to sell pounds. The word that we use in finance is actually a short, okay? Because you don't need to have the pounds today, right? You need 0 pounds to do this today. You're going to write a contract. In 1 year, you're going to have to come up with the pounds to close the contract, okay? So that's why we call this shorting. It's selling without necessarily having the asset. Each future, as you look at that data, each future corresponds to 62,500 pounds. So if you do the math, what the US company would need to do is to short 16 of these contracts, right? And as we mentioned before, to enter this position, the CME, the Chicago Mercantile Exchange, let's say that's where you're writing this contract, the CME is going to require a cash deposit from the U.S. company. So literally what you need to do is you need to open an account with the CME. Let's say it's $100,000. So the margin account will be 10% of the position. You know, doesn't have to be just for our purposes here, okay? So the current futures price, if you look at that data, is $1.2373 per pound, right? So that's the amount that you can buy and sell pounds in 1 year, okay? So that's essentially going to be the price of the futures contract. Let's try to understand what happens now. Suppose that we are 1 month away, okay? Now it's November 2016, and the futures price has gone up to $1.3 per pound. So the pound appreciated, right? That's going to change the futures price as well. So now it's $1.3 per pound. How is that going to affect the futures position that the company holds? Let's figure that out, okay? What happened is that, you know, remember, you sold pounds, you short pounds, so the U.S. company is going to lose money in the futures position, right? You have a loss. We can actually calculate the loss here, right? It's 1.3 minus the 1.2373 that you started with, times the amount that you invested. That means you're going to lose $62,700. What the CME would do is to deduct this amount from your margin account. So now, instead of $100,000, the U.S. company only has $38,300 in the margin account, plus what we call accrued interest. The CME will pay you interest on your margin account. It's like a bank account. Just think of it as a bank account, okay? Here comes a crucial question. I really want you to think about this and try to answer. That's a very important point in this Module 3 that's coming up right now, okay? The U.S. company lost money, right? You lost money in the futures position. Should we fire the CFO? Does that mean that the CFO made a mistake by shorting the futures contract? The answer is no, no. Remember, the goal of hedging is to eliminate risk. The goal of hedging is not to bet on what's going to happen to the pound. That's actually the risk you don't want to take, right? So no matter what happens to the pound, the company is going to be okay, right? Why am I saying that? Oh, you lost money. How can you be okay? Well, remember, right? You have, you know, you're long on pounds as well because you have that payment of 1 million pounds. The value of that payment went up. And we can actually figure out that the value of the payment should have gone up by exactly the same amount, right? You have a loss of $62,700, but your payment, right? Now you essentially, you expect the pound to be at 1.3 now, right? When you receive the money, the futures went up. The futures should be a very good predictor of the future exchange rate, right? So that means you made a gain. You made an equivalent gain, right? What's your net gain? 0. That's what hedging means. When you hedge, you want to see a 0, okay? That's the goal. The goal is to eliminate, right? We want to eliminate risk. Eliminate risk means 0. Whatever happens to the currency, you have a 0 net gain. Very important point. I make sure you understand that, okay? Let me revert it. Let's say that now the CFO thinks that the UK pound will continue to appreciate, okay? So because of this, instead of shorting, the CFO is suggesting that the company buys the pound instead of shorting, right? Is the CFO right? The answer is no. The opinion of the CFO doesn't matter at all. In fact, no one can perfectly predict what's going to happen to exchange rates. It's not the CFO's job. The CFO is the chief financial officer of a company that wants to eliminate, you know, if it wants to eliminate currency risk, maybe it doesn't. But for sure, the CFO has no business taking a long position in the pounds just because the CFO thinks the pound is going to appreciate, okay? that is exactly an example of speculation, which is the opposite of hedging. It's what companies should not do. Remember this. If you want to speculate, go to Wall Street. Do not speculate with companies' money. The idea of hedging then is to neutralize the effect of a particular exposure, right? What you're searching for is this zero net gain. But what we're going to learn now is that the zero net gain may be an elusive goal, right? Companies may not be able to always achieve a zero net gain. In many cases, hedging will be imperfect. Let me give you an example. Suppose we have a company that is planning to issue commercial paper. We learned what commercial paper is, right? It's a source of short-term financing that the large real-world companies use in practice. Suppose we have this company, it's planning to issue commercial paper, but you don't have to issue it now. You have to issue it 3 months from now. The amount is 100 million. Your current commercial paper rate is 3%. What the CFO wants to do is to lock in the 3%. You don't want to be exposed to interest rate risk. How can you do that? All right? What you need to do is you have to enter an interest rate futures contract. Okay? You have to find a contract that will give you a payoff that neutralizes the effect of an increase in interest rate. Which contracts are available in this case? What the CFO will find in financial markets are either LIBOR or a US Treasury bill futures contract. In particular, there is not going to be a futures market for the commercial paper issued by this particular corporation. In fact, as far as I know, there is no futures market written in commercial paper in general. Interest rate futures are always based on a very broad contract such as LIBOR or US T-bills. What this means is that, in this case, hedging using futures is going to be imperfect. It's going to be more difficult to achieve the zero net gain, right? Let's talk about what the company should do in practice. So suppose, right, that in this case you're concerned that interest rates will go up. That's our example. Remember from bond valuation theory, right? We also talked about that in Corporate Finance 1. There is a negative relationship between prices and interest rates. So if interest rate goes up, that means the price of your debt security is going down. Given this, should the CFO buy or sell an interest rate futures contract? Remember, you're looking for a neutralization. You're looking for a zero net gain. Think about that. The answer is that you need to short the contract. You need to sell. You're looking for a position that is going to give you a profit if interest rate goes up. If interest rate goes up, prices go down, the futures price is going to decrease, meaning that the company will profit from the position, and meaning that this futures profit is going to compensate for higher interest rates. If we had the data, we could work out an example, but we don't really need to. I think you already understand how this works. Here's what I want to talk about. It's this idea of hedge ratio, because now we have imperfect hedging. We can buy a LIBOR futures or T-bill futures, but we can't buy commercial paper futures, right? So suppose that the CFO expects LIBOR, for example, to go up by 1%, right? And in that case, the CFO expects the commercial paper rate to go up by 1.5. So your expectation is that for every percentage movement in the LIBOR, the company's commercial paper rate moves by 1.5%. How can you adjust your futures position to take your expectation into account? It's easy, right? What you need to do is you need to take a larger position on LIBOR's future to compensate for the spread, right? It's a larger move. Your commercial paper moves by more, so you're going to have to open a larger position on LIBOR's future to get the right gain, right? To achieve the zero net gain if you can, right? That's what we call a hedge ratio. In financial jargon, the hedge ratio is the number of units of the futures contract that you have to hedge, that you have to buy in order to hedge 1 unit of the underlying risk. In this case, it's 1.5, right? Does that solve the company problem? So you would go and short $150 million, but is that going to solve your problem? Does that eliminate interest rate risk? The answer is no, unfortunately, right? Because the problem is the hedge ratio is going to be based on a forecast. You're essentially trying to guess what will happen to Y in this case is commercial paper, if X happens. What happens to commercial paper rates if the LIBOR changes by 1%? You have to estimate that number. You have to forecast that number. In the real world, the spread between LIBOR and commercial paper is going to be very difficult to precisely forecast. In fact, let me just give you some data here from the real world. That's the data that shows how commercial paper spreads. It's measured relative to T-bills here. So this shows how commercial paper T-bill spreads fluctuate over time. In normal periods, the spread can be fairly low, like 20 basis points. That's what it's showing here, okay? But in stress periods, like during 2008, during the financial crisis, that spread went up a lot, right? So that's what you're seeing here, is that there is very marked, very strong fluctuations in the commercial paper T-bill spread over time. So that's going to make it very difficult for a CFO to precisely forecast what's going to be that spread if you're looking now in 3 months or 6 months, right? So that's the problem, okay? What can we do about it? Imperfect hedging is going to be a feature of the real world. Unfortunately, in the real world, achieving the zero net gain is, in most cases, not going to be possible. Fortunately, companies have other tools that they can use to improve their hedging ability when futures and forwards cannot give you a good hedge. That's what we're going to talk about next. Liquidity management, operational hedging, and bilateral contracts may also help. Let's talk about these alternatives, and we're going to start with the previous example. In fact, that previous example has an almost trivial solution. Let me remind you what we're talking about. We have this company that expects to borrow in 3 months. The current rate is 3%, and the company is concerned about the risk that interest rates will go up, right? What's the trivial solution? You can issue the commercial paper today. Maybe you thought about that already, right? Why is the professor, talking about this? It seems like this is what the company should do, is borrow today. You are right. That is, in fact, the right, a good solution to this problem. What happens is, in this case, you'll pay 3%, no matter what happens to interest rates. But we're not done. What else does the company need to do if you're going to really hedge the interest rate risk? There is one more step. Here it is. The company needs to hold cash. That's why this lecture is about liquidity. Okay? In order for this alternative to work, the company is going to have to hold the cash, right, instead of spending it. Because we have a financial planning model in the background that tells us we're going to need cash in 3 months. If you borrow today and spend it, you're going to need to borrow again. The hedging is gone, right? So that's why it's liquidity that is a substitute for hedging. You need to hold cash if you want to hedge in the right way. And as we're going to see, that's going to be a general, a general principle we're going to learn in this lecture. Okay, the company has to hold the cash, and of course, that is going to introduce potential risks. You have to invest in a safe asset, right? Because you want to make sure you're going to have the money, so you shouldn't be buying risky equity, for example. The safe asset is likely to produce a low rate of return. You're going to pay a liquidity premium, right? The interest payment that you receive on your safe asset, it may be low, but it's taxable, so there's going to be a tax bill, right, that you have to take into account. And finally, you know, I don't want to take for granted that the company will keep the cash. Once you put the money in the company, you know, the CEO may be tempted to spend the cash instead of hoarding it. So that may introduce problems. As we already discussed it in this course, cash can burn a hole in the pocket, so companies could be tempted to overspend, right? We talked about this when we discussed payout policy, for example, right? Because of all of these problems, hedging with liquidity is also going to be imperfect. Let me give you another example, and this is a really cool one, I think. That's actually going to show you why I choose December 14 for the Russian example, okay? So now we go back to our US company that needs to make that ruble payment, right? It's in December 15, so it's in 1 year. And remember that the company's concern is that the rubles may appreciate relative to the dollar. So the company is proposing to enter a forward contract at that amount that guarantees a payment of 3 points, you know, whatever, right, in 1 year. You got the idea, we did this already. Let's think about a situation when the forward was not available, right, which is totally possible for smaller countries, right, if you have a payment that is due in a longer time period, or maybe because of settlement risk, you may not be able to buy a forward contract. So what the company can do is to buy rubles in the spot market. You can buy the rubles today. It's the same idea as the interest rate example. Instead of buying rubles tomorrow, you can buy them today. That is also going to eliminate your exchange rate risk, as we're going to show next, right? If you look at the table that I gave you from the Financial Times, the current exchange rate is 55.667. That's the current rate at which you could buy rubles in December 2014. So now let me ask you this question. What does the US company need to do with the rubles? Think about that. It has to invest in a safe asset, but the asset has to be in rubles. If you have rubles and you change them back into dollars, when that year comes, you're going to have to buy rubles again. So, you know, it didn't work, right? In this case, the hedging position requires you to hold cash in rubles. I hope you got that answer. Let's develop that. How would that work? We have to think about what the interest rates were. So at that time, the 1 year interest rate on a Russian government bond was 16.8%, while the rate on a 1 year US Treasury T-bill was just 0.2%. T-bill rates have been very low in the US, as you probably know. So how many rubles does the company need to buy? That's what this equation is doing here for you. You need 200 rubles in 1 year, right? So if you invest at 16.8%, that means you're going to buy 171.244 million rubles, right? So you don't have to quite buy 200 because you can invest in rubles and, you know, you're going to earn the interest, right? So that's the amount, a simple discounting problem. So that money turns into 200 million rubles in 1 year, right? How much does that take? To buy that today is going, given the current exchange rate, which is here, that's going to take you $3.06 million. So it's approximately $3 million, right? If the company does this transaction, think about this. You're hedged against exchange rate risk. You changed dollars into rubles today. You hold the rubles, right? In 1 year, you can use the rubles to make the payment. You're done. Again, liquidity substitute for hedging, right? There are a few things here that you may be worried about. The first one is not a problem, right? The amounts are different. So now we are spending, 3.076 today instead of 3.082 tomorrow, as we were doing before with the forward contract, right? 3.082 is the amount you're spending if you're hedging the risk with the forward contract. Is this the same amount? The answer is yes, because if you had invested the 3.076 today in a treasury bill, you would get exactly 3.082 tomorrow. Okay? So that's how I built the numbers actually. What I use it here is the notion of interest rate parity. I actually assumed that the interest rates were such that interest rate parity exactly worked. Essentially what the interest rate parity means is that the relationship between a futures and a spot rate has to be the same as the relationship between the interest rates on two different currencies. Right? This is not really a topic of corporate finance, but I want to mention it here just to clarify this example. And the idea is that investors should be indifferent between investing in dollars or investing in rubles. If investors are perfectly indifferent, then interest rate parity should work. The problem is, of course, the real world is always more complicated than our example, right? The actual one-year Russian government bond rate was not 16.8%. I made up that number. I was cheating, okay? The actual rate was 15.6 in December 14. So in order to have 200 million rubles in 1 year, the US company would actually have to spend more money. It would have to spend a little bit more money, which then, you know, if you do the math, that would be equivalent to $3.109 million, which is actually going to be more than what you would have spent with the forward contract. So hedging with liquidity is going to have this cost. Okay? That's not the end of it. Now comes actually the most interesting discussion. That's why I have the picture of the Russian government there, right? Let's think about what was happening in Russia at the end of 2014. Why was the Russian one-year rate 17% is extremely high, right? For a one-year government bond rate. What was going on? What was happening is that Russia was in the middle of a currency crisis. On December 15th of 2014, as this is actually comes from an article from The Economist, the currency lost 10% of its value in 1 day. It had already lost 40% on that year. So what the central bank did is increase interest rates sharply to try to calm the market. But there was desperation, according to The Economist. Okay, so we are in the middle of a crisis, and my hedging strategy seems very smart, but what I'm proposing is that the US company is going to invest in Russia. What's the problem? The problem is that Russian bonds were probably not risk-free at the end of 2014. Right? The US company maybe eliminates currency risk by doing that, but now you're exposed to significant credit risk. You have Russian bonds. Russian bonds at that time were a very risky security. You probably have a low credit rating. We talked about credit ratings already, right? So that is going to create significant credit risk. Currency risk turns into credit risk. So again, that's another problem of trying to use liquidity to hedge. You may not have the right asset, the safe asset that you need to get a perfect hedging strategy. Now the company needs to think about, is it really worthwhile hedging using Russian bonds or not? And the answer is not obvious. Right? So that's the summary. Liquidity is always a possible alternative. It's always an alternative, theoretically at least. You can always think about a liquidity alternative, but you also have to consider the costs. Okay? Liquidity will typically come with additional costs and risks. There's going to be a cost of carrying cash. There may be interest payments that are taxable. Interest parity may not hold if this is currency risk. And finally, as we discussed it, you may introduce some credit risk in your strategy, which you have to think about to make sure that it's really worth using liquidity to hedge. Okay? The bottom line, it's always difficult to give overall conclusions, but I think here the picture is pretty clear. The bottom line is that if a derivative is available, my guess is that it will probably be safer and cheaper. Think about the Russia example. You could go in the forward market with an international bank that is a fairly reliable counterparty and write that forward contract. You're not going to have to hold Russian bonds, etc., right? So that might be, safer. It may also be cheaper because you don't have the other costs of holding liquidity. But in some cases, a derivative is not available. That's the commercial paper example. Right? In that case, the best we could do is to have an imperfect hedge. And it seems very straightforward to borrow today instead of waiting for tomorrow. So in that case, liquidity may be a better tool. So I wanted to always think about liquidity, but remember that if the derivative is available, it might actually be the way to go. we're now going to talk about an alternative that companies have when they want to hedge input price risk. The right hedging strategy depends on the particular risk that you want to hedge. We already learned that when we're talking about the currency risk example and the interest rate example, right? So now we're going to talk about another risk, which is input price. So let's think about a company that makes engines, and the engines use steel. So this company, for whatever reason, wants to hedge the fluctuations in the price of steel. Perhaps it doesn't want the compensation of its executives to depend on the price of steel, so it wants to eliminate the impact of fluctuation in steel prices on the bottom line. I got some data in October 2016 when I was preparing these notes. The price of a steel coil was $497 per ton. Okay? What the company could also do at that time is to go to the Chicago Exchange or to the London Derivatives Exchange to buy a futures contract on steel coils. And we have the July 18 futures price at that time was $532 a ton. Here is a picture of a steel coil. If you don't know what a steel coil is, that's the basic way that steel trades in the financial markets and in the real world, right? So that's the picture. And here's the key idea. Rather than opening a futures position, the company has another alternative, which is to write a bilateral contract with a supplier of the steel. This is going to be similar to a forward contract, but it's also different because this contract involves a real input. The contract, again, it's a piece of paper, just like a forward. The contract is going to specify quantity and price for a certain period in the future. So for example, you can write this contract saying that you're going to buy 10,000 tons of steel, for example, in July 2018. When that time comes, your supplier has to provide you the steel, and you can also guarantee the price. You can predetermine the price in the contract. And companies do that. We call that a purchase obligation, right? This name comes from the fact that the company that writes a purchase obligation is obliged, right, to buy the steel when July 2018 comes. And it's also true that the supplier of steel has to fulfill the contract, right? Otherwise, there are legal consequences. Okay? So what's the difference, right? So now we have the futures contract in the exchange. We have the purchase obligation. What are the differences between the purchase obligation and a futures contract? The first difference is that the purchase obligation price is not going to be a market price, right? It's a contractual price which is subject to negotiation. So you're going to have to call your supplier and negotiate the contract. What price are you going to put down in paper? The purchase obligation does not require the buyer, though, to set up the margin account. Remember the pounds example that we talked about earlier in this lecture. To open the futures position in Chicago, our U.S. company had to set up a margin account with the exchange. The purchase obligation is like a forward. There is no cash exchange today. It's just a piece of paper. Finally, the purchase obligation is going to be subject to settlement risk. Because again, now we are back to a bilateral contract, right? Before we had the forward that was between a company and a bank. Now we have two companies. If one of the companies doesn't fulfill its obligation, the purchase obligation is useless, right? So again, we're going to have settlement risk. What does this mean? In terms of negotiation, the problem that companies face is that the PO price might actually turn out to be higher than the futures price, right? Your supplier may have a lot of bargaining power. You may be the only player in the industry, for example. The industry may be concentrated. Your supplier may be able to extract a high price. Second issue, though, is that the PO can be useful for financial reasons, right? You might have a situation when a firm is cash constrained. If you want to go to Chicago to open a futures account, you have to deposit some cash, right? The company may not be able to afford to do that. It may be better for a company that is very financially constrained to enter the zero-cost purchase obligation if you want to hedge your input price risk. And finally, because of settlement risk, that's something we have to take into account, right? Your supplier may default on the contract, and that has to be part of the considerations as well. However, the main reason why I'm talking about purchase obligations is not necessarily because of steel. Now, I mean, now companies can go in the futures market and buy steel coil futures, so they definitely have that alternative. But there are many cases in which the futures contract is not going to be available, right? For example, a company may need a specific version of steel, right? A steel coil is a generic contract, right? But maybe you want a specific kind of steel, you want the steel to be transformed in a specific way, right? Or maybe you need another commodity that is different from steel and that does not trade in a futures exchange. And there are many examples. There are only a certain number, only a certain number of commodities that you can trade in a futures exchange. Many other ones are not traded. For example, even this generic version of steel futures that we're talking about here, now they are available, but they were not available prior to 2008. So there was a time when companies could not use steel futures to hedge, okay? And now we're going to bring back our researcher. I actually wrote a recent paper on purchase obligations that looks at what happens in a time when companies cannot use futures, what happens to the demand for purchase obligations, how do companies trade off futures and purchase obligations. That's the paper that is summarized here. With my co-authors, what we show is that one reason why companies switch from futures into POs is when they become financially distressed. Remember the margin account example, right? One problem of having a futures position is that it requires a cash deposit. So when companies become financially distressed, it may become too expensive for them to have a future position. They switch into POs. And then the other thing we did is we followed up on this idea that there was this big change in the market in 2008. For companies that were heavy users of steel, right? Their hedging opportunities changed a lot right at that time of 2008 because before that they could not use futures. After that they could. So what we show in our paper is that there was a very strong substitution from POs into futures right after 2008 for the right companies. You can actually measure in the data which companies are heavy users of steel and which companies are not. And what we show in our paper is summarized here in this graph. The blue line is for firms that are heavy users of steel. And you can see that right after 2008, these companies significantly decreased their usage of purchase obligations, while companies that didn't have steel exposure, that had a smaller steel exposure, actually ended up increasing their usage of purchase obligations. Okay? What this shows is that companies do substitute futures for forwards, futures for purchase obligations when futures become available in the market. Right? So the bottom line, I hope that this idea is sinking in, right? The word hedging usually brings to mind a futures contract that trades on an exchange, like a future. That's probably what you're thinking about when we started the lecture. That's definitely an important alternative, but in practice, companies are often going to use alternative tools, such as POs, such as liquidity, either because futures may not be available or because the future may be inappropriate in a specific scenario. As our PO paper shows, for some companies, futures are not appropriate because they are, their cash constraints are too strong. They have to go to POs instead of futures. And there are other examples of that in the real world. So it's very important to think of hedging more broadly, not only derivatives, but also these alternative tools. Let's talk now about operational hedging, which is another option that companies have to manage risks when futures may not be available. The idea is that companies can hedge risks by changing their operations. Let me give you a specific example of a Japanese company, Honda. It makes cars, right? And about 50% of its car sales happen in the US. So let's talk about Honda. You know, unfortunately, that's not the Honda car you can buy in the market, but there are others you could buy, right? So, but we are thinking about the perspective from the point of view of Honda, right? It's a Japanese company. 50% of its car sales are in the US. What is the specific currency risk that Honda faces? So I want you to think about that. What is the risk that Honda faces by selling cars in the US and producing cars in Japan? The risk is that Honda's costs are going to be in Japanese yen. If it produces cars in Japan, right, then you're going to spend money in yen and you sell in dollars. So if the dollar depreciates relative to the yen, Honda's profitability is going to decrease, irrespective of how many cars it sells. So even if people love Honda cars, Honda's profit is going to depend on currency risk, right? It depends on what happens to the yen-dollar exchange rate. And maybe Honda doesn't care, but maybe Honda wants to eliminate that risk, right? If the company wants to mitigate or eliminate the currency risk, how could it do it? That's what we're going to think about in this lecture. First option, of course, is futures. You can definitely buy and sell futures contracts or forwards even on yen dollars, right? What is the position that Honda needs to take? Honda, in this case, needs to short dollars. Again, remember, what you're looking for is the zero net gain, right? So Honda needs to make money if the dollar depreciates. The way to make money with dollar depreciation in the futures market is by selling dollars. You want to be short on dollars, right? But now the problem is you don't know exactly what's the size of the position, right? This is a bit more complicated than the examples we had before. Those examples, we had a specific amount, $200 million, for example. Now, the amount of hedging that Honda needs depends on how much it expects to sell in the US. So there's going to be some imperfection here, right? Let's think now about liquidity. That's another tool that we talked about, and I'm going to ask you another question this time, just because I really want you to get to think about it instead of just hearing me talk, okay? So liquidity, right? That means that Honda is going to borrow money in one currency and invest in another currency, very similar to the Russian example, right? I want you to think about what is the position that Honda will need to take in this case. The position is that Honda has to be short dollars. Again, right, what you want is you want to make money if the dollar depreciates. The way to do that using debt and cash is going to be to borrow money in US dollars, right, and then invest in yen. You have to invest in yen, right, for the hedging to work. Because if you do that and the dollar depreciates relative to the yen, the company is going to make money in this trade. The value of dollar-denominated debt decreases, meaning that Honda is going to have an additional profit from having engaged in this transaction. This will again mitigate what might happen to the exchange rate, how the exchange rate may affect the profits coming from car sales in the US. The other possibility for Honda is to do what we call operational hedging, which is definitely a very important and realistic alternative for companies in the real world, especially large companies, right? What Honda can do is to move production to the US, right? The big problem is that if the dollar-yen exchange rate changes, right, the company's profit is going to change together with the exchange rate, right? But if costs and revenues are both in dollars, right? If your costs are in dollars and your revenues are also in dollars, so now the company is going to have what we call a natural hedge. For example, if the dollar depreciates, right, your revenues go down, but your costs also go down in yen, right? So the company is naturally hedged. Not natural, in this case, it involves a decision of the company, right? So the word natural may be a little funny. The company has to make the voluntary decision to move production to the US. After you do that, you're going to be naturally hedged. So let's gather evidence. This is not a paper. I just went out and looked at the financial reports for Honda, trying to figure out what does Honda actually do to manage its currency risk. Okay? So from the annual report, companies have to report in their 10Ks, in their annual reports to investors. They have to tell investors if they are using derivatives for hedging purposes. And what Honda says is that they do not hold any derivatives designated as hedges for the years of 2014, 15, and 16. So they don't actually use the futures market to hedge in this case. Might seem surprising, right? What are they doing? Other thing we can do is to look at the debt structure. That was one of the topics of our module 2. We didn't look at foreign borrowing, but we looked at other aspects like banks and bonds, commercial paper, etc. Right? You can also get data on the currency that a company's debt security is denominated. That's what is in this table here. That's from Honda, from the June 30th, 2016 financial statement. What you see is that Honda does have US dollar denominated debt, right? So there is a fairly large issuance here of it's 1 billion yen, right, of a US dollar medium-term bond, okay? So at a 2.5% interest rate. So Honda is borrowing in dollars. And it's probably holding some cash in yen as well, but the evidence suggests that Honda is in fact using the debt markets to hedge its currency risk, right? That's exactly what Honda should be doing, is to have some dollar-denominated debt. Finally, let's look at the operational data. Again, there is a lot of data these days about companies we can try to use to figure out what they're doing in practice. This is Honda. As I said, a huge fraction of Honda's sales comes from North America. So here you have revenues, right? For example, in 2015, approximately half of Honda's revenues came from the U.S. market. Yeah, it's mostly Japan and U.S. market, but also other countries in Asia, right? That comprises most of the sales of Honda, right? So it's 7 billion. Well, this is yen, so I'm not going to try to guess the currency here, but you can see it's half, right, of the total revenues, okay? But look, assets, right? This tells us in which country has Honda located its assets, right? Its investments, intangible capital, for example, right? And what you see is that there is a significant amount of assets in the U.S. as well, right? It's not perfect evidence. This is not costs, right? It's assets. But this data does suggest that Honda moved some of its operations to the U.S. as well, right? And it moved some operations to Asia, right? Similarly, it has a significant amount of sales in other Asian countries. It moves some of the operations to Asia as well, right? We know, in fact, we didn't have to get this data. We know that Honda produces cars in the U.S., right? There are plants around the U.S. So that's the summary, right? For the case of Honda, the company actually decides not to use currency derivatives. Why? Maybe because Honda has a natural hedge. Currency risk may not be that much of a problem for Honda because since it produces cars in the U.S., it is less concerned with the possibility that the U.S. dollar may depreciate, right? And in addition, it has debt in dollars. Having borrowed in dollars also going to have a hedging role for Honda. If the dollar depreciates, that debt is going to decrease in value, so Honda makes money in yen. So real-world companies go beyond derivatives. They use other alternatives, even when derivatives are available. That's what Honda's example is showing. Let's go back now to a topic that we talked about in Corporate Finance 1, which is a company's cost of capital. We've been talking about this notion of currency risk, right? So for example, let's go back to Honda. Honda is a Japanese company that is also investing in the US. how should Honda adjust its hurdle rate, its cost of capital, when it's evaluating whether to open a new plant in the US or not? Good question, right? What about the plant in Africa? What if Honda decides to produce in Africa to take advantage of cheap African labor, for example? Right? That hasn't happened. That hasn't happened yet, but maybe it will, right? How should Honda adjust its cost of capital? That's the question we're going to talk about in this topic, in this lecture. Let's start with a numerical example. So now we have a financial manager of a US company that identified an investment in the UK, and this investment requires you to invest 100 million pounds today, and it's going to give you 110 million pounds in 1 year. This investment has similar business risk as the US business. It's just like your US business, except that you're moving it to the UK. Think of it this way. The cost of capital for the US company, you estimated it. For domestic projects, it's 8%. The question is, what is the net present value of this project? You are investing in the UK, you're a US company, you have the US company's cost of capital. How should you compute the NPV of this project? What the company may want to do is to express the cash flows in dollars. Instead of thinking in pounds, can we think in dollars? And the answer is yes, right? What the company can do is to use the futures market. You're going to receive the 110 million pounds in 1 year. So what the company needs to do is to sell pounds, right? You go to the futures market, you short pounds, 110 million, at the current futures rate, which we figured out already in our lecture. Right now, when I was preparing this lecture, the futures rate was 1.2373. Let me also give you the current exchange rate. A dollar pound is 1.2173, and we're going to use those two numbers, right? Let me create a timeline here, and then I'm going to ask you a question. So here we have the all the actions that this company is taking, right? You have to go to the futures. You have to go to the futures market, right? But you are also buying pounds to invest in the UK project. So you're buying 100 million pounds at the current exchange rate, right? You're investing this money in the UK, and then you're opening the futures position. When next year comes, you're going to receive 110 million pounds, because that's your investment, right? And you can use those pounds to close your futures position. You're going to go to the futures exchange and close that position, right? What it means is that what you're going to receive is exactly the amount that was written in the futures contract. The futures exchange is going to give you $136.1 million in exchange for that, right? So now you know that you invested $121.73 million today, and you received $136.1 million in 1 year. Now let me ask you a question. Now comes the question. What is the right discount rate for this project? And remember, the discount rate for US projects is 8%. What should the company discount cash flows at? The answer is that it's the same discount rate. Let me do the math first, just to get that out of the way, and then I'll talk about why, right? So essentially what we're going to do is we're going to discount the dollar cash flows, right? So first we are changing the cash flows to dollars. And remember, to do this, we have to use the futures market, right? We essentially used the futures market to eliminate currency risk. Once you've done that, you can discount the cash flows at the same discount rate. So the NPV, if you do the math, by now this should be trivial for you, is $4.29 million. Let's talk about why. Why are we discounting at the same rate? Let's think about two questions. What happens to the project if the exchange rate goes to 105? Just an example. Whatever number I put here, the answer is nothing. The company is hedged, right? You're going to make or lose money in the futures position. You're going to make or lose money in the same way in the project, right? You have achieved the zero net gain that we're always talking about. Okay, nothing happens to the company is fully hedged. What happens to the project if the cash flow is 100 million instead of 110? Well, unfortunately, now you're going to have a negative NPV, right? you were not able to eliminate the business risk. You still have business risk. What you don't have anymore is the currency risk. The currency risk is gone. Your profits no longer depend on currency. They only depend on whether your project is successful or not. That's why we should discount at 8%. The project has no currency risk left. It only has business risk. All the risk comes from the business, right? The general principle here is that if a currency risk is fully hedged, the cost of capital for foreign projects should be the same as the cost of capital for domestic projects. The fact that you're investing in a foreign country does not mean you should use a different cost of capital. As long as the business risk is the same, of course, right? The reason we can use 8% in this case is because we assumed that the business risk was exactly the same. That may not be the case. You have to find the right discount rate for each business. That's a topic we talked about a lot in Corporate Finance 1. Once you've done that, if you hedge currency risk, you're done. You don't have to worry about it anymore. The world would be beautiful, right, if that was the end of it. But of course, the problem, as we've been talking about in this lecture, is that hedging is not trivial. You want to achieve that zero net gain, but in many cases, you're not going to be able to do it. Hedging is going to be imperfect for many reasons, right? And it's very important for us to think about what happens to the cost of capital when hedging is imperfect. How does unhedged currency risk affect the company's cost of capital? This is one of the big questions in modern finance, and I don't think we have a clear answer yet, but there are some important principles and ideas that I want to discuss with you so you have a better handling of this question in the real world. It is a difficult question. It doesn't have an easy answer. Let's start with Honda, right? As we discussed it, Honda has dollar currency risk, right? Because it sells cars in the US, and Honda may be imperfectly hedged. We don't know that exactly, but let's say that there is imperfect hedging, despite the operational hedging, despite the dollar-denominated debt, right? There might be some residual currency risk. How would that affect Honda's cost of capital? We're going to have to go back to Corporate Finance 1 and remember this very important idea that what matters for a company's cost of capital is what we think of as systematic risk. It's measured by the beta, right? The beta is going to tell you how the company's value is going to fluctuate with fluctuations in the market. So if you want to think about currency risk, we have to think in terms of beta. We have to try to answer this question: how does currency risk change Honda's beta? Right? Would the US currency risk necessarily increase Honda's beta? That might be what you're thinking. There is more risk, beta should be higher. That's actually not obvious, as we're going to learn now. Beta depends on market risk, right? So it's going to depend on whether the cash flows and stock returns become more cyclical or not, right? Once you invest in a foreign country. If they do, then beta and the cost of capital should go up. If they don't, then maybe you're going to have a lower beta. It might be safer, okay? So this is the framework that I propose for us to think about this. It's a very simple framework where we're trying to divide, what I try to do here is similar to the example we've been talking about, dividing risk into business risk and currency risk. Every investment is going to have at least these two, right? So there is the business risk, which is that you might sell more cars or you might sell less cars. And if you think about Honda, for example, this risk should be highly correlated across US and Japan, right? If there is a boom in the world economy, right, you're going to sell more cars in US, you're going to sell more cars in Japan as well. It might make sense to assume that business risk is very similar, no matter whether you're selling cars in US or whether you're selling cars in Japan. Down, down, up, up. What about currency risk, though? That's a whole new ballgame, right? Now we have to think about how does the exchange rate, yen to dollar, moves when there is a boom in stock markets, right? When there is a boom in the world economy, what's going to happen to that exchange rate? By the same token, what's going to happen when there is a recession? What's the currency beta, right? And then the answer is that whether beta increases or decreases is going to depend on the correlation between the exchange rate risk and the market risk, right? We have to try to gather some data to think about whether the US dollar relative to the yen, whether it tends to gain or lose value when there is an economic downturn. So here is the graph that shows you the data. What you see in this graph is the US to yen exchange rate. That's the blue line. And then on the red line, what I plotted is the return on the S&P 500. So that's how the market is doing. Right? So the blue line shows the exchange rate. The way to interpret this is that if the blue line goes up, that means the US dollar is appreciating because the US dollar is buying more yen. So what you see earlier in the data in the early 2000s is that the US dollar was appreciating, right? At the same time when the stock market was going down, that was the crash of the internet bubble. So that would suggest that there is a negative correlation. However, if you look more recently, for example, in the recent financial crisis in 2008, what was happening is the stock market was going down, but at that point, the US dollar was depreciating relative to the yen. More recently, the US dollar has been appreciating together with the stock market, so now it looks like there is a positive correlation, right? But if you go to the very end, I'm not sure you can see, but in the very end of the picture, you will see that, again, we seem to have a negative correlation. The US dollar is again depreciating, but the stock market is going up. Right? So really the answer we got is that it's not clear how the yen to dollar exchange rate moves with the market. Right? So what we make of the currency beta? It's an answer that you see here is, we might as well assume that the currency beta is 0. Right? There is no systematic relationship between the US yen exchange rate and how the stock market is doing. Right? In addition, if we assume that business risk in Japan is the same as business risk in the US, it might make sense for Honda, in our case, to end up using the same cost of capital. Even if there is unhedged currency risk, right, under these two assumptions, the unhedged currency risk would not affect the cost of capital. So that's the summary here, right? In this case, unhedged currency risk doesn't seem to be having a big impact on the cost of capital simply because the currency risk seems to be uncorrelated with market risk. We just talked about Japan, right? We talked about how currency risk changes the cost of capital for a Japanese company investing in the US. Let's talk about a different example now, which you might be thinking about. What about an emerging market, right? So here you have Brazil, where I'm from, right? Suppose we have a situation now where a US company is considering an investment in Brazil, right? Let's say that this investment has a similar business risk as the US business. So for example, it might be a technology company that is expanding into the Brazilian market, selling the product in the Brazilian market, right? And suppose that there is some unhedged currency risk. Of course, what this company should be trying to do if it's concerned with the currency risk is to find ways to hedge. But as we discussed it in the Russian example, when you invest in an emerging market, it might be more difficult to fully hedge the currency risk because the futures market might be underdeveloped and holding liquidity is costly and so on and so forth, right? So suppose there is some unhedged currency risk. What would be the cost of capital for the Brazilian project? And here is the benchmark. The benchmark is, again, a cost of capital of 8% for the US. Using our model, that roughly corresponds to a beta of 1, right? It's a risk-free rate of 3%, a risk premium of 5. So this is a US project that has a beta of 1. What would be the cost of capital for the Brazilian project? This framework that we talked about, this always works. At least that we know, okay? That we can think about business risk and currency risk, and those are going to be the two risks that's going to affect the beta. And again, remember, the crucial thing is to think about how the business risk and the currency risk depend on the overall stock market, right? If there is a boom in the stock market, right, in the US, what's going to be happening to profits of Brazilian investments? If there is a recession, if there is a decrease in the US stock market, what's going to be happening to the Brazilian profits? Of course, since our US business has a beta of 1, we know that the US business is going to be cyclical. Profits are going to be going up and down with the stock market. And then we have the currency, right? What's going to be happening to the emerging market currency as a function of the stock market, right? So think about the intuition first before we show you data or numbers, right? What our intuition would suggest, I think, is that investing in emerging markets should be riskier, right? So what our model should tell us is that it's risky to invest in emerging markets, so our beta should go up, your cost of capital should go up, right? That would be true, of course, if the first condition is that investing in emerging market has to be more cyclical, right? So if the stock market is doing well in the US, then the stock market in Brazil is going to be going even higher. Brazilian profits are going to be even more cyclical than US profits. Okay? And that is usually the case, even though we're going to talk about a problem at the end. And then we have the currency risk, right? So what happens to emerging market currencies? And what is going to be clear, if you look at data, is that usually what happens is that emerging market currencies tend to depreciate in bad times, right? So if you're investing in Brazil, you're making profits in Brazil, there is a recession, the emerging market currency is going to depreciate, right? So what's going to happen is the profits of your company here in the bad state are going to become even lower, right? So the currency risk is going to increase the beta for the US company investing in Brazil. Okay? So let me show you an example using the Brazilian data. Here what you have is the blue line is the amount of dollars that the Brazilian real buys, right? So if the blue line goes down, that means that the Brazilian currency is depreciating. The red line again shows the US stock market. And look, the picture now is very different from the Japanese picture, right? What you see is the blue line is almost perfectly tracking the red line. Every time the US market goes down, the Brazilian currency depreciates relative to the dollar. Every time the US market goes up, the Brazilian currency appreciates relative to the dollar. So that is really what the data are telling us. So if you think about cross-border investments in emerging markets, what we saw is that the business beta will probably be greater than 1, right? Because emerging market profits are more cyclical, and the currency beta is now positive, right? Because the emerging market currency is depreciating in bad times. What these effects would do is they would make the US investment in Brazil riskier, right? So that would match our intuition perfectly. These effects should increase the cost of capital for the US company investing in Brazil, so the Brazil beta should be greater than the US beta. One way you can capture this in the capital asset pricing model is by adjusting the CAPM. So we call this the adjusted CAPM, which is sort of a long formula, right? So what is the Brazil beta for the US company would be the US beta, which in this case is 1, times the beta of the Brazilian market relative to the US market. If the emerging market is more cyclical and if the currency beta is positive, as we saw, then what will happen is that the Brazil beta will be higher, right? And the CAPM will get the right intuition, right? That we started with, the emerging market investment should be risky. Great. The problem is I tricked you. So I stopped the data in 2010. Let's see what happens if we look at the Brazilian data in the last 5 years. So clearly what you see in this picture now is that there is the Brazilian currency is no longer moving together with the US stock market. It's moving in an opposite direction. In the last 5 years, the US market has done well, as we know, right? We are in 2016. The last 5 years have been good for the US stock market, but the Brazilian currency has been depreciating. If you look at the business beta, you get a similar picture. The Brazilian stock market has been doing poorly, even though the US market has been doing great. Right? So now if we think about our model, what happens is that if we look, the 5-year data, and remember, to compute beta, we usually have 5 years of data, so the model might suggest that the business beta is negative and the currency beta is negative, so it seems that Brazil has suddenly become safer. So here's a question for you. Has Brazil really become safer in the last 5 years or not? And the answer is that, there was a big crisis in Brazil, right? It doesn't seem like Brazil is a very safe place right now. There was a political crisis, the president was impeached, right? So we'd probably be making a mistake if we had assumed that Brazil suddenly became safer, right? The low returns are due to the political crisis in the country. That creates a problem for international finance. The theory tells us that beta should do the job for us, but beta is really failing in this case. What people have done in practice is to try to make adjustments to this CAPM model that we just talked about. And the model that is most commonly used in practice was what is called in the industry the Goldman model. So that's why I have a picture of Goldman Sachs headquarters here for you. It's called the Goldman model because it was invented at Goldman Sachs, when people were initially thinking about how to adjust cost of capital for international projects. This is how the Goldman model works. What you do is you adjust the CAPM by adding what we call the sovereign risk premium. That comes from the bond market. It's the spread between the Brazilian sovereign bond and the US risk-free rate. So the Brazilian sovereign bond is the bond issued by the Brazilian government to borrow money in international markets. It's denominated in dollars, so it's in the same currency, right? That spread, in the data, that spread is going to reflect specific risks about Brazil. So currently, for example, this is a time when the Brazilian sovereign risk is probably quite high. What's happening in the market is the long-term Brazilian bond denominated in dollars in October 2016 was yielding 6%. So there is a 3% risk premium, if you compare with a 3% risk-free rate if you invest in Brazil. Right? So how would we use that in the model? Essentially, we add the sovereign premium to the cost of equity, or another way to implement this is to, rather than use the risk-free rate, to use the yield on a Brazilian long-term sovereign bond instead of the risk-free rate, instead of the US Treasury yield on our CAPM formula. So that's what you have here. So we would essentially be using 6% instead of 3% for our risk-free rate. And the beta, you can use the same beta that we talked about before. It's the adjusted beta, where you would multiply the US beta that reflects the business times the beta of the Brazilian market relative to the US market. And if you're wondering, it's probably clear given our discussion so far, the market risk premium we are using is the same one that we used in Corporate Finance 1 Module 4, right? In this course, we're using 5%, but some practitioners use different market risk premium, as we discussed in Corporate Finance 1. You can go back and review it if you want. So how would we implement this? The cost of equity for the company then, for our US company investing in Brazil, would be 6%, right? That's the big change. That's really what the Goldman model is doing, plus this beta. So even if the beta is low, right? Even let's say you get a beta of 0.7, which is counterintuitive, right? That's going to be compensated by this sovereign risk premium. So in this case, you would get a cost of equity of 9.5% instead of lower than 8%. So then the model is again consistent with our intuition. But here's the problem. The Goldman model is a practitioner model. It's really not backed by finance theory. It's the CAPM. The nice thing about the CAPM, if you go through an investments course, is that the CAPM can really be justified using theory, examples. It is a very strong a model from the theoretical point of view, whereas the Goldman model is what we call an ad hoc adjustment. Okay? The best argument we have for the model is that other people use it, so that's why I'm teaching you this model. Hopefully, though, the research will show us how to make this adjustment in a more solid, more theoretical way. Okay? There is also some evidence that the sovereign risk premium captures the right risk, because the sovereign risk premium predicts high sovereign returns. And people are trying to follow up on this idea to try to find a version of the Goldman model that can be justified by theory and data. Maybe in a future class we'll be able to talk about that. This module was about risk management. And we started by identifying right and wrong reasons for hedging risk. So remember, hedging is not about reducing risk. Hedging is about choosing which risks to take. That's the key idea we talked about in this module. We also talked about how companies can use forwards and futures to hedge risk, to hedge specific risks that they want to eliminate. Right? We talked about specific positions that companies have to take, which direction, and in particular, we emphasized that it's very important to distinguish hedging from speculation. Speculation is the wrong way to go to a futures market. It's the wrong reason to go to a futures market. And then we talked about what can we do when the target risks cannot be eliminated using derivatives. There might be imperfect hedging, futures contract may not trade. Right? So we talked about substitutes such as liquidity management. Companies can use cash and appropriate borrowing positions in order to substitute for derivatives hedging. We talked about which specific transactions you want to enter, how to borrow in a foreign currency, for example, which cash to hold. Right? We were very specific about this. This is a very important idea for hedging, is that liquidity is a substitute for hedging. Then we talked about bilateral contracts, which is a very useful form of hedging for when the risk that you're concerned about is related to prices of important inputs. And we talked about, at the end, we talked about a currency risk, right? And one issue we emphasized is that companies can change operations to hedge risks, such as currency risk specifically, right? We talked about operational hedging in Honda, for example, moving production to the U.S. is a way to address currency risk. This point is broader though, right? Operational hedging can be used as a substitute for futures and forwards as well. It's another way that companies can mitigate specific risks. And then at the very end, we talked about the relationship between currency risks and cost of capital, both for the cases when the currency risk is fully hedged, right? In that case, there is no effect on the cost of capital. And then when the currency risk is unhedged, right? We talked about the difficulty actually of adjusting the cost of capital for international projects when currency risk is unhedged. We talked about models that practitioners use, but this is really an area where I think finance researchers and practitioners have to learn more in order to improve our knowledge of how to adjust the cost of capital for international projects. We're close to the finish line. This is the last module of Corporate Finance 2. But I think it's going to be one of the most interesting ones so far. In this module, we're going to apply the tools that we learned in the first 3 modules to analyze the financing of acquisitions and innovation. We're going to talk about how companies finance M&A and how companies finance R&D projects using several examples from the real world. So you probably noticed in this course, we are using examples in every module, but in this one, we're going to move even closer to the real world and really talk about some recent deals that happened in the M&A world and the financing of some innovation-intensive companies that you see there, Merck, for example. Okay, so there's going to be all these interesting examples, a lot of detail. I really wanted to get to the bottom of all these examples. So this module is going to be a little bit longer than the previous one, not too much. But fortunately, what I did is I made the part self-contained. So what you can do is you can spend more time focusing on the application that interests you the most. So if you want to learn about private equity, for example, you would focus mostly on parts 4.5 to 4.8. Okay. Of course, I think it's all very interesting. So it would be great if you can follow everything. But if you're short on time, maybe you can do some adjustments based on this slide. Okay. So in terms of specific topics, you'll learn how to differentiate between cash and stock financed M&A deals, how companies finance M&A deals in practice, how to estimate the impact of M&A on a company's financial statement, and how to estimate the impact of M&A on a company's financial statement, how to estimate the impact of M&A on a company's financial statement, and how to estimate the impact of M&A on a company's financial statement, and how to estimate the impact of M&A on a company's financial statement, and how to estimate the impact of M&A on a company's financial statement, and how to estimate the impact of M&A on a company's financial statement, and how to estimate the impact of M&A on a company's financial statement, and how to estimate the impact of M&A on a company's financial statement, and how to estimate the impact of M&A on a company's financial statement, and how to estimate the impact of M&A on a company's financial statement, and how to estimate the impact of M&A on a company's financial statement, and how to estimate the impact of M&A on a company's financial statement, and how to estimate the impact of M&A on a company's financial statement, and how to estimate the impact of M&A on a company's financial statement, and how to estimate the impact of and how an M&A deal may affect capital structure and payout decisions, which is two important topics we talked about in corporate finance too. Now we're going to talk about those topics in the context of M&A. And then we're going to move on to private equity and talk about the specific challenge of how to finance a private equity deal and how to build a leverage buyout, an LBO model in Excel. It's a very common financial model that is used in practice to analyze private equity deals. Okay, we're going to use these LBO models to make financial policy decisions. Finally, what we're going to do is we're going to talk about the financing of R&D and to develop a risk management framework that allows you to optimize the financing of R&D projects and support value creation through innovation. In Corporate Finance 1 Module 4, we talked about this important topic, which is how do companies pay for a deal. In the real world, acquirers can choose to pay cash or to pay in stock. This is the example that we used. It was the HP Compaq deal that happened many years ago. There was a case in which HP was acquiring Compaq, and Compaq had 1.68 million shares outstanding, right? So if you take, for example, a final price of $27 billion for Compaq, which is approximately the offer value in that case, this would represent $16 a share, right? So as we figured out in Corporate Finance 1, if HP pays cash, it would offer $16 in cash to Compaq shareholders, okay? This is all stuff that we did in Corporate Finance 1 Module 4, so I'm recapping it here so we can go deeper into this example, right? If we pay with stock, what will happen is that HP is going to issue new shares and give them to Compaq shareholders in exchange for Compaq shares. So as a result, what happens is that Compaq shareholders are going to become shareholders of HP as well, right? And then HP is going to become the new merged firm. In a stock deal, what companies have to determine is what we call an exchange ratio. So the exchange ratio is going to tell you how many shares of HP each Compaq shareholder is going to receive, right? We did this calculation again in the previous course. If you're paying $16 a share and HP's, and we use HP's pre-deal stock price to base the calculation, we would obtain an exchange ratio of 0.69. Okay? So what this means is that if you own, for example, 10 shares of Compaq, you would receive 6.9 shares of HP, right? So HP, as a result of paying for the deal, HP is going to issue 1.165 billion new shares to pay for the deal using stock. Okay? But this is the question we haven't really talked about. You know, in Corporate Finance 1, we went through these details so you could understand you know, what's the difference between cash and stock, the mechanics, but we really haven't talked about how do companies choose between cash and stock payments. And if you think about it, this is a financial management decision. It's a financing decision, right? How you're going to pay for a deal, right? So it's exactly what we're talking about in the second course, right? It is one of the most important financial management decisions that companies will do when they are setting up the financing of an M&A deal. So our goal is to talk about many factors that companies have to consider when they are trading off cash and stock, when they're thinking about what's the optimal way to pay for a deal. Okay, we're going to talk about taxes, signaling, ownership, risk sharing, and finally impact on capital structure. Capital structure is going to be a key consideration here. Taxes. First issue, taxes of course are very important. And for M&A deals, there is a very simple general principle, which is that while a cash deal is taxable, a stock deal is not. So if HP decides to pay cash, what will happen is that Compaq shareholders are going to have to pay capital gains tax on the stock that they sell to HP. Presumably, they're going to be making some gains, right? M&A deals are usually associated with large premium, meaning that Compaq shareholders are going to have to pay tax. If HP is paying with stock, then the stock deal is going to generate no immediate tax. So Compaq shareholders are going to be able to defer taxes until the moment when they decide to sell the stock on their own. Then they have to calculate the appropriate capital gains tax. So here's a question I wanted to think about, right? So stock deals are not taxable, cash deals are taxable. Let's think in terms of pricing, right? So the acquirer has to price deals, cash deals, stock deals, right? Which type of financing, cash or stock, which type of financing should lead to higher premium? Are acquirers going to pay higher premium for cash deals, or are they going to pay higher premium for stock deals? The answer is, as you might expect, right, that acquirers are going to have to pay a higher premium for cash deals, simply because the acquirer has to compensate the target for the expected taxes that are going to be paid. Okay, so the target is going to pay taxes, so what happens in practice is the acquirer is going to have to pay a higher price to partly compensate the target for the higher taxes. The data, in fact, from the real world suggests that premia are higher in cash deals. So it's a 7% higher premium in terms of the target, 7% of the target's pre-deal value in cash deals. So 7% in addition to what acquirers pay in stock deals. Okay? So this makes a lot of sense, I think. The second consideration is signaling. This is a very important consideration when companies make financial decisions. We talked about signaling in the context of payout decisions and in the context of equity issuance, for example, in Module 2 of Corporate Finance 2. And a key idea for M&A is that paying cash is really going to be a sign of confidence by the acquirer, right? Because you're going to pay cash for the deal, that means that the acquirer has to be fairly confident that the deal is going to create value, whereas paying with stock is going to require equity issuance, right? So it requires the acquirer to issue equity in the market, as we figured out in the HP Compaq example. And we know, right, we learned in Module 1 of this course that the market reacts negatively when companies issue equity, okay? So this is going to be very interesting because it's going to allow us to learn more about how the market reacts to mergers. We saw this picture in Corporate Finance 1. It's a classic picture in corporate finance that shows that acquirers on average don't really make any gains when a new deal is announced. The buying firm on average makes, it doesn't lose money, doesn't make money when a new M&A deal is announced. Okay? But what we're going to learn now is that the market reaction depends on whether the acquirer pays with cash or whether the acquirer pays with stock. So the researcher comes up to tell us that if we divide deals into cash and stock deals, what you're going to find out is that cash deals are going to generate an increase in the acquirer stock price on average, while stock deals are going to generate a decrease in stock prices. So when acquirers pay with stock, the stock price goes down on average by 2.3%. That's the data that comes from a recent paper analyzing market reaction to mergers. Whereas if you pay with cash, you generate an increase in your stock price. Right? So that's interesting because it shows that the reaction of the market to mergers depends on how you finance that deal. Right? So why does the market react negatively to stock deals? What we believe in corporate finance is that this negative reaction may actually not be due to the deal itself, right? When the deal is announced, the market learns two new pieces of information. It learns that company A is buying company B, right? So this transaction is going to create some value, which then should be reflected in stock prices, right? The NPV of the deal should be reflected in stock prices. But the market, in a stock deal, the market also learns that the acquirer is issuing equity. So what we believe in corporate finance is that the negative reaction to a stock financed deal can actually be due to the equity issuance and not to the deal itself. So this is something that acquirers have to consider when they are deciding how to pay for a deal. Another consideration is ownership structure. And if you think about this, it's a very simple idea, right? If you pay with stock, you're really going to give ownership of the company to the target. The new stock is going to come with voting rights. So if the target has a large institutional shareholder, for example, this institutional shareholder is going to become an institutional shareholder of your company, right? This is relevant for large companies, but it is particularly relevant for smaller companies, right, that have concentrated ownership. If you are the owner of a small company and you're going to give ownership to a new investor, that means that you're no longer the sole owner. Now you have to share the ownership with the new investor. So that's an additional consideration that comes into play when you're thinking about how to pay for an M&A deal. So you might be thinking at this point, it all sounds bad for equity, right? So negative reaction to stock prices, diluting ownership, right? So why would an acquirer choose stock financing? And what we're going to learn next is that there are two very important considerations that actually make stock financing a very important financing method for M&A deals. We learned in Module 1 that companies are reluctant to issue equity. So companies almost never issue equity to finance projects. It's a fact of the data. However, companies are very frequently issuing equity to finance M&A deals. So let's try to understand why this is the case. The first consideration is risk sharing, and the way that I'm going to show you this is to think about the valuation of the synergies. Back in Corporate Finance 1, we estimated a synergy of $13.1 in that case. Given the data that was provided by the management, our calculation suggested that this deal was going to create an NPV of $13 billion for the merged company. And as we also learned in Corporate Finance 1, what the deal pricing is going to do is to distribute the gain for acquirers and targets. So if you pay $27 billion, for example, then this is going to represent a $6 billion gain for the target and a $7 billion gain for the acquirer. Okay, but think about this. By then, I think we've done, in this course, we've done many NPV calculations. We know that NPV calculations are based on forecasts of the future. In particular, we talked about synergy valuation in Corporate Finance 1. The synergy is something that really hasn't happened yet. It's the new thing that will come when you merge these two companies. So it must be that companies in the real world are going to be fairly uncertain about the value of synergies, right? We really don't know for sure what their synergies are worth. So the reality is going to be probably closer to something like that. That's our expected value, right? We expect the synergy to be $13.1 billion, but it could be much higher or it could be much lower. Maybe the deal has no synergy at all. We might even have a negative synergy. Why does this matter? Okay, what I'm going to try to do with you now is to think about what happens now if the acquirer pays cash and what happens if the acquirer pays stock. So suppose first that the acquirer is paying cash. In the baseline case, we learned that the acquirer is going to gain $7 billion, the target is going to gain $6.1 billion. So try to figure out on your own how much does the acquirer gain, how much does the target gains if the synergy doesn't turn out to be as you expected. The answer is fairly simple. Okay, and it's really based on simple algebra. That's the baseline case, right? The key aspect of a cash deal is that the target is getting cash. So the target is going to gain $6 billion no matter what, right? If the deal turns out to be better than expected, what will happen is that the acquirer is going to gain more. So the acquirer is going to gain $20 billion in this case. If the deal turns out to be worse than expected, right? So all the premium that you're paying to the target is actually going to be reflected in a decreasing value for the acquirer. You're basically giving money for free to the target, right? So the acquirer is going to lose the minus $6 billion. So cash removes all the risk to the target and it transfers all the risk to the acquirer. Those are the outcomes, right? So all the deal risk is going to remain with the acquirer in that case. And if you think about stock payment, right, the difference is that the stock payment is going to create risk sharing, right? If the deal turns out to be better than expected, remember, in a stock financed deal, the target is going to own shares in the acquirer, in the merged firm. So if the deal turns out to be great, both are going to gain more. If the deal turns out to be bad, both are going to lose, right? The target is going to share some of the losses, which means that the acquirer is going to lose less. And up here, the acquirer is going to gain less because the target is capturing some of the gains. Okay, very simple point, but it's actually a very important consideration. You know, what stock payment means is that acquirers and targets are sharing risks. A stock payment allows buyers and sellers to share the risk of the transaction. Very important consideration for M&A. And finally, there is capital structure, right? So, for example, for this deal, the price for Compaq was $27 billion. HP's market cap at the time of the deal was $45 billion, 45.8 actually. So think about this. To finance the deal using cash, what would HP need to do? Right? HP would have to get the cash from somewhere. Remember this picture, you know, cash doesn't grow on trees, so HP is going to have to come up with that cash, and most likely it's not going to have $30 billion of cash sitting in the balance sheet. So what's going to happen is that HP would have to issue debt. If you want to pay cash, you're going to have to issue debt. So M&A deals it's one of those cases that it can actually generate a very significant change in capital structure. To pay cash, companies are going to have to issue debt, and this large debt issuance in some cases is not going to be feasible, or it may not be optimal for the company, which is what we're going to talk about next. Okay? The bottom line is that paying with stock has three advantages. It minimizes taxes, it avoids large increase in debt, and it allows the acquirer to share risks with the target. And in the next lesson, we're going to talk more about capital structure, about this relationship between M&A and leverage, which we just mentioned here. Because of these advantages, what we see in the data is that stock financing is actually much more common in large deals. The largest deals that you might have heard of, like HP Compaq, for example, right? That was a very famous deal. It was, in fact, an all-stock deal. HP didn't use any cash to pay for Compaq. It paid entirely with an equity issuance. Okay? Because all of the factors that we talked about in the previous slide are going to matter more in large acquisitions. Risk sharing, of course, is going to matter more for the acquirer if it's a large deal. The increase in leverage is really only going to happen if it's a large deal, right? And so you know, what we see in the data is totally consistent with this idea that what tends to happen is that companies use stock financing to pay for large deals, and they use cash to pay for smaller deals. M&A turns out to be a great laboratory to study financial decisions. We already talked about the fact that M&A deals can create a large increase in leverage. What this means is that when companies finance a large M&A deal, they have to do hard work. They have to really think about what's the optimal amount of debt to issue. In addition to this, that might be a time that companies may be forced to change payout decisions. Should maybe dividends change when a company when a company makes a new deal? And finally, debt structure, right, is also a relevant consideration. We talked about that this topic in Module 2, right? Debt can be raised from bonds, it can be raised from banks, and when companies finance large M&A deals, they have to consider whether they have the right debt structure as well. So what we're going to learn now is that these are all very important considerations for the optimal financing of M&A deal. We're going to start with a more recent example, which is the recent deal between AT&T and DirecTV. So in 2014, AT&T acquired DirecTV. The deal was completed actually in 2015. It was announced in 2014 in May. Okay? And the data that I have for you here is what was the sizes of the companies prior to the deal. So DirecTV's market cap was approximately $39 billion in May of 2014, whereas AT&T was a larger company, its market cap was $180 billion prior to the deal announcement. Remember that the moment the market learns about the deal, the market cap is going to reflect the value of the deal as well, so it's always good to know what were the companies worth before the deal was announced. in Corporate Finance 1, we talked about the fact that target premium are usually 20 to 30% on average. So what if DirecTV had that valuation that I just showed you, what we're looking for at a 30% premium, 20 to 30% premium, is that, you know, AT&T is going to have to pay about $48 billion, you know, for the equity of DirecTV. So it's a pretty large price tag, right? In addition, DirecTV had $20 billion in debt and $4 billion in cash at the time of the deal. And one important consideration about M&A is that when an acquirer buys a target that has some outstanding debt, right, you have to assume this debt. So you're buying the company, you have to pay the debt holder somehow, right? So the acquirer is either going to carry the debt into the balance sheet or you're going to pay it off at the time of the deal, right? The acquirer becomes responsible for the debt. The acquirer, of course, is also going to own the cash balances, right? So if DirecTV owns cash, this cash is going to go to the acquirer. So what happens is that the acquirer ends up assuming the net debt. So you can think of this net debt, the difference between debt and cash, as an additional liability that the deal creates for the acquirer. In the case of DirecTV, this liability is $16 billion, so it's the difference between debt and cash. So the total sticker price is really $64 billion, right? So you're paying $48 billion for the equity. That's what you have to give the shareholders. And in addition, you're assuming this net debt. So, you know, even though AT&T is a very large company, this is 1/3 of AT&T's market capitalization. So this is what I'm talking about. These M&A deals are really going to require the company to think very carefully about financial policies. How am I going to finance an investment that is that large, right? And of course, that might be a crucial investment for AT&T as well. So finance becomes really important at the time of an M&A deal. In fact, what companies do is they use financial planning models, which is something that we talked about already in Corporate Finance 1, Module 2, right? A long-term financial planning model allows you to think about how is the deal going to change the company's financial statements. And it allows us to answer questions like, you know, can AT&T finance the investment without raising new funds? Should AT&T finance the investment with debt or equity? What's going to be the impact of debt on the financial statement? What's going to be the impact of equity on the financial statement? So this is what I want to do now. I'm giving you all the financial statements for AT&T in the period prior to the merger. So this is for your reference. We're going to pull out some numbers from these statements. You have the balance sheet and you have the income statement and the cash flow statement right here in these slides. First question, and this is simple, so I don't even think we need a financial planning model to answer this, right? Can AT&T finance a $64 billion investment without issuing debt or equity? And the answer is going to be obviously no, right? AT&T is not going to have enough cash to finance such a large investment, right? And then the next question is, should it finance the M&A by issuing only new debt, right? Or should AT&T also issue equity? That's what we were talking about before, right? Is AT&T going to issue debt and pay cash, or is AT&T going to pay for the deal by issuing stock and giving stock to the shareholders of DirecTV, right? To pay for this M&A investment by using only new debt, AT&T would have to issue at least $48 billion, right? Because that's going to be the price tag, that's going to be the cash payment you're going to give to the shareholders of DirecTV. So, you know, it's going to be the amount of the new debt issuance. In addition, as we already learned, you're going to assume some debt. So what we can do with the financial planning model is we can figure out the impact of the deal on AT&T's capital structure and to make financial policy decisions, right? So the way that we're thinking about this is we're really designing this deal before the deal is announced. The acquirer AT&T has to think about what's going to be the impact of different financial structures on our capital structure, on our profits, on our interest payments. And these financial models are going to allow acquirers like AT&T to make better financial decisions. Let's start with leverage, right? So AT&T's total debt, if you go back to the balance sheet I gave you, AT&T's total debt in 2014 was $83 billion. And as we already know, the market equity was $180 billion. If we compute leverage, And remember, that's something we learned in Corporate Finance 1, leverage must always be calculated using the market value of the equity. The current leverage of AT&T is about 30%, 31%. Does this number look familiar to you? It's actually the average capital structure of a US company. As we learned in Module 1, the average leverage of a US company in the data turns out to be around 30%. So AT&T is just like the average firm. So what happens if AT&T finances the acquisition of DirecTV using debt? We already know that it's going to have to issue $64 billion, right? So the new debt following the deal is going to be $147 billion. And here's a question for you, which is a tricky question. You know, we're going to spend some time talking about this, but I wanted to think about it first. What's going to be the market value of the new equity? So assuming that AT&T is paying only debt, right? To figure out the leverage, we have to think about what's going to be the market value of the new equity, and that's the question I have for you now. It turns out that we don't really know, okay? Because the market value of the equity, of course, is going to depend on how the market reacts to the deal, right? If the reaction is positive, meaning that the stock price of AT&T goes up, what will happen is the market value of the equity is going to go up, right? If the market reaction is negative, then you know the market value of the equity is going to go down. So ex ante, AT&T doesn't really know if the equity is going to go up or down, right? Of course, you know, presumably what the managers believe is that the deal is positive NPV, so the value of the equity will increase. But as we learned already in the data, sometimes it happens, sometimes it doesn't, right? Let's think about some math here. Very simple calculation that is going to help us think about this. So a merger is really just like adding up. So you have here AT&T and DirecTV, right? AT&T had $83 billion in debt, $180 billion in equity, right? DirecTV had $64 billion in asset. You know, it had 48 equity and 16 debt, meaning that the market value of the assets prior to the deal was $64 billion, right? And in addition, if we are financing this deal using only debt, then we are issuing $48 billion of new debt, right? So if we just add up, you know, with no value creation or value destruction, what is going to happen is that the equity is not going to change at all. So, if, you know, just adding up the companies and issuing the new debt, of course, is going to create a large increase in debt in the balance sheet of the merged company. But the market value of the equity is not going to change. On the other hand, if there is a positive reaction, if the deal is positive NPV, right, then now on top of just adding up the two companies, now we have to add the NPV of the deal as well, right? This deal is going to create value. What this is going to do is it's going to increase the market value of the equity. So it's the market value of the equity of AT&T following the deal announcement, following this, you know, this deal is going to be higher than 180 billion, right? And as we learned already, this has to reflect the difference between synergies and premium, right? So if the deal is positive NPV, that means that the synergies are higher than the premium that the acquirer is paying for the target, right? Which means that the merged, the value of the merged firm is going to increase. And if you think about this case, this is a case in which no new shares were issued, right? So this deal was paid entirely with cash, right? It was only debt financing. There was no new equity. So what this means is that there are no new shares issued. So if the equity value goes up, the stock price will also go up, right? So the stock price reaction should be positive in this case. Let's go back to leverage then, right? That was our question. Now we know what should happen to the market value of equity, but let's try to figure out then what happens to the leverage, right? We know that was an easy calculation that the total debt of AT&T following this deal, if you pay only with cash, is going to be 147 billion, right? And we know from the data that on average, market values don't change. Of course, that's not what the acquirer wants, right? The acquirer would love to see an equity value shoot up when you announce a deal, but you have to be realistic, right? On average, it may not happen. So a conservative approach may be to say, yeah, we think this is a great deal, but the market may not like it. So let's do the calculation using the current market value, which was 180 billion. And if you do this calculation, what you figure out is that your leverage is going to increase to 45%. So it goes from 30% to 45%. Is it too high? Right? Now what we're going to do is we're going to use what we learned in modules 1 and 2. We talked about trade-off theory of capital structure. We talked about credit ratings, right? So let's think about, should AT&T increase its leverage from 30% to 45% or not? In module 1, we talked about the trade-off theory of capital structure, which is the first consideration we're going to think about here to decide whether AT&T should increase its leverage or not, right? So the median firm in the US has a leverage of 30%, and by doing so, it creates a 5% in value relative to a firm with zero leverage, right? That's the picture we learned in the first module. And our financial planning model for AT&T, right, generated this increasing leverage, right? If AT&T decides to pay for DirecTV using only cash, right, financing this deal with debt, what will happen is that the leverage ratio of AT&T is going to increase to 45%. If you look at this picture, right, and if we assume that AT&T is like the median firm, this means that AT&T is probably going to be destroying some value by issuing additional debt. You may think that, perhaps AT&T has more debt capacity than the average firm. We also talked about the fact that the trade-off theory applies differently to different types of firms. So for a large, profitable firm like AT&T, it may be possible to have higher leverage, right? So maybe 45% would not be such a high leverage ratio. However, as we also learned in this course, it's also important to think about credit ratings. Right? What is AT&T's current credit rating, and would it be able to maintain its credit rating after such a high increase in leverage? Right? And what turns out is that AT&T, if you think about ratings, right? We saw this table also in the course before. There is a relationship between the leverage of a company and its credit rating. Right? So AT&T right now is on about 30% leverage. So if you look at the credit rating of AT&T, it is about BBB. Okay, so AT&T has a current credit rating of BBB, which corresponds to a leverage ratio of 30%, just like the median firm in the US. But if AT&T decides to increase its leverage to 45%, this table would suggest that AT&T is risking a credit rating downgrade. And in particular, as we talked about in the course, going from BBB to BB, that's the range that really worries companies, because it means that the company might be downgraded in what we call the junk territory. Right? AT&T might become a junk company in the sense that its debt would have a credit rating that is lower than BBB minus. And these rating downgrades can be very costly for companies because they affect the company's access to capital, for example. It affects AT&T's ability to issue commercial paper, right? It affects the cost of debt. So AT&T might be very careful about issuing, issuing debt that is going to cause it that is going to cause a credit rating downgrade into junk territory. And if you look at the data, that's in fact what happened. This deal was not financed only with cash. DirecTV shareholders received $28.5 in cash, but they also received stock in AT&T. Right? The specific exchange ratio for this case was 1.892 shares of AT&T per each share of DirecTV. So what this means is that AT&T issued 954 million new shares following the DirecTV acquisition. And if you do the calculation here, $28.5 in cash represents $14 billion in, $28 per share represents $14 billion total cash expenditure. Okay, so it was both cash and stock, perhaps because AT&T was concerned about the credit rating. If we look at the credit rating, this is recent data following, this is already 2016, so after the deal was announced, after the rating agencies learned about this deal, what happened is that AT&T was able to maintain an investment grade rating. Rather than being downgraded, AT&T kept its rating of BBB+, okay, which is the range that companies like to be at, as we discussed in Module 2. Stock price, right? We talked about the fact that the equity value of AT&T following this deal is going to depend on how the market reacts to the deal, right? And what happened in this case is, in fact, that the stock price of AT&T went down a little bit when the deal was announced, right? So the date of the announcement is marked here. You can see that there was a slight decrease. It wasn't a very large decrease, but the market did react negatively, right? This is consistent with the fact that, this deal was stock financed. AT&T decided to issue a large amount of equity to finance this deal, so perhaps the market was reacting to the equity issue. And here's a question for you, right? We talked about debt structure in Module 2, right? We talked about types of debt, bank, bond, commercial paper, right? AT&T is, of course, a large public company, and it's issuing a significant amount of debt to finance this deal. It wasn't $40 billion, but it's still $15 billion in cash, right? So what would you expect? What type of debt is AT&T going to issue to finance the acquisition of DirecTV? And here's the answer. Just directly from the data, you see that AT&T really doesn't have that much bank debt. As a result of the deal, though, there was a little bit of a debt issuance here in 2015. What you see is that now AT&T had a $10 billion term loan that was issued about at the same time of the deal, right? But still, most of its financing comes from the bond market. So AT&T DirecTV is not really a case where there was a big shifting to bank financing. As we're going to learn next when we talk about private equity deals can be quite different. But in this case, there was a moderate, if any, a moderate increase in the amount of bank debt that AT&T has. Payout, that's the third consideration, right? So should AT&T change its payout policy after the deal or not, right? And here is the trade-off. Lowering the payout is going to allow the company to conserve cash, right? Financing this deal is requiring AT&T to issue a significant amount of new debt, right? However, lowering payout may lead to a negative stock price reaction, right? As we learned already in the course, the market reacts positively to stock repurchase and dividends, so cutting dividends, cutting stock repurchase may not be good for the stock price. What happened? Here's the data. And again, looking around the time of the deal, right? You see that AT&T actually did not change its dividend policy. It was paying about $10 billion of dividend in 2014. Following the DirecTV deal, it's still increasing its dividend over time. So it paid $10 billion in 2015, $11.7 billion so far up to September 2016. There seems to be a little bit of a decrease in stock repurchase, though, right? Because it was at $1.6 billion, now it went down a bit. It's still $700 million in stock repurchase in 2016, a little bit lower than what it used to be. So just to summarize, right, the most important thing we learn here is that, in this large deal, right, AT&T had to finance this large deal, and that probably forced the company to issue stock to mitigate the increasing leverage and to maintain its credit rating, right? There was a negative stock price reaction, maybe partly because of the equity issuance, but that's what AT&T had to do to get this deal financed. AT&T's debt is still mostly bonds, but there were some loans issued in 2015. And finally, there was no significant change in the dividend policy, perhaps a small reduction in stock repurchase. So that's the bottom line of everything that happened to AT&T's financial policy around the time of the DirecTV acquisition. Finally, the last thing I want to show you here is that we can actually see, this is a very cool accounting fact, when a large deal like that happens, we can actually see how the deal impacts the company's financial statements. I gave you before the balance, all the financial statements for AT&T prior to this acquisition. You can actually see what happened following the acquisition. So this is the first balance sheet that was published following the acquisition, and you see that, of course, the total assets are going to significantly increase, right? Because AT&T is acquiring a new company, a large company, so assets are going to go up a lot, right? You see that intangible assets increased, right? Most of the assets that AT&T is acquiring here are intangible, but then there is this other item called goodwill. Goodwill is where the acquirer is going to record the premium that was paid for the deal. AT&T is, of course, paying a large premium for the equity of DirecTV. This premium is going to be reflected here in the goodwill. So you can see that goodwill is going up significantly between 2014 and 2015. And finally, here in the bottom, you see that this deal did result in a very large increase in long-term debt for AT&T. Long-term debt went up from $77 billion to $122 billion following the acquisition of DirecTV. In terms of the income statement, again, we would expect the acquisition to increase revenues, for example, right, because you're adding DirecTV. You can see it here. There is also an increase in operating income, right? And then at the bottom, you're going to see also an increase in shares outstanding, right? Between December 14 and the most recent data, you'll see that the amount of new shares that AT&T has gone up by about 900 million. Okay, so this, of course, reflects the fact that AT&T is using equity, is using stock issuance to pay for this deal. So here's a question for you. You just saw AT&T's 2016 income statement, right? And as we discussed already in this course, synergies are very important for an M&A deal, right? So the M&A deal has to be motivated by the synergy, by the new profits that are going to be created. So this is the question: should AT&T's 2016 income statement already reflect synergies or not? And the answer is that probably not yet, right? Synergies are probably going to take time to realize. That was also the case in the HP Compaq deal, right? Usually, what will happen is that it might take a few years for the synergies to affect the bottom line. In the case of this deal, what the management discussed is that they expect a $2.5 billion annual synergy, but only starting in 2018. So whatever change you saw in the income statement is a purely mechanical change. Operating income is going up, but not because of synergies, simply because you're adding two profitable companies. Okay? And then finally, if we look at the cash flow statement, we can see again the impact of the acquisition. There is this item called cash acquisitions, right, which is going to show that AT&T spent a significant amount of cash in that year to acquire DirecTV, right? And this is probably going to result in a negative change in cash, right? It's because of this negative change in cash that AT&T was not able to finance this deal only using debt, right? That would require an even larger negative change in cash and a larger increase in the leverage ratio, right? Which forced AT&T to finance this deal partly by using equity as well. Let's talk now about private equity acquisitions, which is a very interesting type of acquisition to discuss in terms of its financing, because the acquirer in this case is an investment company, right? Rather than AT&T acquiring DirecTV, now what we're going to have is an investment company, a private equity fund acquiring another company. In a standard deal, which is usually called a leverage buyout, the target is going to become private. So all the shares of the target are going to be bought by the private equity fund, right? So we have this private equity fund buying out all the shares of the target, right? So these characteristics are really going to matter for the optimal financing of the deal because, for one, the acquirer is going to have difficulty issuing public equity, right? You're a private company, you're a private investment company, so you really cannot issue public equity. That was the final outcome of the AT&T DirecTV deal, is that AT&T decided to issue equity to mitigate the increasing leverage. But in the case of private equity acquisitions, that might not be feasible because the acquirer does not have public equity to use. Okay? In addition, the target becomes private. So if you're buying out all the shares of the target, you're not going to be able to issue equity on the target as well. So what tends to happen in leverage buyout deals is that these are actually, in fact, going to be all cash. So these are deals in which the acquirer does not have the luxury of being able to issue equity. These are going to be all cash deals, right? And the sources of capital, the sources of this cash are going to be two. They're going to come from debt financing, which, by the way, that's why leverage buyout is called the leverage buyout, because it's financed with debt, but it also comes from the private equity. In Corporate Finance 1, we talked about the Dell leverage buyout, which happened in 2013, right? In that case, there was $15 billion of new debt being issued and a $6 billion infusion of cash from the acquirer. Just to give you another example here, in the same year, there was another acquisition, another private equity deal by 3G Capital and Berkshire Hathaway. That's Warren Buffett's company. And what these guys did is they acquired Heinz, right, using $6 billion in new debt, and in this case, $17 billion in cash from the acquirer, right? So you see that there is no new equity issuance here. It's all cash and private. It's all debt and private equity financing this cash, right? So this mix of debt and private equity is what's going to determine the capital structure of the target firm. And then, of course, what happens is that this debt is going to have to be paid off using the cash flows from the target. You issue debt to finance the deal, and then the target cash flow has to pay off this debt. The equity comes from the limited partners, right, which are the people who invest, the wealthy investors who are investing money in private equity funds, or, they may come from previous investments as well. For example, Berkshire Hathaway, of course, has a significant amount of cash that comes from successful previous investments, and they could use that cash to help finance the Heinz leverage buyout. Okay, so, but it's almost inevitable the case that since there is no access to new public equity, private equity acquisitions tend to be associated with large increases in leverage. We, in fact, in Corporate Finance 1, we gave the example of the Dell leverage buyout, which, according to our estimates, leverage in that case went up from around 20% to more than 60%. So a very significant increase in leverage following the acquisition of Dell by the private equity fund. Right? That's why these acquisitions are called leverage buyouts. And the cool thing is that now, we know a lot more about optimal leverage and what a 60% leverage ratio means, and we're really going to use what we learned to try to understand the optimal financing in leverage buyouts, right? So this is a case in which the private equity fund has to optimize everything, right? Going from 20% leverage to 60% leverage is really going to change, the shape of the company from a financial standpoint. So all sorts of considerations here are going to matter, and we're going to talk about at least those 5, starting with target selection. So let's start right here with target selection, right? Which types of companies are going to become LBO targets, right? So which types of companies are going to be able to go from a 20% to a 60% leverage? Think about that for a while. The answer is that the private equity fund has to look for companies that are somehow under-levered, right? Companies that can increase their debt by a significant amount, right? If the companies are already very highly levered, it's going to become much more difficult to finance this deal. So private equity funds are typically going to be searching for companies with strong cash flow and strong collateral, right? But also companies that have low current debt. This is going to allow the private equity fund to issue more debt at the time of the acquisition and help finance this deal, right? In the data, we actually see that very clearly. Remember the paper by Korteweg where it's this quantitative trade-off model that we talked about in Module 1. Korteweg shows that leverage buyout targets are on average under-levered, consistent with our intuition. In an average LBO, in fact, value can increase by 1 to 2% if the target moves to the optimal capital structure. So this is what it looks like in the data. The actual target of a leverage buyout is on average to the left of the optimal capital structure. So that allows the private equity fund to increase leverage a bit without changing value, right? And maybe even overdoing a bit without destroying value, because if you go over the optimal but you don't fall too much, right? You might still be better than what the company was at the current leverage ratio. So private equity funds are definitely going to look for companies that are to the left of their optimal leverage ratio. But you know, that's not going to always happen, right? You might ask, but why would a company have suboptimal leverage? And the answer is that it may not. Many good targets may actually already have optimal leverage, right? The private equity fund, you know, will then not really have sufficient equity to move to the optimal leverage. If you cannot issue a lot of debt, right, then you're going to have to finance this deal using your own money. The money may not be enough. So in some cases, leverage can become too high. For example, Dell, right? If we look at Dell, the leverage of Dell prior to the LBO was 26%. And if we think that Dell is like the median firm, again, you know, this is not something we can state for sure, but if we just use the median firm here for comparison, you know, Dell was actually pretty close to the optimal capital structure, whereas, you know, post-LBO, you're moving way to the right, so you're probably destroying some value here by issuing so much debt. And this is the question that we need to think about, right? So how do private equity funds address this high leverage problem, right? If leverage is too high, the risk of financial distress increases, as we learn, right? And it might become more important than the tax benefits of that. So the risk that private equity companies face is that companies are going to have difficulty making future interest payments, right? So it's very important at the time of private equity acquisition to think about all the ways that private equities can address this high leverage problem. Let's talk about the high leverage problem. How do private equity funds address the high increase, you know, this increasing leverage that is almost the natural consequence of leverage buyouts? And what we're going to learn is that there are many ways actually that there are many changes in financial policy that are engendered by a leverage buyout, including changes in payout, different types of debt, and even creative financing structures. So let's get started talking about debt structure. This is something that we discussed a lot in Module 2, right? We talked about the fact that there are different types of debt in the real world. And a large company like Dell, a large public company, will typically issue only bonds, right? Rather than having bank debt. If you look at the financial structure of Dell, it will probably be mostly bonds. However, what we'll learn now is that in the financing of a leverage buyout, even for a large public firm like Dell, that's probably not going to be only bond financing. Instead of banks or bonds, what LBO funds like to do is to issue both bank debt and bonds. Okay, so a leverage buyout is going to be a case in which bank debt is going to be very important. Let's start here by showing you the debt structure of Dell prior to the leverage buyout. So this is going to look very familiar, right? It's a large public company. I think we've seen 5 or 6 different tables like this. Prior to the leverage buyout, Dell had mostly bonds, right? So for example, in 2011, out of the $6 billion of debt that Dell had, $5 billion were bonds, and it had a drawn on a credit line, but so that's what the revolving credit stands for, but it was mostly bond financing. However, at the time of the leverage buyout, this additional $15 billion, right? So that's a lot of new debt. This additional $15 billion that was raised at the time of the leverage buyout actually came from banks and from Microsoft. Microsoft also gave a loan to Dell at that time. Okay? We don't have any data on that structure right after the LBO because Dell became private. Okay? Even though we're actually going to see some data in a while, a few years after the leverage buyout, but there is no data right there, but we know that just based on the deal financing that most of the debt came from, or almost entirely came from bank financing. And the question is why, right? So why did Dell choose to issue bank debt rather than bonds? So let's remember the basic trade-off we talk about. The main benefit of bank debt is that bank debt can lower interest rates. Right? Because you're giving more control to the bank, because you're posting collateral, you're making the debt senior, you have additional financial covenants, the bank debt will typically result in lower interest rates. That's the key point we learned in Module 2, right? On the other hand, yes, you are giving more control to the bank, so you're losing some control by using bank debt. And the key idea is that for a leverage buyout, this decrease in interest rate is going to become especially valuable. Right? That's the time when leverage increases a lot, you're concerned about the risk of financial distress, so reducing interest rates becomes extremely important at the time of a leverage buyout. Right? The typical debt structure in an LBO will have, as I said, banks and bonds, so it will have a bank loan, right, with short to medium maturity, typically 5 to 8 years, and then it's going to have some additional financing as well. The bonds that are issued at the time of a leverage buyout are typically going to be what we call junk bonds, right? So these are bonds that are issued by companies that have a junk rating because the leverage is so high that LBO targets like Dell are not going to be able to have an investment grade credit rating anymore. And then there might be some other financing as well. Of course, the financial structures in practice are fairly complicated. There are many different types of loans. So this is how the financing of the Dell leverage buyout actually looks like. There was a $6 billion senior secured loan. But there was also the loan to Microsoft, some credit lines. You can see, though, that we don't have to talk about all these details, but these are all bank loans. Okay? What Dell did was actually to use mostly bank debt to finance the leverage buyout. Right? So bank debt is one of the recourses that private equity funds have. The second thing that private equity funds do is to plan for early repayment. Right? So this is not a case where you're optimizing capital structure. 60% is not an optimal capital structure. Okay? It's going too high. So typically what private equity funds plan is to reduce leverage. If performance turns out to be good, then there is going to be a plan to pay down the debt and go back to a more reasonable capital structure. If you look at Dell, I actually showed you this article already in Corporate Finance 1, right, where we talk about how what actually happened to the Dell leverage buyout. But one interesting point you can see here is that the company Dell has actually used its cash flow to shrink debt, right? So consistent with what we're talking about, Dell is in fact trying to pay down some of its debt, down from the amount that it started with, what was $18 billion. Now, according to this article, it was $15 billion. Third thing that PE funds optimize is payout. Okay, and we talked about payout in Module 2 as well, right? Companies determine the optimal payout policy, focusing on cash management, signaling, and all that. So let's think about leverage buyouts. How would a private equity fund change payout policy following leverage buyouts? What happens to dividends? What happens to stock repurchase? And the answer is quite simple. Typically, what private equity funds do is to, reduce payout as much as possible. Okay? Both dividends and share repurchase will typically go to zero, right? The leverage buyout is a time when cash is very tight, cash is very valuable, right? The goal of payout policy is to distribute excess cash, right? So when cash is tight, it makes no sense to pay it out. What we know from the data and several examples is that private equity funds actually typically cut payout to zero. Okay? And we can actually get some data, as I mentioned before, to look at this, because Dell is a cool example in that in 2015, what happened is that Dell decided to acquire this company called EMC, and as part of the financing of this acquisition, it issued tracking stock on a company that was partly owned by EMC, and because of that tracking stock, there's some legal details here that we don't have to talk about, but essentially what happened is that Dell was forced to disclose information at that point. So Dell became public again for the purpose of disclosure, so we can actually look at the financial statements of Dell. It's a unique opportunity for us, because typically what happens is that when companies go private, we can no longer see the financial statements, but for Dell, we can actually see what happened to things like payout following the leverage buyout. So we have a window into an LBO, which is really cool for us. So this is, and here you're going to see very clearly, okay, at the time of the leverage buyout, which happened in 2013, 2014, right? You can see that both dividends and stock repurchase were cut to zero. Okay, so Dell was doing significant amount of repurchase in 2013. There is no stock repurchase after the leverage buyout, and dividends were also cut to zero. As you can see, 0 dividends in 2015, 0 dividends in 2016. So that is the optimal payout policy if there is a very high increase in leverage, right? Which, by the way, you can see here that in 2014 there is a large amount of debt issued to finance the leverage buyout. Okay, and then you can see afterwards that Dell is trying to repay some of its debt, consistent with that newspaper article that we were talking about. In addition, like I said, we can get recent data on the debt structure. We don't have data on the debt structure right after the leverage buyout, but we do have the recent data, and you can see that, in fact, Dell has changed it, right? It used to be an all bonds company, right? It had only outstanding bonds. Now it has both bonds and loans. Okay, so the debt structure changed significantly as a result of the leverage buyout, right? So now it's about about half and half, even more loans, right? So it has a higher fraction of term loans than senior bonds in its capital structure. Finally, we talked about all these ways that private equity funds address high leverage problem. With all these alternatives, even with all these alternatives, there are cases when the private equity fund may not be able or may not want to increase leverage too much. So we almost think of these as LBO deals that are not really LBO deals, right? So LBO between quotation marks. In such deals, and they end up requiring more equity and the use of what we think of as creative structures. So here's an example. That's a cool picture of Warren Buffett talking to Barack Obama. And Warren Buffett, of course, is the CEO of Berkshire Hathaway. Berkshire Hathaway acquired Heinz through a standard leverage buyout earlier in 2013, as we already talked about. That was a standard PE deal. But then in 2015, Heinz decided to acquire Kraft. How did they finance that deal, right? So this is sort of a private equity deal because it's a private equity company buying Kraft, right, to merge with Heinz. But in this case, there was no new debt issuance. The deal was financed with $10 billion in cash from the owners, from 3G and Berkshire, and new stock issued by Heinz, right? So in this case, because the private equity fund owned another public company, it could merge those two companies and use some of the equity of Heinz to help finance this deal. So that's an example of what I mean by creative financial structures. Of course, the outcome is that Berkshire Hathaway and 3G Capital did not have to issue any new debt to finance this deal. As the previous example, I think, already shows, a private equity acquisition is a type of deal that is very heavy on finance. It's a situation where financial modeling, financial policy is extremely important. Okay, so, and there is, in fact, a model, a financial model that is very specific to private equity deals, which we call LBO model. It's a leverage buyout model. You know, it has its own name in finance jargon because it's a very common model that private equity firms use. The goal of this leverage buyout model is specifically to forecast a company's ability to repay debt. As we've been discussing, a leverage buyout is a situation when leverage increases a lot. In some cases, it might increase beyond, you know, what's the optimal point. So it becomes very important for the private equity fund to optimize financial structure and to make sure that the target is going to be able to repay debt. What the LBO model is going to allow us to do is to write this down in a financial planning model and to improve our financial decisions. What I want to do is I want to give an example of a leverage buyout model using a recent deal. That was the leverage buyout of ADT Security Systems that happened in 2016. ADT was acquired by Apollo in about $7 billion deal. It was one of the largest standard leverage buyouts that happened during 2016. That price is a 56% premium over the pre-deal value, right? So as we learned already in the course, private equity funds also pay large premium to shareholders of targets, right? And what we're going to do now is we're going to talk about financial policies. So specifically, we're going to learn how we can use a leverage buyout model to help make financial policy decisions at the time of the LBO, right? So the steps of a leverage buyout model are typically these three steps where you start by gathering data pre-LBO on key financial policy variables, and then we incorporate the financial consequences of the LBO and analyze the results. That, as I discussed already, is going to allow us to perhaps make better informed financial decisions. Let's look at the data for ADT. So this is a snapshot from ADT's capital structure prior to the deal announcement. It had $5.4 billion in outstanding debt already. The equity was worth like about $4.5 billion at that time. The debt structure, again, typical of a large public company like ADT, most of the debt was coming from bonds at that point, right? So ADT had $5 billion in outstanding bonds prior to the leverage buyout, and it didn't really have much in terms of term loans. You know, it had drawn down on a credit line, but it didn't really have any term loans at that point. This is some data on financing costs and ratings. You can see that ADT already had kind of a lowish rating, right? Its credit rating at the time of the deal was BB minus, okay? And you can see that the yields to maturity that ADT was paying at that time were around 6%, or the coupons here. I think that's going to be more relevant data on the interest payment. The ADT was paying coupons of the range of 4 to 6% at the time of the leverage buyout. And finally, we look at payout. ADT was actively repurchasing stock and paying dividends prior to the leverage buyout. So it was distributing cash to investors. Okay? So let's put this together here. That's the summary. ADT is starting this leverage buyout with a high leverage already. It's 55% leverage, a rating of BB minus, an average interest payment of approximately 5%. That comes from the coupons. Okay? And it's paying out $140 million a year in dividend and repurchasing $320 to $1.4 billion a year in the previous 3 years. So that's a summary of those pictures, those tables that we saw. So what we're going to do is we're going to build some cash flow forecasts using this data, right? So this is a standard financial planning model similar to what the ones we learned in Corporate Finance 1, right? So what we're going to do is we're going to forecast the company's profits, forecast the company's interest payments, and all of this data uses data prior to the LBO. So that's what we call this pre-LBO cash flow forecast. So you can see here that the interest payment is 5% of the amount of debt that ADT had prior to the LBO, for example. Some of these forecasts, like forecasts for for profits, for EBIT, come from Capital IQ. Some of the other forecasts I'm making up myself. So for example, I'm assuming that capital expenditures are going to keep growing at a constant rate, that the company is going to pay dividends and share repurchase at the same amount that it paid in 2015, for example. And then what we can see, the bottom line, as we did in Corporate Finance 1, is we can measure the change in cash. Okay? So in particular, for this example, for the next 5 years, what's happening is that ADT does not seem to be generating enough cash, right, to increase its cash holdings. In fact, it has negative changes in cash forecasted for all the next 5 years. Right? The bottom line is that even prior to the LBO, ADT is already in a tight financial situation. This is a company that really doesn't have a lot of operational cash to spare. It's already facing a tight budget. Given this, right, if even before the LBO, right, probably what needs to happen is that ADT would either need to cut capital expenditures, payout, or else raise additional capital from investors. The current situation doesn't seem to be sustainable, right? What's going to have to happen is ADT might have to have, even if the leverage buyout had not happened, ADT might have to change something about the financial structure of the company. And now come the LBO, right? So starting from this situation, starting from this tight budget situation, ADT is being acquired by a private equity fund, right? Given what we just learned, how much new debt would ADT be able to support, right? So I think it would be pretty easy for you to guess what is the new, what would be a reasonable guess for the financial structure of the ADT LBO? That's the question I have for you. The answer is that ADT is probably not going to be able to support that much debt, okay? Because it's already starting from this tight financial situation. The ADT leverage buyout is probably going to have a large equity component. And this is what we're going to see going forward. I'm going to show you how the LBO was financed, and it actually turned out that the LBO was financed with a large equity component. We're now going to learn how to use the LBO model to test different financing structures that a private equity fund might want to use for the ADT buyout that we're talking about. So far, what we figured out is that the ADT buyout will probably have to include a large equity component because the company really doesn't have the ability to take in a lot more debt. But we're going to be able to go a little bit further using our financial planning models and really test different financing structures that the private equity fund might consider, and really figure out how will these different financing structures affect the cash forecasts following the LBO. So we think of this as the post-LBO cash forecast. So really what we're doing here is a testing, is a what-if exercise. Okay, so let me give you a specific proposal. Let's say we start with half and half, okay? Just 50% equity and 50% debt. That is, in fact, a large equity infusion. It would require, given the size of the buyout, it would require Apollo to write a check of $3.5 billion almost. It's a large amount of equity investment for a private equity company, right? But you're still issuing 50% debt to finance the transaction. In addition, as we discussed before, very commonly in a leverage buyout, payout is going to be cut to zero. There's no point in paying out cash if you're tight on cash. So let's cut dividends and repurchase to zero. And let's assume for now, again, this is just an assumption, that the debt is going to come from a new 10-year bond. So 3.5 billion equity, 3.5 billion debt. In order to forecast cash, we have to figure out the interest payment. The current average interest, which we looked at in the previous session, was 5.2%. That's what ADT was paying the current bonds. 5.2% the yield to maturity on a 10-year bond prior to the LBO was 6.2%. So as we learned before in this course, if a company issues debt now, it will probably pay something closer to the yield to maturity. The coupon is not a good estimate of the new interest rate you're going to pay on a new issuance. So it would be 6%, but ADT is increasing that, right? So that is going to go up because you're issuing $3.5 billion. So it would be reasonable, I think, to even assume that ADT will probably going to pay even more, right? If the current yield to maturity is 6.5, you're probably going to go even higher than if you issue more leverage. Okay, investors, as we learned in Module 2, investors are going to demand compensation for the risk of default. So just to give a specific example, let's say that the yield on a new bond is 7%. That means that the new interest that ADT is going to have to pay is about $240 million. In addition, of course, there's going to be an increase in operating performance, right? Because Apollo paid the premium of 56%. It would be crazy to pay a premium like that if you don't expect performance to increase following the leverage buyout. We discussed this in Corporate Finance 1, in fact, right? It must be the case that ADT's operating performance is going to go up as a result of the leverage buyout. Maybe there's going to be some restructuring, optimization of the management, whatever, cost cutting, whatever Apollo thinks that it can do to ADT to increase operating performance. Let's just say, for the purpose of our model, that our EBIT is going to increase at 20% following the leverage buyout. Okay? With these numbers, what we can do is we can go to our financial planning model and incorporate these new forecasts. And what I did here is I highlighted in bold the changes that the private equity fund is implementing. All the other forecasts are exactly the same as you saw before. Okay? So now what you see there is that we have a 20% increase in EBIT following the leverage buyout. So you can see that going from 2016 to 17. Your interest payment is also going up, okay, to $522 million with the new interest you're paying on the bond. Payout has been cut to 0. And at the end, with these changes, what we see now is that ADT is generating some cash, right? So except for year 1, when the operating performance increase hasn't materialized yet, in the other years, ADT is going to generate cash. So ADT is now cash positive. It generates, if you sum the changes in cash, it's about $500 million of cash between 2016 and 2020. But notice, though, that leverage is still quite high, right? If you sum the leverage that ADT had before the LBO with the new debt, that's going to be close to $9 billion, right? We can also look at EBIT divided by interest payment, the interest coverage ratio. Looking at the previous table, the interest coverage ratio is going to be less than 2. Right? So here's a question for you. Given this data, why may Apollo still be concerned about the financing proposal? The company is cash positive, but that may not be the final answer. Why? The reason is that this company is still in a very highly levered position. Remember, the concern with high leverage is financial distress. Right? So what could happen in a situation like this is that even a small decline in performance, your EBIT over interest is 2, so a relatively small change in performance might bring ADT close to financial distress. Right? For example, we forecasted that EBIT is going to increase by 20%, but maybe this increase in operating performance may not materialize. Right? So that is the high leverage problem we were talking about in the previous session, right? And what private equity funds have to do is to address the high leverage problem. That is, really the lifeblood of financial management for private equity funds. How are you going to address the risks of high leverage? A very obvious answer is that Apollo may have to spend even more cash, right? Of course, as we already discussed it, that's going to be constrained by how much cash Apollo has, right? Apollo is a private equity fund. You're going to have to raise this cash from your limited partners. and you may have it or you may not have it. Well, that may not be an option. The other option that typically private equity funds will always have is to issue bank debt. Okay, so that's something new, I think, that you're learning in our private equity discussion, is that bank debt may really have an important role in this situation. Okay, so let's look at the proposal, and then I think we'll understand this. Let me give you the final proposal. This is what Apollo ended up doing. It wasn't, in fact, able to spend that much more cash. And like I said, an obvious solution would be to maybe spend $5 billion in cash, but it might be the case that Apollo didn't have that. So what they did for sure is they issued some bank debt. So instead of issuing a bond, they went to banks such as Barclays, Citigroup, Deutsche Bank, right, to try to get the financing for this acquisition instead of issuing a new bond. In addition to that, and this is actually a new idea we're going to talk about in this example because it was important for the ADT case, is that they also resorted to what we call preferred equity, which we're going to talk about. And this preferred equity was provided by the investment arm of Koch Industries, which is another company actually. Okay, so let me give you some details on bank debt. There is no actual data on the interest payments because, as we already discussed, when a company goes private, essentially the data disappears. They don't have to disclose data anymore. We really had a unique opportunity in our Dell example to look at the Dell's data. Okay, so as we learn in this course, the important idea is that the bank interest payment is likely to be lower than 7%. Right? The company is going to be able to save some interest payment by issuing bank debt instead of having bonds. The way you do this is by giving additional control to the bank. Right? In fact, what happened is that Apollo raised acquisition debt of $8.4 billion in addition to a relatively small credit line facility. This data comes from Capital IQ, as you know, many of the data are using this course. So here's the question. Why are they raising so much debt, right? It's 8.4. And the answer is that, you may be able to actually go a little bit further, right? If the bank debt comes at a low enough interest rate, it may actually make sense for Apollo to refinance the existing debt. You can use the additional bank debt to buy back the bonds. That's going to, force you to spend cash, but at the same time, it's going to reduce your interest payment. Right? So your cash position might increase if you use low interest rate debt to buy high interest rate debt. In addition, another real-world consideration is that the bond may have covenants. We talked about covenants in Module 2. There may be bond covenants that require a company to buy back the bonds at face value if there is an acquisition. Bondholders are not stupid, right? They may be able to anticipate that a company like ADT may be acquired, and they might include a provision in the contract that guarantees the value of their debt, right? Even if ADT issues more debt, the value of the bond debt will not go down. So because of these reasons, it might have been necessary for ADT to have additional bank debt. Let's make a few assumptions here to use our model. So just for the sake of the example, we are going to assume that ADT issued just enough bank debt to finance the deal and did not refinance bonds. Given the preferred equity issuance, the amount of bank debt that is just enough to finance the deal is $2.5 billion, 2.55, and let's say that the interest rate was 5%. That's not an unreasonable guess, given the difference in interest rates between bank debt and bonds for the same company, right? Given that bank debt is much safer, right? So that will give us a total interest payment of $408.35 million if we sum the new interest on bank debt with the pre-LBO interest. And now we have to talk about preferred equity. So that's just an example, of what a preferred equity contract is. That's an old one. Okay, but what is this? A preferred equity is a security that is a little bit like equity and a little bit like a bond. So it has a promised return that's going to be similar to an interest payment. So whoever owns the private equity is going to have a promised return, let's say 8%. Okay? However, the private equity is junior to bonds. And the crucial issue is that the payment of this interest, it's interest, but it can be postponed if the company runs into financial trouble. So if ADT becomes financially distressed, Apollo can contact Koch Industries and say, look, we're not going to be able to pay interest on preferred equity. That event is not going to trigger financial distress. Okay, so let's say that the interest on preferred equity is 9%. It makes sense that this would be higher, right, because it's a much riskier investment. In dollars, that's going to be $67.5 million a year, right? And what we can do now is we can include this estimate in our financial forecasting model, right? So this is our final proposal. Notice that your interest payments have now significantly decreased because despite the fact that Apollo wasn't able to issue, to spend more cash, it was able to issue bank debt and the preferred security. But we are also, of course, incorporating the preferred dividend payment here. It's probably the first time you see this in our forecasting models. For this case, it's important to incorporate the fact that you expect to pay a preferred dividend of $60 million on the ADT acquisition. So here it is, okay? And given these changes, we can reforecast cash, right? You can see here at the bottom, and that's what the numbers look like. They're cash positive, right? However, it's still a pretty tight financial position. Despite all the financial engineering, ADT, hasn't been able to really make this high cash generating deal. Okay, so the total change in cash is $500 million, right? This is not that different from what we calculated in our previous proposal. So here comes a question for you. This is actually the final proposal, right? So is ADT in a stronger financial position or not? The answer is yes, right? Why? Your cash, your cash forecast hasn't changed much, but there's this crucial point that preferred equity is not debt, right? It cannot trigger default. So really, what matters is the interest payment. The ADT has to make the interest payment. If you don't make the interest payment, you're going to become distressed. The preferred equity payment is almost like a dividend. In a tight situation, it can also be cut to zero. So if you look at the forecast, ADT did have higher interest coverage under the final proposal. So you have a little bit more flexibility, to even accommodate a small decline in performance and not become financially distressed. Okay? So just summarizing here, right, the first proposal had a bond issuance, and because of that, you had higher leverage and low interest coverage. With the new proposal, we are actually able to reduce leverage because preferred equity is not leverage, right? And your interest coverage is now higher. So it is, even though ADT spent the same amount of cash, and even though the forecasted change in cash is not that different, this is definitely a stronger financial position. If Apollo is still concerned, right, that's still too tight, there are a couple more things you can do. One of them we talked about already, right? We assumed that this is actually a conservative assumption. We assumed that they were going to issue just enough debt to finance the deal, but they do have that additional amount of bank debt that they can issue if they want, that they secured for the deal, right? So what they can do is they can issue more bank debt, repurchase some of the bonds, and thereby they can lower the interest rate even further. Your EBIT interest coverage is going to increase even further if you do that. Okay, so increasing bank debt will typically send you further away from financial distress. And of course, the other thing that they can do, if you can't do anything else on the financial side, you might have to go and think about cutting capital expenditures, for example. Our plan so far maintains the same amount of capital expenditures that were forecast prior to the LBO. Our final example in this module is going to be the financial management of R&D investments, which is, of course, a very important source of value creation for companies in the real world. In fact, in Corporate Finance 1, we spent quite a bit of time learning how to develop a financial model to value our R&D. Okay, and we're actually going to start from this to start thinking about how to finance the R&D, right? So in Corporate Finance 1, we learned the valuation of R&D, now we're going to learn the financing of R&D. So let's recap the main points by using the new drug example that we talked about in Corporate Finance 1. So to develop a new drug, a pharma company will probably have to go through several stages, right? There's going to be an initial stage when you're going to test a small number of volunteers. Some of the more promising drugs are going to move forward. There's going to be future stages, right? And by the end, you're really testing this drug in thousands of patients in a global sample. And finally, if the FDA approves, you can launch this drug, right? So what we also learned is that each phase requires an increasing investment. So the late phases can each of them cost $500 million for a single drug. Right? So we actually used this data to build a simple numerical example to allow us to think about R&D, right? So that's how our example looked like. You have an initial investment that's going to be probably on the small side, right? Most of these R&D investments are going to fail, so 95% chance there's going to be no new drug developed, no useful idea, right? And then on 5% of the cases, you're actually going to develop something useful. If you do develop something useful, you have to spend a lot of money, right? Because that's the late stage where you really have to test this into many thousands of patients and spend the money to develop this new drug, okay? We did the evaluation already. Let's think about what's special about R&D in terms of financing, right? So the first thing to notice is that R&D is a case where you have staged investment. What do we mean by that? What we mean is that R&D is going to have at least two, in our example, you have two investments. There is the initial investment of 30 million, which is not the big ticket, and then there is the future investment of 1 billion if the R&D turns out to be successful, right? That's what we mean by stage. There are investment in different stages. The other issue is that for R&D, cash flows are going to happen way into the future, right? The company investing in R&D now really hasn't generated any cash flows. The cash flows are only going to be generated if the drug is successful after you have spent the big ticket money, and maybe even a few years into the process, okay? So the third issue that I think we need to talk about is that R&D investments are going to be very intangible. It's essentially research, right? So a bank, for example, may not place a large collateral value on the research that you're doing, right? There are no physical assets that you're creating or anything. So you have low intangible value, little collateral, cash flows come way into the future, and you have this staged investment. So let's think about the following question. What's going to happen, okay, if you go to a bank and ask for a bank loan to fund your R&D program? Most likely what will happen is the bank is going to say, no, I'm sorry. To fund your project, we need collateral. That's what we learned. Banks work with collateral, right? So they're going to say that, you don't have collateral, you don't have profits, you can't issue bank debt, right? Company may try to go to the bond market, but really what happens in the real world is that these R&D intensive firms are not going to have a lot of debt capacity. They are typically going to have low leverage. R&D investments in practice are financed mostly with equity, right? And as we learned, the equity tends to come first from internal sources, so from retained profits, and then if the internal profits are not enough, then the R&D investments can be financed with external equity issuance. As we learned in this course, companies tend to avoid issuing external equity because of the negative stock price reaction, right? So in terms of the trade-off model, right, you have this situation in which cash flows happen way into the future, right? So one consequence of this is that the tax benefit of that is fairly small. Think about it. To be able to enjoy a tax benefit of that, your company has to be profitable, right? If you're just spending money, you're not profitable, project is not going to generate a lot of tax benefits of that, right? In addition, financial distress is very costly for R&D intensive firms because their value lies way into the future. So if you go bankrupt before the drug is developed, then you just wasted money, right? So that's one way to think about it. Going back to our picture that we've been using since module 1, right? The median firm in US has a leverage ratio of 30%, but an R&D intensive firm will definitely not be like a medium firm, okay? It will be way to the left, right? And probably have a very low optimal leverage ratio, so this curve looks almost like downward sloping, okay? The more leverage you have, the lower is your value going to be, right? Let's look at some evidence from the field. Actually, instead of looking at a research paper, what I did is I pulled out a couple examples from Capital IQ, right? So this is actually a very cool picture. It's one of the first laboratories that Eli Lilly had. That's one of the big pharma companies now, right? And then on the left, what you have is the recent financial data for Eli Lilly. You have revenues, right? And notice, for companies like that, they're typically going to be spending a lot of money in R&D, right? So you have COGS, SG&A, and R&D there, and you can notice that those three items are about the same. So the cost of goods sold for Eli Lilly is of the same magnitude as the amount of money they spend on R&D, right? On the bottom, you have their market capitalization, which is about $70 billion, and the amount of debt and cash that they have. So you see that Eli Lilly has only $9.3 billion in debt, which is fairly small for a company of that size. If you think that's a unique example, the answer is no, because look at Merck. Merck is another big pharma company, right? Again, spending a significant amount in R&D, perhaps a little bit less than Eli Lilly on a percentage basis, right? Your R&D is $6 billion, which is about 50% of your COGS, looking at that data. Again, similarly to Eli Lilly, though, Merck has fairly low debt compared to the amount of equity, right? They have $167 billion in market capitalization and only $25 billion in debt. So here's the summary, right? R&D over revenues are fairly high for both of these companies. Both of them have a fairly high leverage ratio. So Eli Lilly has 12% leverage ratio, Merck has a 13% leverage ratio. So they're definitely to the left of the average of the median US company. And these are big, right? These are like fairly big and profitable companies, right? So the most likely explanation for why they have low leverage is because they have all these intangible assets, that they have all these R&D investments to make. Let's talk about now the staged investment characteristic of R&D. As we discussed already, when developing a drug, the big ticket, the large investment will likely lie in the future. You're making the R&D investment today, that's going to be relatively small, the amount compared to the amount of money you need to invest later on if your research turns out to be successful. Right? So how is the drug company going to finance the big ticket investment? Here there may be a trade-off, right? On one hand, the cash flows are near, right? The drug is successful, now you're closer to the point at which you might generate cash flow, so maybe you're even going to be able to raise bank debt, right? But here's a question. Should the drug company wait, right? Should you wait until the future to raise the financing? Right? So just say, okay, we don't need that much money now. We're just spending 30 million. The 1 billion, we may need that or not. So let's wait until the drug is successful. Then we're going to go to the bank and try to raise the money. The problem is that that strategy is going to create risks for the R&D intensive company. And the specific risk is that when the time comes to make the big ticket investment, the financing may become tighter. For example, your research may turn out to be successful in the middle of a financial crisis. If you think about it, the research may have nothing to do with what's happening in the outside world, right? You're inside the lab, developing drugs, testing people. You have a great idea, the drug is successful, you have to spend money. Guess what? Banks are not lending you money because the government told them they can spend money, okay? Or you can have a company-specific funding crisis. Let me give you an example. It's a very cool case study from the data. It looks at Intel, actually. In the early 1980s, Intel's research produced this very innovative chip that was probably going to become, as it in fact became, a key new technology for computer companies. Okay, and Intel, what they had to do, they were in the research stage. The research was successful. What they had to do to build this chip, which is a complex machine, right? They had to build new manufacturing plants. At that point, of course, Intel had some business already. Its main business was what was called the DRAM memory chip. And what was happening in the market at that point is that the market for the DRAM memory chip was decreasing because the competition from Japanese manufacturers was getting higher and higher. So Japanese companies were copying the DRAM chip. That was decreasing profitability for Intel. At the same time, they had to spend money to build this new manufacturing plant. So what happened is that Intel's cash position decreased, its debt went up. So in the end, Intel was unable to make the required capital expenditures without being rescued, and it was in fact rescued by IBM. IBM was kind of a business partner, and what they did is they had to inject equity, right? Remember, high-tech companies like Intel have very little debt capacity, and they were in a tight cash position. They might have tried to raise a bank loan. The bank said no. What happened is that IBM had to step in and inject some equity. They actually bought 12% of the company in order to salvage the new chip. At that point, Intel wasn't as large as it is now. That 12% investment was just $250 million. Okay? And of course, we know that when companies issue equity, they have to give up value, right? So what happened in that case is that IBM injected equity, but they got a pretty good price for it. And here is the key question. That's a great example. What do we learn? Could Intel have avoided this funding crisis? And the answer is yes, right? If Intel had been able to raise financing ahead of time, there was a time when DRAM chips were very profitable. Maybe at that point they had collateral. They could have gone to a bank, right, and raised financing ahead of time, before the funding crisis arises. The problem is that the DRAM crisis coincided with the need to invest in the new chip, in the new technology. So if you think about it, this is a risk management problem. That's really cool because we're going to go back to risk management ideas we talked about in Module 3. How can an R&D intensive firm mitigate the risk that the funding crisis is going to coincide with the need to invest in a new technology, right? That's the question. As we discussed in Module 3, companies have several options to manage risk, right? Futures and forwards, supply contracts, operational hedging, liquidity. Let's think about these options in the context of R&D. First of all, is there a futures contract that Intel can buy to hedge cash flow risk? And the answer is obviously no, right? That's not the kind of risk that can be traded in financial markets. So if you go to Chicago or London, you're not going to find any derivative that is going to allow Intel to hedge its cash flow risk to a large magnitude. So hedging with derivatives doesn't work. Supply contracts, not going to help either. The main role of supply contracts is to deal with input price risk. That's not the case here. Maybe operational hedging may help, right? One thing that R&D and high-tech companies do is invest in different projects at the same time. So maybe one of them needs investment, the others don't. Some projects may be generating profits and all that. But here's an option that remains, and it is what R&D companies actually do in practice to manage risk, which is cash, holding cash, right? So there is this old saying that cash is king. When we think about R&D investments, R&D financial management, that really is the case. The empirical evidence in finance has a lot of evidence that suggests that R&D intensity is a key determinant of the amount of cash that companies hold. In fact, one of the reasons why U.S. companies hold more cash than foreign companies is because R&D investments are more important in the U.S. The U.S. is a very high-tech, innovative economy, and that's part of the reason why U.S. firms hold more cash. There is evidence showing that. Right? The idea is that R&D intensive firms mitigate the funding risks by having a significant amount of cash in the balance sheet. So in the case of Intel, right, if they had raised debt before the crisis and held more cash in the balance sheet, they would have been able to finance their new plants without having to issue equity. Here's the data. Rather than giving you data from a research paper, again, I'm going to show you an example. If you look at the balance sheet for Intel, you'll see that they have a significant amount of cash in short-term investments. For the last 4 years, they were in all years they were about 10% of assets, right? It's more like 20% of book assets. So they hold between $15 and $25 billion in cash and short-term investments. And as we saw already, Intel is a very R&D intensive company. You can see the R&D investments on top. They are still making a lot of research, right? So how much cash should the company hold? Unfortunately, that's one of those questions that we don't have a great answer for. We don't have really good guidance from the literature on what is the exact amount of cash that an R&D intensive company should hold. The data shows, though, that such companies tend to hold more than 10% of their book assets in cash. So 10% is probably a good number to start with. And there are a couple more issues that we can discuss here about how an R&D intensive firm should really manage its cash position. Here's the first question. So suppose we have an R&D intensive company that is going to increase cash by issuing debt. Okay? One way to increase cash is by holding profits, of course, but maybe the company can't do that. You don't have enough profits, so you're going to have to issue debt. The two options is to raise 1-year debt at 3% or to raise 10-year debt at 6%. So short-term debt is cheaper, right? But the long-term debt matures in 10 years. Which maturity should the R&D intensive company hold if the goal of that is to increase your cash balance? The answer is that, in this case, debt maturity is the key consideration, right? If the company is issuing debt to raise cash, the debt must be long-term. Think about it. If you issue short-term debt, you have to repay in a year. You get cash today, the cash is gone a year from now. It's kind of a silly, not to use a worse word, it's a silly financial management strategy, right? It's cheaper, yeah, but as we learned in Module 1, the low cost of short-term debt can in fact be an illusion, right? Short-term debt will always be cheaper than long-term debt, even if you look at the US government. That's the case. It doesn't mean that the US government should be issuing only short-term debt, right? Second question, how should the R&D intensive company invest cash? So suppose you raise it $500 million in cash, and the goal of this money is to manage your R&D risk. What should you do? The answer is that this cash cannot be invested in securities that are going to decline in value when you need the cash, right? For example, you should never invest cash in the equity of related technology companies. Maybe that will have a very high expected return. These are high beta companies, right? If they do well, the cash is going to increase a lot. But the problem is that if there is a crisis in the technology industry, right, that affects everybody, your profits are going to be low, and the return on this cash is going to be low as well, so the hedging role of cash goes away. If you look at the data, companies, in fact, tend to hold cash in securities that are fairly safe, such as U.S. Treasuries and bank deposits. So the managing of cash does take this risk management aspect into account. I want to talk a little bit about the non-incorporated interview that you're going to watch. Non-incorporated is a small business, of course. It is, though, much more financially sophisticated than Analog Outfitters, which is the first interview that we had in the course, that I hope you watch it as well. So what you'll see in this video is that many of the ideas that we discussed in this course and also in Corporate Finance 1 are going to appear in the words of Parm, who is the owner of Non-Incorporated, the person we interviewed. Okay, but Parm, of course, is going to bring the invaluable perspective of a real-world business person who is going to give his perspective on these issues and the perspective of a small business, right? Which is, as I said before, it's very different from some of the examples for large companies that we used in the course. As you watch through this video, I want you to think about a few issues that are to me, they are the most important ones. Of course, the whole video is great, but these are the specific issues I wanted to think about. In terms of the acquisition strategy, right? So think about the following. Why is non-incorporated a bit like a private equity company? There's actually some similarities between what Parm does and what a private equity company do. Second, why did Nona change its acquisition strategy as the business developed? This is something Parm talks about in the video, right? So why has the acquisition strategy changed? Can you think of reasons why? In terms of financing, one thing that Parm talks about is that they use long-term leases to finance acquisitions, and I want to make sure you understand that. In addition, I asked him about bank financing, right? So what does he do when he has to raise money from a bank? And he gave very interesting answer. I want you to watch it and think about it. And there is very interesting point where he talks about this financing strategy of giving equity in the building to the seller. And as I think I mentioned this in the video, this is actually similar to stock financing in large mergers. It's a very similar idea, and I want you to really understand that. Okay? Think about it, make sure you understand this. It's a very interesting idea. Finally, Parm talks about what conditions does he think are feasible or situations in which non-incorporated would consider bringing in new equity capital to finance investments, right? That's something we talked about in the course, debt versus equity, when would you issue equity? Parm talks about that. Finally, risk management, right? He talks about the risk, the nature of the interest rate risk that his real estate business faces, right? So I wanted to think about, what is the nature of this risk? That's a very interesting argument, I think, and what can the company do to mitigate this risk? He also talks about payout, right? So I asked him about payout. So what are the key considerations that he sees when he determines payout policy for the non-incorporated? And he has an answer that I think really goes back to what we discussed in the course. And also he talks about which strategies does his company use to minimize tax bills. Okay? So there are some interesting ideas there that I want you to think about as well. And what you can do is maybe discuss these ideas in the discussion board, add some thoughts, and I think that would be interesting. I'm sure Parm would appreciate it as well, to see some discussion generated by our interview, which I really thought was great. Hi Parm, how are you?
Good, how are you? Nice to be with you.
Thanks for talking to us. Can you start by telling us a little bit about your business, what lines of business you have, a little bit of history maybe?
Sure. Really, it's two businesses. One is I own a chain of tire and auto stores in Illinois and Iowa. There's 4 different brands. CarX, you may have heard of. There's another brand called Fast Tire. There's a Davis Tire. There's a Schutz Tire. And these are just independent stores that I've bought and accumulated over the years. And my other core business is real estate. And basically I own, roughly 100,000 square foot of retail space, and really just in central Illinois and a little bit in Chicago. But for the most part, it's a commercial real estate business and then a retail business of tire and auto repair.
So why did you think it was a good idea to put these two businesses together?
Well, they kind of went together a little bit. So really the operating business, which is, selling tires and selling repairs, sort of produced the operating cash flow over the years. Not at first, obviously. I used to lose a lot of money, but eventually it produced a little bit of cash. And ultimately, one of the ways that I instantly got into real estate was I owned some of the stores. So I would have a retail store that's selling tire and autos, and that's really the main source of the income. And the other way to generate long-term assets, really these days, is real estate. And so the stores were paying rent anyway, so might as well been rent to myself. So it started with one store I had, and I would buy the store, and then that was my first real estate business, was getting rent and the income stream from rent. And then over time it'd be a couple stores, and eventually I would own most of my stores. And then the natural sort of progression was to own shopping centers, where now in one space there might be 3 tenants or 4 tenants, and generating and building long-term assets through real estate.
Very interesting.
So they went together perfectly.
And what have been some of the major investments that your company has done in the last few years?
Well, the last few years, really the major investments are on the retail side, which is Nona Inc., is acquiring stores. Yeah. And some of them aren't major from a dollar standpoint because once we got to a certain place from a balance sheet standpoint and from generating cash flow, we really started focusing on buying operations that were struggling, because there was no value in buying something that was really successful and already and charging a premium for it. When I was building the business and I was small, I would buy opportunity. I would buy stores that were really already successful. Yeah. I would pay a premium for it, but I had to do that to be able to build on. Over time, we learned how to manage those and were able to take more risk and say, you know what, once a year or twice, a couple times a year, we can acquire an operation or store and it not be that successful and it not immediately add value to the balance sheet. So we would take a risk ultimately, but we would buy them for nothing. So they were not real dollar value investments, but they were structurally good investments because it took away resources and from our personal resources, from the people operating the businesses that we had to put in and try to manage stores that are not doing well, because we had to basically take struggling stores and try to get them, to a certain place where they can cash flow. So that's really been the predominant investments that we've made on that side. On the real estate side, I buy commercial real estate as much as I can when the deal is right in the shopping center. So recently we have bought a shopping center in Bloomington. It was like a $6 million shopping center, but that's probably been our biggest one in the last year and a half. Yeah.
When you buy a new store, how do you know that you can improve the operation? So, the store could be struggling because it's in a bad location, for example, or it could be struggling because it has bad management. How do you figure out, how do you separate one from the other?
Well, you nailed it. I mean, basically, those are really the two biggest things that I look at. Yeah. So the first and foremost is I just walk into a store, or me and a couple guys, we walk into a store and we just observe. And doing it long enough, I can probably tell in about 15 minutes that it's a poorly run store. So right then, at least that at least gets me to where I'm going to take a look at it and then dive deeper. Okay, if I walk in and I just see, wow, this is a really good manager, they have a couple of nice technicians, they look like their processes are well thought out, and it's struggling, then you go to that next step, and it's like, well, what's going on in this town? Maybe it's the location, maybe it's it's just a function of the competition that happens to be around it and the density of the competition around it. So that would be the next layer that I would look at. But really the first and foremost to me is management, because we believe that management can bail you out of even a bad location. Yeah. You can have a bad location, you can even have maybe a struggling economy, and you can even have a struggling town within that, economy within a certain town. But if they're really poorly managed and there's somewhat of a demand for it, then it's fixable, because you really just got to check those boxes off of what constitutes a good process and what good managers.
I see. Yeah, that's interesting. What about the real estate side? How do you locate a good investment?
That one is an evolution. So when you are starting out, you don't have a choice. You buy C property. Yeah. If I were to grade properties, A being the really good pieces of property, B, C down the right? Well, when you're starting out, you're not going to get an opportunity to buy an A's and B. Couple of reasons. One, you don't have the money for it. Okay, you haven't built up enough cash to be able to go to the bank and borrow enough money to overpay, basically. The other one is you don't get access. If you're small and you're just starting out in commercial real estate, you don't hear about the A and B deals. You only get the C deals. Then as you start having a little more and the realtors and the people in the town, and they know that, hey, you're a buyer and you can maybe go and be able to buy and have a $6 million deal or a $10 million deal, then all of a sudden those things open up. Once you get to that point, really it's an evolution of where you are in time. If you're in your entrepreneurial stage where you're building and trying to acquire and build, well, then you tend to buy things differently than you were if you're, like, for example, my stage right now, I prefer to overpay. But have properties that are A+. So I don't get an upside. But what I really do have is guaranteed strong rents. So for example, I have tenants like Starbucks, AT&T, all the big national triple rated tenants, right? But when you're really trying to build, you want to buy the B properties because they have the most upside. Because someone that's selling it isn't charging a premium. So I think depending on where you're at in your evolution of your business career or where you're at as the evolution of the company, if it's the company's trying to grow, you're going to be buying differently. If the company is in a mature stage and really wants to not disable or change that balance sheet and really keep having a strong balance sheet, they'll tend to take less risk. At least I do, take less risk, pay a little bit more, but guaranteed, much more guaranteed streams of cash flow. Does that make sense?
Yeah, no, it makes total sense. You talked a bit about financing, which is very interesting to me. When you buy a new business, let's say a store, let's talk first about a new car shop, then we'll talk about real estate. But when you buy a new car shop, how do you finance that investment? I mean, is it a big investment up front?
No,
or not to begin with?
It can be. Right? Depends. I've had 5 years ago I bought a store that was $750,000. 6 months ago, I bought a store that was zero.
You spent no money.
Spent no money. Basically, what I did on that one is I took over the lease. The company or the business was struggling enough, and they were in a long-term lease with the landlord. They needed to get out. They just needed to get out on lease. So basically, we'd go in there and maybe make an asset purchase, maybe spend $25,000 on their equipment, and really ultimately what I'm buying is I'm taking over their liability of this lease that they've signed. So the mixture for me has been all over the place. So it's been very traditional financing. Go to a bank, and to make it simple, it's a $100,000 investment. You put $20,000 down, no differently than a house. You borrow $80,000, amortize it over 5 years typically for the business.
Will banks happily lend you money to buy a new shop?
It depends when you're
kind of a risky.
It depends where you're at. Again, so when I first started out, the banks would not loan me that type of money. So what I did was, let's say Heitor was selling me the business. I would go to him and you say, I want $100,000 for it. I said, well, I'll give you your full asking price, okay? But I'm going to only give you $70,000 in cash. So now what I'm borrowing from the bank is 80% of $70,000, $56,000 if my math is correct, right? So now the bank is willing to loan $56,000 on $100,000 because that's technically 44% equity, right? So, but then I make the owner carry that $30,000. The bank doesn't count what the owner carries as debt. The bank treats it because they're second in line. The bank doesn't care, right? So as far as the bank is concerned, they're only loaning you $56,000 on a $100,000 transaction. They feel pretty safe about that. So in many instances, I worked with the buyer or the seller and said, if you really want to sell it at your full asking price, instead of me negotiating and going back and forth, I'll give you the full asking price, but in return, you're going to carry a portion of that. And by carrying, that means over the next 3 years, let's say it was $30,000, I'm gonna give you $10,000 a year for the next 3 years, no interest, okay? That helps me finance from the bank's perspective early on, and it gets the deal done for the seller. Now they have risk because they don't know me, so they might potentially lose $30,000, but at least they're gonna get 70.
So it's fair to say that there is a little bit of risk sharing, right, between you and the seller in that sense.
And it always depends on where that seller is in from a necessity standpoint, or where they're at from the. If they're selling a prime piece of asset, whether it's a business or real estate, they're in a position that says, I will never take that. If you are buying from somebody that is struggling a little bit or really wants to get out, some people want to get out because they're old and they're just ready to retire. Some people want to get out for various different reasons. It's not always because they're struggling. You just never know. But I always, every single deal I've done, I make the seller at some level take on some of the risk.
It's very interesting because when public companies merge, the way that they do this is by using equity. So the target firm will keep some equity in the merged firm. Right, so you're kind of doing that, even though you can't do the equity. So it's very interesting.
That's right.
You know, I didn't know that.
And the banks love it.
That I'm learning
and the
now.
banks love it. And the banks love it. So when you go to the bank and say it's a $100,000 transaction, but I only need to borrow $56,000, to them it looks like you are in a very great cash equity position. Because they don't treat that money that they're giving you as they treat it as equity.
And what kind of collateral does the bank look for? If it's, of course, if it's real estate, right? They have
the real estate.
But what if it's a store?
The store is inventory, the lifts, the hard assets. But really, all they have is inventory and lifts, and those depreciate. Well, inventory really doesn't, but the equipment depreciates at an incredibly fast rate.
Yeah.
So as far as banks are really concerned, your real collateral is the person that they're borrowing from for the most part. They will, and at the end of the day, they as you move on through your evolution of where you're at from a balance sheet standpoint, then they don't even ask. They don't ask now. But early on, they want to tie it. Like I know people that have tied it to their house. They're going to go buy it. Yeah, so they're buying their first store, for example, or they're buying a Subway or a Jimmy John's or whatever, and they're going to borrow $150,000. It's tied to their home, and eventually they let those things go as you prove to yourself. And it's no different. Banks, you establish a relationship. No different whether it's IBM borrowing from banks or whether it's a little guy who owns Jimmy John's or me or something like that. You develop a relationship with that bank, and they get to know what you do and how you do it and why you do it. And sometimes you struggle, but they're with you the whole way. But if you really can be transparent with them, eventually it doesn't just become a collateral thing.
And do you have a relationship with a specific bank, or do you shop around? How do you handle the banking relationship?
I don't shop around. I have been with the same couple of bankers almost my entire, what I would call almost my entire meaningful business. Early on, it was whoever, but last 15 years, it's been the same, and usually the same person. That person's moved on to different banks, but I followed that person to the different banks.
I see. So when you get a loan these days, they don't even ask for collateral, like inventory. It will be just a loan, and it's your promise to pay.
No, typically now it might go like this. Hey, I'm going to acquire a couple stores in Iowa. It's one of problem stores. I need $150,000, and they just give it to you. It's not even directly tied to a store. It's just tied to Nona Inc. and our operation.
Very interesting. Yeah. In terms of financing, again, have you ever considered raising money from other investors? Raising equity from other investors or not?
I have on real estate.
On real estate.
I have on real estate, but that comes at a cost as well, right?
Yeah.
So the only time I think the only time that so far that it's made sense to me is if I wanted to acquire a bigger piece of a strip mall, maybe a $10 million strip mall, where I need a couple $1 million in cash, okay? I can get financed 80% almost on anything, even if it's a $20 million deal. I'm pretty sure I can get the financing for it. But they're still gonna want you to have 20-25% cash, right?
Yes.
So if I get it from somebody else and raise it privately, I still gotta pay them. And what's happened with the interest rates as low as they've been, there's really never been a need for that, right? There's no reason to have a private investor give you money and then they're going to want 6% or 7% when banks are loaning. Now, the only time you really need to do that is if you just don't have the cash, but you believe that you're buying, that you want to buy this property. But it won't make sense unless it's an appreciating value. Yeah. For example, the shopping center that I was just telling you that I bought in Bloomington, I bought it at the highest price you can buy. I overpaid. Okay, I overpaid. There's no upside. Yeah. So if I bring in private investors on that, there's really no upside for them on something like that. So if it's one where there's upside, it makes a lot of sense.
But you can share the rental income with them, right? They would be giving equity.
They would be able, And really, real estate is all about all about paying down debt.
Yes.
It's the principal payment. So every single month, even if your loan payment to the bank is $30,000 a month, but 21,000 of it goes towards principal. In my mind, I made $21,000. In the mind of any investors, they made $21,000 because at some point it's just deferred, right? Yeah. So at the end of the year, it's $240,000 in equity. Okay, and later on, if you talk about how owners get money out by refinance, well, that money is there because it's actual equity. You just didn't get it today. You just didn't get it up front.
Yeah. No, very interesting. Let's talk a little bit about risk. What are the major risks that you see in the near future for your business, and what are you doing to try to mitigate those risks?
Well, the auto side is probably actually both sides. Real estate, they both have risk. The auto side risk is not as clear, so there's some guesses. Technology. Yeah. Technology is probably the biggest risk, right? Electric cars. The way cars are lasting longer. For example, brakes are a big part of our business, and now you have regenerative brakes where they don't wear down as much. But I have to remind myself, 25 years ago when I started this, we only did, mufflers and brakes. And we thought, oh my God, what happens if they start having ABS, which is analog brake systems, and they have And we've sort of, you know, they don't happen really fast, so we've just kind of evolved through them and figured it out as time went on. So, but technology is always a risk. Technology is always a risk. But outside of that, it's people. We happen to be in a business that cannot be automated. So if I don't have a guy that can fix the car physically with his hands and mind diagnosing it, it's not going to work in the automotive business, right? Yes. There's no way to automate. And if people aren't going into that industry, which they're not, there's not a big pool of technicians, and there's a shrinking pool of qualified people that are even entering this business. Then now all of us are competing for a very, very small pool, and that is a serious risk and something to really think about. On the real estate side, it's always interest rates. Yeah. Always interest rates to me first, but even interest rates depend on when you buy in that cycle, you'll be okay. But and the other part is frankly the economy. If it's not growing, and retail is not thriving, then as you notice in Champaign over the last 7-8 years, you've seen a cycle of a bunch of buildings for lease signs, and then they'll go through a period where those are leased, and then they'll come back again, you know. And so that's really predicated on what type of economy we have. So that's always the risk is just oversupply, oversupply on the real estate side, and then ultimately it's very hard to manage interest rate risk because. So right, he has a higher cost of capital.
Even if the interest rate on your loan is fixed,
it doesn't matter.
You still face the interest rate
because
risk.
The buyer that's eventually going to sell to now has to spend more to finance that project. So you just lowered the price of your asset.
Yes, that's a good point. So do you feel like these risks are pretty much outside of your control then?
My only thing is that it's going to apply to everybody. That's really the best way to think about it. It's the way I think about it, is that it's going to apply to everybody, and as long as you're cognizant of it, like I learned in one of the phrases I learned in MBA school was scanning your environment, you know. And as long as you are scanning your environment and really paying attention to the subtle changes that are happening and adapting to them, you should have a competitive advantage, at least to be able to stay in it.
You talked a little bit about paying cash to owners, right? So how do you pay dividends to the owners of the equity, for example? I mean, to yourself, and let's say if you have a co-investor in the real estate business, how do you manage this payout decision? What do you do there?
Well, a couple ways. One of them is you have to think about taxes. Taxes are a huge consideration because they change everything. They really change the equation from a tax standpoint. So whether something is ordinary income or something falls into when you sell a property and it becomes capital gains, and so all these things go into the pot, right? But one of the ways, so in my business, I have two businesses. The operating business, I don't have much choice. You know, it's an operating business, so we're an S1 company. So whatever money you make, it just flows down to your personal income. Now, what I can do is, because I own some of the buildings that the operating business is renting from, I could make those rents be higher. For example, I could make those rents higher and take more of your money through real estate. Real estate, you depreciate. You have depreciation in real estate. So it's not a cash event, right? So it might show on paper that you made $50,000 on this real estate a year, but really you might have made $85,000 in actual cash because you have depreciation in real estate. So one way is to shift it. The other way I do it, is, which I just did a year ago, I periodically sell property. Okay, or refinance property. So there's a couple of ways you can do that. One is, you were almost telling the example of you built $250,000 of equity this year. Then at the end of the year, you can do this every year if you want. The bank, as long as the bank is holding, you know, the loan to value of 80%, at the end of the year,
you can get some.
Go and refinance. You pull out the equity, and it's non-taxed.
It's not taxed.
It's not a taxable event. Zero tax, because you refinance. So a lot of people in real estate that love real estate, which is why like people watch, I know, like Donald Trump and stuff, and be like, well, he doesn't pay very much taxes. Well, because he owns a lot of real estate.
That's because of the real estate.
It's not because of him or hiding it. It's just the way the function of real estate. So every single year, I could pay myself zero, okay, and every single year go back and refinance my property, pull out whatever excess equity I've made outside of the loan to value that the bank would like to keep, and that becomes a tax-free event.
And you can even get some profits out of the operating business, right? And so you can put the two businesses together in a way that minimizes taxes as well.
And the other way
is,
the other way to do it is to randomly every once in a while sell certain assets. You pull out that money, and then you put them in a 1031 exchange, which is what I just recently did. So basically, you just take your equity that you made in these other properties, sell it, make a little bit of money, and then put it immediately back into upgraded property, and that becomes a non-tax event. And then you can then go refinance that and then pull it out. And then, you know, so those are really, and then the last part is at some point you have to decide to cash out and just sell. And that's a major taxable event. So you have to really plan for that, and people, I haven't got to that point yet.
Well, thank you. This is all very interesting. Just to finalize, you know, there are business students from all over the world watching this. What kind of advice do you have for people who are starting?
In business?
Yeah, in business.
Well, I mean, I think if there's a couple of ones that I always say to young kids is that this is more of a philosophical thing, that you don't have to love what you do. Everybody wants to say I'm not happy, or I don't love this, right? Well, it's, you know, it's the means to the end, right? Yeah. So along the process of whatever it is that you want, you know, define what you want. Yeah. If it's quality of life, if it's money, if it's whatever, define that, okay? But the steps along the way are not going to, you're not going to be happy the steps along the way. So obviously that's the main thing. And the other part of it is that everybody knows this, is that unless home runs are wonderful, they're wonderful. To be honest, I've never had a home run. I've never had a home run. I've had a lot of singles. I'm not sure I believe that. But pardon? I'm not sure I believe that.
I
really haven't. Okay. I really haven't had a home run. Like, I have friends that have had home runs. Right. And I know, and I can tell you the difference between what home runs are and what home runs are, when something goes from nothing to just explode. Mine has never exploded. It's been sort of a steady process that I started a long time ago. But it started with, you know, you asked about the real estate. It actually started with an apartment that I bought for $63,000. That was the first real estate transaction I made. And that's when I learned, whoa, I can make more rent and things. So I think it's just a matter of defining what you want and having patience, because most of the time you will have to have a methodical patience. And if you get lucky, you have a home run. But most of the time, it's pretty methodical.
Yeah. Thanks a lot for talking to us. This was great.
Enjoyed it.
Yeah, thank you.
Yeah, thanks.
What it did in this module is to apply what we had learned in the past 3 modules to a couple of very practical examples. Right? We talked about the financial management of acquisitions and the financial management of R&D. And in doing that, I think we were able to apply many of the concepts that we learned in this course, like the trade-off theory of capital structure, the choice between bank and bonds, how to set your payout policy, risk management. So I think that was really a cool, you know, at least for me, that was a very cool module. Okay, so here are some of the topics we discussed. We talked about how to differentiate between cash and stock financed M&A deals. We talked about how companies finance M&A deals in the real world using some examples. Right? And we learned how to estimate the impact of an M&A deal on a company's financial statements. So I think you should know more about the accounting of M&A after this module as well. We talked about how companies set their capital structure and payout decisions at the time of an M&A deal, which is one of the biggest investments that companies make. So it's a time when they really have to optimize financial strategy. That is even more true for private equity deals. Right? Private equity deals are very heavy in finance, as we discussed, and they have some specific challenges. For example, private equity funds cannot issue public equity. Right? We talked about how they manage these risks by building leverage buyout models in Excel, and we learned how to use these leverage buyout models to make financial policy decisions using a real-world example of a recent leverage buyout. Then finally, we talked about the financing of R&D investments. Again, R&D investments are important and special. Right? They are special because they are intangible, the cash flow is in the future, they require staged investment, and all of these features mean that R&D is really a risk management project. Okay? The financing of R&D is is an application of the risk management ideas that we discussed in Module 3, and we learned how to develop this risk management framework to help support value creation through R&D investment. Let's talk about the objectives of assignment 2. Just like the previous assignments, there's going to be some open questions that allow you to discuss the ideas of the module in your own words. And there's going to be one problem with data that I want to talk about briefly. It's a case involving a potential takeover target. There has been some rumor in the financial press that Mondelez International might become a target either of a private equity fund or of another company. So what I'm doing in this question is to give you new data to allow you to think about the financing of this deal. Okay, so how would the potential deal for Mondelez likely to be financed? You know, either as a private equity or a strategic acquisition, and I think we can learn a lot about you know, actually what might happen going forward by thinking about the financial aspect of this deal. As before, I'll give you all the data that you need. The data is going to be in raw format, just to allow you to really sort through the data and find the most important data that you need to answer the question. And the goal is, again, to force you to look for the information on your own. The solution is going to be available as always, but please try to do the assignment before you look at my solution. Question 1 asks you to evaluate different motivations for hedging. So the first one is 1A. In this case, it is a valid motivation for hedging, you know, reducing volatility in input prices. In this case, though, because the input does not trade on an exchange like steel, right, the best option will probably be a purchase obligation, as we discussed in Module 3. Right? The purchase obligation is one way you can hedge input price risk even when your input does not trade on a future exchange, essentially by contracting the input price in advance. Question 1B is also contains a valid motivation for hedging. You know, hedging interest rate risk, as we discussed in the module. Is a valid. It's something that companies should worry about, right? Using future, though, is likely to lead to imperfect hedging. Right? You're not going to find the exactly right future, so you're always going to be left with some residual interest rate risk. So a safer option to consider is going to be to issue the debt today and hold cash. Right? So now, as we discussed in the module, you're going to have a trade-off between the costs of issuing debt and holding cash and the benefit of being in a safer financial position. Question 1C, again, describes a valid motivation for hedging. This company in particular is exposed to an appreciation of the Mexican peso, right? Because if the Mexican peso appreciates, then your costs are going to go up relative to dollars and euros, which is where your revenue is. So the key options in this case, right? Since your profits go down, if the Mexican peso goes up, you have to take a position in futures or in another asset that gives you a profit if the Mexican peso appreciates. So what you would do is you'd buy Mexican pesos, or another option, as we discussed in the module, is to hold cash in Mexican pesos, right? Question 1D, though, describes something that is not a valid motivation for hedging. Reducing volatility of earnings should not increase shareholder value. Okay, we went through this in the module, and I hope you remember it when you were reading this statement, that this sounds right, but it's not. Right? Shareholders can do this on their own. It's really not a reason for hedging. Right? Question 1E, again, describes something that is a valid reason for hedging, again, exposure to currency risk. Right? In this case, though, the company is exposed to a depreciation of the pound because your revenues are going to decrease if the pound depreciates. Right? So it's the opposite of the previous question, and of course, you know, the derivatives position is also opposite. So in this case, what you need to do is you need to go short on the pounds. You need to do something in your financial position that gives you a profit if the pound depreciates. So you would sell pound futures, or you would borrow in pounds and hold dollars if you are concerned about using the futures market. Question 1F is, again, not a valid motivation for hedging. It sounds appealing, but it's wrong. Trading profits is not a good motivation for hedging. This is exactly what we think of as speculation. Okay? If you want to speculate, you should not do it with corporate resources. You should move to Wall Street. That's how I like to describe this. The CFO should move to Wall Street. So question 2 is a little bit more elaborate example about currency risk. The situation where a company is making an investment in Brazil, but the investment needs to be approved by the government. So the immediate risk that you face is that you have the exposure to this payment in reais, right? So this is like an exposure that means that what will happen is your payment might increase if the real appreciates in value. As we saw in Module 3, the real can actually change very sharply in a short period of time, so your payment could easily go up 20-30% in a short period of time. Okay, so the options, of course, one option in this case is to hold cash in advance, as I have here, right? You can hold reais in advance, so if the real appreciates, you don't care anymore, or you can try to profit from the appreciation of the real by buying real futures. And here's this is one of the most interesting questions of this assignment, right? So now we are in a situation where the real depreciated, okay? So your futures position didn't make money, and the investment wasn't approved, right? So all you had is the loss on your derivatives position, or your loss on your long position in reais if you're holding reais through another way, right? So the key thing is, I think, that the company did not necessarily make a mistake. We weren't sure if the government were going to approve or not, but think about it. You would have been in a much worse situation if for some reason the company had not been able to make the required investment because it became too expensive, right? If the investment became too expensive for the company because the real appreciated, then you cannot make the investment, maybe because you can't raise financing, right? That would be really costly. You're losing this valuable investment opportunity because of currency risk. On the other hand, now the only thing you lost in the current situation where the government canceled it, the only thing you lost is your trading profit, and that shouldn't be a big deal. The CFO should be able to explain to investors that there was a good reason why the company was hedging the real risk. And now the question is, what happens? Suppose the investment is approved, right? What changes? So now, of course, the exposure changes, right? Now the company is exposed both on the revenue and the cost side because you're producing in Brazil, you're selling in Latin America, including Brazil, but also in other countries, right? So what you need to think about using the framework we developed in Module 3 is, how are the Latin American currencies going to move together? And the key idea here is the idea of natural hedge. So suppose that you're selling in Argentina and producing in Brazil. If the Argentinian peso and the Brazilian real move head to head, then your costs and revenues are going to change together, and maybe you don't have to worry about currency risk, right? So it'd be interesting if you could come up with that on your own. However, it may be the case that these relative movements still matter. Maybe the correlation between the Argentinian peso and the Brazilian real is not that high, so you may still want to hedge against these relative movements. Question 3 is also about the currency risk, thinking about two different companies that are exposed to a similar risk in different ways. So you have a U.S. exporter, right? And the U.S. exports to Switzerland. And the way I frame this question is that the Swiss franc tends to depreciate in good times, and it tends to appreciate in bad times. That's actually true in the data. The Swiss franc is considered to be a safe haven. So Switzerland is a place where everybody tries to put their money when the world becomes when the world goes into a financial crisis. So think about now the U.S. exporter, right? So you are selling in Switzerland. In a boom, the Swiss franc depreciates, so your profits go down, right? Because you're selling in Swiss francs. In a recession, though, right, when the situation is bad, your profits in Switzerland are going to go up. So think about that in terms of beta, right? Higher profits in booms, lower profits in recession. That means the U.S. exporter is going to have a lower beta. Right? I hope you figured that out. And the Swiss exporter, of course, is going to be the opposite. It has to be the opposite. right? So the beta for the Swiss exporter is going to increase because now you have less profits in bad times. So that's exactly when you don't want to have lower profits. Both companies may be still concerned with currency risk. Even the US company may want to eliminate currency risk for reasons that we discussed in class, right? So for example, you might not want the executive compensation to depend on the appreciation of the Swiss franc. But for sure, I think the Swiss exporter would be more concerned because the Swiss exporter is becoming riskier, right? The currency risk is probably going to affect the cost of capital of the Swiss exporter, so you have an additional incentive to hedge currency risk. Again, currency exposure. Question 4 is about a U.S. exporter, right? And in this case, the exporter is because you're selling in Korea, right? You are exposed to a depreciation of the Korean won, right? So in that case, your revenues are going to go down. So the hedging strategy is to, for example, to borrow in Korean won and hold dollars to mitigate currency risk. That's what you would do if you use liquidity. You could try to find futures as well, but the question tells you to discuss what is the liquidity strategy. I did this in purpose because if you're thinking only about futures, it's important to consider that you can always try to replicate a future strategy by using a foreign debt and cash. So now question 5 is going to think about different types of acquisitions and how they're likely to be financed. That's the topic we talked about in Module 4. So in Part A, we have a situation where we have a highly levered acquired and a large target, right? And this, of course, is going to make it difficult to finance the acquisition with additional debt, right? So if you're already highly levered, your debt capacity is lower. So what the acquirer is going to do in this case is probably to issue equity and try to pay with stock instead of issuing with debt, financing it with debt. Question 5b is interesting because it talks about a situation where the target is less optimistic about the deal, right? So think about what this means in the framework we developed in Module 4. If the target has stock in the merged company, then the target is not going to place a very high value in that because you really don't believe in this deal, so you think that the bad outcome is more likely than the good outcome. So what this means is the acquirer is probably going to have to pay to give the target more equity to compensate for this pessimism, right? It might be better for the acquirer to just pay cash in this case. If the acquirer can pay cash, you can eliminate this disagreement by saying, take the cash then. I know you don't believe in the deal. Take the cash, go home, let me run the company. Question 5c is about a large acquirer and a small target. We actually discussed this directly in the lecture, right? In this case, leverage is not an issue. The tax bill for the acquirer is smaller. It's relevant for the target, but for the acquirer, it's going to be a small amount, so you can easily pay a higher premium. And what that means is the acquirer is more likely to pay cash, which is actually what we see in the data. Small acquisitions are by and large financed with cash, and equity financing is much more used in large acquisitions. Question 6 talks about how a manager can keep a private equity firm away. Right? So this is a situation, where the company is a good candidate for an LBO. You have stable cash flow profits, you have low debt, moderate growth prospects, so maybe your stock price is not too high, right? So that's a very good candidate for a leverage buyout deal. So what can the target management do? Of course, you could try to restructure the business and increase the value of the business and make it harder for the private equity fund to pay a premium. You can always try to do that. Might be hard though. An easier thing to do may be to increase leverage, right? This business seems to be under-levered, right? And as we discussed it in Module 4, the fact that LBO targets are under-levered helps the private equity fund conduct this deal, right? The deal might create value for shareholders in the end, but maybe the management wants to fend off the private equity fund for other reasons, like to protect employees, for example. In that case, it may actually be optimal to increase your leverage ratio and have a more efficient financial structure. Question 7 is going to get into the data again, right? So we have this Mondelez case, which is actually a current case. Maybe by the time you see this video, Mondelez will already have been acquired by someone. Mondelez is a large food company. It has a market cap of $63 billion and net debt that is about $15 billion, okay? So as we discussed in the course, standard takeover premium can be up to 30%. So that would mean, if we use 30%, it would mean that the acquirer would have to pay $82 billion. In addition to that, you have to assume the debt, right? We discussed this notion in Module 4. You have to carry the debt, right? So that you're really looking at a $100 billion deal here. Current leverage is 20%. The current credit rating is BBB, right? So, if you're wondering, that's how I computed it, $15 billion of that, right? Credit rating is BBB. And so there is a little bit of space for an additional debt issuance, right? So if we assume that Mondelez is similar to a median company, you may be able to increase leverage a bit, but not much, right? In a deal like that, the bulk of the financings probably have to come from equity. Okay, so that would be the answer, that you're probably not going to have a lot of debt capacity in this deal, right? So let's think about the two possibilities, right? How would a private equity deal look like? It's really hard to imagine that a private equity fund would be able to invest more than, let's say, $20 billion. The Heinz Kraft deal was one of the largest ones, where the Berkshire Hathaway and 3G Capital injected $17 billion of cash on the deal, as we discussed it in Module 4. So even if you put $20 billion, that would still require you to issue $62 billion in new debt. Maybe that's feasible, right? But what would happen to leverage? Asset value should increase, right? So leverage, of course, total debt is going to go up to $77 billion. Let's say that your asset value increases because of the premium of 30%, right? As we did in the examples in class, your equity value is probably also going to go up, right? So incorporating the increase in premium here, you would still see that the leverage is actually getting close to 100%, right? It really wouldn't work. Okay, this leverage is too high. The credit rating of Mondelez would really tank. That would become a company that is really close to financial distress, and I doubt that the private equity fund would be able to finance this deal. So the standard private equity doesn't seem feasible. It's going to be important in this deal to use some equity, right? So for example, Heinz Kraft is partially owned by private equity, but it can also use stock because it already owns Heinz Kraft, so it can actually issue equity in Heinz Kraft to help pay for Mondelez, so maybe they can bring all the companies together. Let's see if that happens going forward. There are, of course, some concerns about regulation and whatnot, but there is, like I said, some rumor that a deal like that might go on. What we just learned is that it's probably going to be Heinz Kraft. It's less likely to be a private equity firm. In this course, we learned a lot about how companies make financial management decisions. What I want to do in this summary is to point out some of the key concepts that I would like you to remember as you leave this course and go on to your future career, to your future endeavors. The first one is that there are many mistakes, there are many shallow arguments that might affect how you think about payout and financial decisions, and I don't want you to get fooled by them. For example, we talked about the fact that dilution is an illusion. There is no such thing as dilution. Changing the number of shares outstanding per se has absolutely no effect on stock prices. This is a bogus argument that is very common in practice, and I think after taking this course, you'll be able to understand why dilution is an illusion and why the number of shares outstanding is irrelevant. The other issue we talked about here in the middle is that debt does not mechanically reduce the cost of capital. That was the logic behind the Modigliani and Miller theorem that we covered in Module 1 that has this very practical application, right? Which is that it shows us that there is no such thing as cheap debt. The fact that debt is cheaper than equity doesn't mean that a company should issue debt. Okay, so that again is a very important concept that I would like you to remember as you go forward. We also talked about the trade-off model of capital structure, which we summarize it in this picture, right? Essentially, there is an optimal leverage ratio. There is a point, a leverage ratio at which a real-world company is going to maximize its value. For a median US firm, as we learned, that leverage ratio is 30%. A median US firm gains 5% in value by moving from 0 leverage to a 30% leverage ratio. That's based on the most current research, as we discussed in Module 1. And in the other modules, especially Module 4, we talked about how we can use the trade-off model of capital structure to make financial decisions in the real world. We used this model to talk about the financial management of M&A and the financial management of R&D. So if you want to see how we apply the trade-off model in the real world, go back to Module 4. As I pointed out in the introduction, this course allowed me to bring a lot of evidence from recent research, including mine. So that made me happy, and it would make any researcher happy to be able to talk about research on an MBA course. That's the ideal interaction between teaching and research. Some of the key points we learned from research is, for example, that debt financing is the most important source of marginal funds for most companies. So companies are usually reluctant to issue equity unless it's a special event like mergers and acquisitions. Partly, that happens because stock prices tend to decrease if firms issue equity or cut dividends, and they tend to increase when firms repurchase equity. So that's, again, is a key factor about corporate finance that we discussed in this course. We talked about why this happens, so you can go back to Modules 1 and Module 2 if you need a refresher on this. So I really want you to remember this fact. The third fact that we talked about, and we actually used that a lot when we're thinking about optimal financial management of R&D and especially M&A decisions, is that credit ratings matter. When you make capital structure decisions in the real world, it's not sufficient to just use the trade-off model. We also have to incorporate the fact that companies target credit ratings. Credit ratings affect companies' access to capital, so a credit rating downgrade is a very important consideration when you're thinking about the optimal financial management of an M&A transaction, for example. I think that really came through in the course. Another point that I think we learned in this course that I use it in practice in our cases is that there is a fundamental trade-off between bank and bond financing. Bank debt is one way that companies can reduce interest expenses at the cost of giving additional control to the bank. So it's a trade-off between interest payments and control. That control comes in the form of covenants and collateral. Those are the two most important mechanisms, right? And that was a key insight between the financial management of M&A decisions. For example, we talked about the fact that private equity funds use bank debt as a way to relax financial constraints to allow them to raise more debt to finance leverage buyouts. So that's a very important concept to take to real-world data as well. We talked about the payout trade-off, and I want you to remember the key idea is that paying out cash on one hand can help companies control overspending and signal good prospects, right? But on the other hand, payout is going to compete with other uses of cash, such as debt payment, right? You know, interest payments and principal payments, debt repayments in general. Because of this, we talked about when we did the M&A cases, right? One issue that came out is that M&A investments in some cases may require reductions in payout. That's especially true for leverage buyouts, but it also happens for strategic deals. So you can go back to those cases and revisit that discussion, but this really is the fundamental payout trade-off that drives payout decisions in the real world. In Module 3, we talked about risk management, and the key idea really is that hedging there are good and bad reasons to hedge. And there are many bad arguments in practice that after taking this course you should avoid, okay? Hedging is about choosing which risks to take and not necessarily about reducing risk. If you ask people, you know, why do companies hedge, the answer that comes to mind, you know, if you ever heard about hedging, right, is that, you know, companies hedge to reduce risk. That is actually not true. And if this still sounds puzzling to you, please go back to Module 3 and revisit that. For example, a good reason to hedge is choosing which risks to take, choosing not to face currency risk or distress risk. You are avoiding those specific risks right? Whereas reducing the volatility of earnings is a bad reason to hedge. For example, we mentioned the fact that shareholders can do that on their own, right? It's not clear that reducing volatility is good. Companies have to take risk in order to create value. The other point is beware of speculation. One way that companies can hedge is by using traded instruments such as futures, and that creates a temptation to speculate, right? So maybe let me invest in oil futures because I think the oil price is going to go up. That is something that companies, CFOs should not do. If you want to do that, move to Wall Street. There's nothing wrong with working in Wall Street, of course, but you should not speculate with companies' resources. Companies should use futures, forwards, and other mechanisms to hedge and not to try to make trading profits. The other key idea that we mentioned, that we talked about in Module 3 is that hedging is more than just derivatives. When we think about hedging, the first thing that comes to mind is a futures contract, the Chicago Board of Trade. But in practice, companies will very often use additional tools such as liquidity, purchase obligations, operational hedging. In Module 3, we learned how companies do that. We learned the specific strategies that companies, the specific positions that companies have to enter in order to use these alternative tools, as well as futures and forwards. We also talked about that. But really, there is this key idea that hedging goes beyond futures. So you remember that as well. In Module 4, we did several M&A cases, and one of the key ideas that came up that I wanted to remember is that M&A, because of the size of M&A transactions, large acquisitions are the most important exception to that rule that companies usually don't issue equity to finance new investments. It's a basic fact of corporate finance. Companies are reluctant to go to the equity market, but for M&A deals, that's not true. Companies do pay for M&A deals with stock, and there are several reasons for that. One reason is leverage, of course, to reduce leverage, but there is also the risk-sharing aspect that we emphasized in Module 4. And then there is private equity, right? Private equity, unfortunately, usually they cannot access public equity. A private equity fund cannot issue equity to finance a deal, so that's because that's the reason why it's called private equity, right? So we talked about how private equity, they use their own money and then creative financial strategies to address high leverage issues and to get deals financed. That's specifically true for leverage buyouts, okay? Private equity deals, I call this heavy in finance because it's really a situation where financial management becomes really, really important. Because of this, private equity deals are a great laboratory. No matter what you think about private equity, if it's good or bad for the economy, that's actually an issue we discussed in Corporate Finance 1. From the point of view of learning and research, private equity is great because it's a great laboratory to study financial policy. If you go back to Module 4, you'll see how private equity deals really force us to think about issues like what is the optimal leverage ratio? What do we do if we have to go beyond optimal leverage? How do we address high leverage problems with mechanisms such as bank debt? How do we change the payout policy if we have the high leverage problem and all that? So I think going back to those cases is really going to allow you to see how these financial concepts we talk about in the course apply to the real world. And we can do that because of private equity. Finally, the last thing we talked about is financing R&D. Again, that's a very important investment in the real world. That's how companies innovate, create new products. And it's also very important to think about the financial management of R&D. The two key ideas that we discussed in Module 4 is that an R&D investment usually cannot support a very high leverage ratio. So these investments have to be financed with equity. And then also the idea that R&D, because of the staged, because the investments are staged over time, you invest today, you also invest in the future, that creates a risk management role for tools such as liquidity. So when you think about financing R&D, it's not just how you finance R&D today, it's also about how you manage the future risk that you might have to make an R&D investment, or that you might have to make an investment in a product in a time when your financing dries out. So if you want to review those concepts, please go back to Module 4. But it's again, and I think one of the key issues we learn in this course is that the financing of R&D is also special. It's another example that we can use from the real world to understand how we use these financial policy ideas to manage real world investments. And really the last thing I want to talk about is, it sounds like we know everything, but of course that's not true. It would be a very boring it would be a very boring situation for a researcher if we had already learned everything. And there are many open questions in finance. Let me just talk about a few that we did discuss in this course, right? That they came out when we were thinking about, real-world financial policy. For example, we don't really have a quantitative trade-off model of capital structure. We don't know how much debt, should a company have exactly, right? We know the median firm. We use the trade-off model in a qualitative way, but it would be better if we had the quantitative model. We don't have that. We also don't know why credit ratings should matter so much. We know that they matter, right? And there is some regulatory arguments behind it, but there is this question that perhaps credit ratings matter too much. Why do companies should care so much about credit ratings? When we talked about payout, we talked about the dividend puzzle, right? We really don't know in corporate finance why do companies pay dividends. So at this point, the best we can do is to say that companies pay dividends because investors like it. If you cut dividends, your stock price goes down. But we really don't know the underlying reason why companies pay dividends, because most of the reasons why a company would pay a dividend can be replicated with a stock repurchase. And finally, in Module 3, at the end of Module 3, we talked about this big puzzle in finance, which is that we really don't know how to adjust the cost of capital for unhedged currency risk. We gave a few examples, and we talked about the Goldman model, which is used in practice, but it's not a great model. So this, again, is an issue where I think we'll learn more. Hopefully, next time I teach this course, we're going to have better answers for this question. I just want to end with a big thank you for every student who took this course, and especially for students who have hanged on for 2 courses. I know it's a lot of material, but I really put my heart into this. Every topic that I thought about, it took me a long time to think about it and think about how am I going to teach, which papers am I going to talk about. I really put my heart into this, and I want to thank you for, hanging out with me and being here, and I hope you learned as much as I did. I actually learned a lot from teaching this course, and I hope you also learned. And I hope to see you in the future, in a future course in Coursera or somewhere else. Good luck to everybody.
At Geese College of Business, one of our strategic priorities is to democratize education. We do that by delivering our IMBA, IMSA, Executive Education, and Business Minor online. That is not business as usual, and it's certainly not the online education of old. We put our very best faculty in the online space. They actively engage with students from around the world, face-to-face in a digital classroom. Faculty and students collaborating together infuse these programs with the personal attention that enables students to reach their full potential.
The IMBA program through the Geese College of Business is so incredibly innovative. The ability and accessibility to reach a whole new audience of students and let them learn on their own time has been phenomenal. And being able to collaborate with people across the globe and to learn from top-notch professors has been completely revolutionary.
When you're interacting and teaching in a live session, you can kind of see the student's environment. And while I'm teaching here at night in Champaign, it's daytime wherever they are in the world, some of them. And so it sort of slaps you in the face immediately that there's a completely different perspective.
You might think, oh, it's more removed, it's more distant. But in fact, my experience in an online class has actually been surprisingly intimate and connected. In a classroom setting, you might have 50, 60 or more students in a room at one time, and so I'm scanning around looking at people. But in an online, I'm looking at one place and the student's looking right back at me. And that's surprisingly a direct experience.
I was shocked at how much it felt as good or better than when I was sitting in class in my undergraduate days. Everyone has their cameras on their computers. There's a chat feature, so you can also type in a question and the professor can answer your question that way.
I think the cool thing is that you can truly participate from wherever you are. These systems work on your desktop, on your cell phone.
We were traveling in the middle of nowhere back from Indiana, and on the Wi-Fi still on my iPad, I was able to connect through Zoom with classmates in Dubai and Tokyo and California all at the same time. Even being in a remote place, on the go, the accessibility and the exposure that I was able to get was phenomenal.
Getting my MBA makes me feel empowered because I don't need to stop being myself. I don't need to stop working. I don't need to stop being a mother. I don't need to stop having my life. And that is everything.
Our online programs are designed to be career-curated learning experiences. Our leading-edge course material is structured the way that professionals apply these concepts every day. Leadership, communication, and critical thinking skills are built into the core, empowering our students to put their purpose into practice at the highest level.
One of the most impactful things is just your ability to take the skills that we deliver and take them back to work on Monday. I've heard a couple of stories where students have talked about the skills that they were able to build over a couple of weeks, and then they were able to immediately bring that skill set back into their job and make an immediate impact.
I would recommend GEES IMBA program for anyone. This is both if you're starting, questioning your career, to if you're a professional and you want to hone your skill, this is it. This is the place to be.
At Geese College of Business, we are truly revolutionizing how online education is delivered. This isn't just a few PowerPoint slides and a reading assignment. Our faculty and students thrive in this one-of-a-kind global classroom. Relevant, timely discussions about current topics from around the world keep content fresh and exciting. The next generation of business leaders will come from all corners of the world, and now they converge here at Geese Business.